All right, so I did prepare some slides for this, but we are also going to be looking at charts. So like I said, bootcamp day number 2, we are going to be reviewing candlesticks and volume. When it comes to candlesticks, I only pay attention to a few very basic ones. I know there's a bunch of weird candlestick formation names, like just some crazy candlestick formations, like the upside down clown went into the cloud, drip, top, drop. I don't know, I just made that up. But there are some really weird candlestick formations, so we're only going to be focusing on the main ones that I pay attention to. So the very first one is going to be a bullish and bearish hammer. Looking at the bullish hammer on this example over here, this is where price ended up opening up on that specific time frame. It could be the 5-minute, 15-minute, 20-minute, 30-minute, hour, whatever time frame you are using to identify your setup. This is where the open is on the green. Price traded up to this high point right up here, but sometime throughout that time frame, price dropped all the way down to this low, but the buyers were strong enough to the point that they were able to push price all the way back up into this high point right here. And by the end of that time frame, we got a close up here. What is that telling us? Buyers are very, very strong. If price dropped all the way down to here and they push price all the way back up here, those buyers are strong and those buyers are outweighing the sellers. For a hammer to be considered a bullish hammer, it doesn't have to just be green. It could be red as well. I see a lot of people get that confused. They'll see a red body and they're like, whoa, 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 whoa. That is not a bullish hammer. Yes, it is. It doesn't matter if it's green. It doesn't matter if it's red. If we have a small body at the top of the candle and then a very long lower wick, that is going to be considered a bullish hammer. And when you see a bullish hammer, this is a bullish indication that buyers are likely going to try to push prices up. In tomorrow's class, when we talk about the price action and how we piece together the overall candlesticks and volume and levels, it's going to make a lot more sense. So for the time being, this is a bullish hammer. Again, it implies that buyers are going to try to push price higher. Now, as far as the inverted hammer, also known as a bearish hammer, it's pretty much flipped upside down. So this is where price opened up on the green candle. They pushed price all the way up into this high. However, the sellers outweighed the buyers and were able to push price all the way back down to here as the candle closed. Same thing over here, except price opened right here and it pushed all the way up to this high. However, the sellers were so strong that they pushed price all the way back down to this low point right here. And this is indicating that sellers are outweighing the buyers and that more than likely they are going to try to push price down. Again, tomorrow when we piece together the levels as well as the price action and the volume, it's going to make a lot more sense. Now we are going to run through these candlesticks and then we're actually going to go look at a real chart. But the next candlestick that we're going to be looking at is the bullish and bearish engulfing. So as we can see, we have this small bodied red candle right here, and then just a massive green candle right here that swallows up the previous red candle. What this is implying is that there were little sellers right here, and the next candle was enough buyers to swallow up the amount of sellers over here. That's what's considered a bullish engulfing. However, when I trade, if there's just a big, thick green candle, I'm going to consider that a bullish engulfing candlestick. To me, it doesn't necessarily have to swallow up a previous red candle. As long as it is a large green candlestick, I consider that a bullish engulfing, and that implies that buyers are very, very strong at that area. As far as bearish engulfing, we have this small body green candle and then a large red candle right here. This is implying that there wasn't a lot of buyers right here, but when the sellers came in, they were able to swallow up the previous buyers, implying a lot of selling pressure. So when we see bullish engulfings, this implies that price is more than likely going to push higher. When we see bearish engulfings, this implies that price is more than likely going to go lower. Again, when we talk about volume and levels, it's going to make a lot more sense. The next candlesticks I pay attention to are Dragonfly and Gravestone Dojis. A little different than the bullish and bearish hammers just because the actual body of the candlestick is a little smaller. So as we can see on this red candle right here, price opened right here, pushed all the way up into this high point right here, and then sellers drove the price all the way back down into this low point right here. So this implies to us that the sellers were so strong that they drove price all the way back down into this low, and that body is very, very small. That is a Gravestone Doji, and that implies that more than likely sellers are going to try to push prices lower. Now, as far as a Dragonfly Doji, we opened up here, price dropped all the way down into this low point right here, but the buyers were so strong that they pushed price all the way back up towards that opening price. So when we see this implies that buyers are more than likely going to try to push prices higher. And then the final candlestick that I pay attention to is going to be dojis. A doji just basically is telling us indecision in the market. If the market is trending up, 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 and then all of a sudden we get a doji, that is more than likely going to be a reversal pattern just because buyers are not too sure about pushing prices higher. However, if price is dropping and then all of a sudden we get a doji, that implies that the sellers are actually uncertain about pushing prices lower, but the buyers are showing their presence. So again, we're uptrending, all of a sudden we see a doji, buyers are uncertain about pushing prices higher, and then sellers are actually showing their presence because they're pushing prices back down. At one point, this was just a bullish candlestick right here, and the green body went all the way up to here. However, the sellers came in, drove price all the way down. At one point, this was a bearish candlestick with a body all the way down here. However, the buyers came in and pushed prices all the way back up here. So again, when we see dojis at the top or bottom of a trend, that implies that one side became uncertain about pushing or driving prices lower, and then the other side was actually showing their presence. So if price is coming down to a support level, we want to be looking for bullish candlesticks. It could be bullish hammers, it could be a bullish engulfing, it could be a dragonfly doji. When I see that at levels of interest, that confirms a trade. If price is coming up to a resistance and I see an inverted hammer, a bearish engulfing, or a gravestone doji, that validates an entry for me. And again, we're going to go over that tomorrow. So those are the basic candlesticks that I pay attention to. Again, no crazy, insane names. There's literally so many of them, but I keep it very basic when it comes to the candlesticks. Now, the last thing we're going to discuss is going to be volume. I'm going to show it to you on a chart, and then we're going to look at some candlesticks. So volume, the amount of shares traded in a specific time period. That's it. All right, so now actually looking at a chart, if we pull up the S&P 500 futures, if we go to the 15-minute time frame and we look down at the volume right here, this is showing us how much volume was traded on the 15-minute time frame. So when this candlestick opened right here, this volume was at 0. By the end of the candlestick, the volume was all the way up to here. So if we look at this candlestick, this is a bearish engulfing candlestick. Again, for me personally, when it comes to looking at bullish or bearish engulfings, if there is a large red candle or green candle, this would be my red candle, this would be my green candle. If there is a large red candle, I consider it bearish engulfing. Look at the size of this candle compared to the previous candles. This is a bearish engulfing. Or over here, as we see, price drop, 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 drop. This would actually be a bullish engulfing right here. Price swallowed up the previous candlestick right here. Very large green candle. And as we see what ended up happening, price continued to push higher. So now when you're able to piece together the volume plus what's actually happening on the candlestick, you get a very good understanding of what is going to happen next. So as we can see right here, price drop, 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 drop. And then all of a sudden on the 15-minute time frame, we get a 15-minute bullish hammer. Again, it doesn't have to be green. It could be green or red. And no, I'm not colorblind. This is just how I like my chart. But as we can see, we get a bullish engulfing at the bottom of a downtrend. Now, depending on if there is a level of interest there, that could confirm an entry. So at the beginning of this candlestick, price opened right here, price dropped all the way down to here, but buyers were so strong that they then pushed price all the way back up to here, and we got a nice bullish candlestick. Sometimes you might have to wait for a few candlesticks to form before validating an entry. So because we have a bullish hammer right here, a small bodied candle right here, and then a bullish engulfing right here, that would confirm an entry. And again, look at the green volume compared to the previous red volume. As we come down, we get the bullish hammer selling off on lighter volume, a small bodied red candle right here, and then a bullish engulfing with larger green volume than the previous candlestick right here. That would confirm an entry. As price is pushing up, 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 as we can see, we get this gravestone doji right here with elevated volume on the 15-minute time frame. So as price opened right here, it pushed up. Sellers drove price all the way back down here, and that's probably where a majority of that 15-minute volume came from. And then we had another doji, buyers being uncertain about pushing prices higher. Again, if you had a level of interest up here, maybe that ended up confirming a trade. But as price trades down, it then tries to push back up. We then get another gravestone doji right here, and then price starts to break below right here at 815. If none of this gave you an entry, price pushes to the downside, comes back up, and then we get a bearish hammer right here on the 15-minute time frame, suggesting more than likely more downside is going to come. So as you piece this together with the previous candlesticks of this Dragonfly Doji of uncertainty, price drops lower, price tries to push up, comes back down, and then we get some thick sell candles right here. And then again, we come back up, and then we get this inverted hammer suggesting more than likely price is going to drop. That could validate an entry. Now, for me, when it comes to looking at the candlesticks, I am very interested in the wicks. The wicks are going to be the ones that let you know where the buyers and sellers are. So as we can see with price over here, price drops to the downside. We get this nice bullish hammer right here, Dragonfly Doji, whatever you want to call it. Look at that lower wick right there. Buyers are now present. As price comes back down again, what happens? 15-minute wick right back down into this low right here, and buyers bought it right back up. A little later in the day, price dips to the downside, buyers buy it right back up. And as a result, what happens? Price pushes back to the upside. Sellers were not able to drive prices lower below these lows right here. And as a result, what's more than likely going to happen? The buyers are going to come in and try to push prices higher. Here's a really good example in the overnight session on ES. As we see, price starts dropping to the downside. And then all of a sudden we get a Dragonfly Doji with very nice volume right here on the 15-minute time frame. Again, that is not always going to confirm an entry right away, but as you continue to watch more and more price action, what do we see? We wick down again, and then we get a bullish hammer right here on increased volume right here. Again, piecing together previous candlesticks with current candlesticks, that could then validate an entry. And as a result, price ended up pushing to the upside. And we got the guest speaker today, so she is going to take the video from here. No, I'm just kidding. So now if we continue to scroll back, looking at price over here, as we can see, we have this drop to the downside. Price then tries to push back up, setting a lower high. And then as we start dropping to the downside, bearish engulfing, very thick red candle to the downside. Buyers then try to start buying it up right here, and then another strong bearish engulfing, suggesting more downside is to come. And as we can see, price continue to drop to the downside. Looking at a 15-minute time frame over here, looking at the 15-minute time frame over here, there's actually a couple examples. As we can see, price tries to push up right here. What do we get? A nice little gravestone doji at the top of an uptrend, then a bearish engulfing. What happens? Price ends up pulling to the downside. Looking at this 15-minute candlestick right here, what happens? Price dips down, buyers buy it all the way back up, giving us a nice long lower wick, and sure enough, they go and push price higher. Then as we can see, we have this thick green candle right here, but then the following 15-minute candle, we have a thick red candle, which is a bearish engulfing candlestick. And as a result, what ends up happening? Price ends up dropping lower. As price pushes up the following morning, what do we see? We have a nice push to the upside, and from there we then get a 15-minute gravestone doji at the top of an uptrend, which is suggesting a reversal. And as a result, what happens? Price ends up pulling to the downside. So now when you're actually looking at these candlesticks, what's going to be very important is reading the volume with these candlesticks. Because as we can see in this 15-minute time frame right here, price tries to push up, it's on low volume, they keep selling it off. Then a little later in the day, price comes up, we have this 15-minute bearish candlestick right here on heavy volume, suggesting that the sellers are active up in this area. Again, piecing together the price action plus the volume is going to give you a very good understanding on what is going to happen next. Looking over here on the 15-minute time frame, what happens with the S&P 500? Slow uptrend all day, and then all of a sudden this massive volume spike right here with this long upper wick. What does that suggest? Sellers are active in this area. And what happened for the remainder of the day? Price sold off. So that is going to wrap up bootcamp day number 2. Today we covered candlesticks as well as volume. Again, piecing together the actual candlestick with the volume is going to give you a very good understanding if buyers or sellers are active at the area. And as a result, that can help us find high probability trades. So again, make sure you guys do tune in tomorrow for bootcamp day number 3, where we are going to be talking about price action. So if you guys did find value in bootcamp day number 2, what I need you to do right now is make sure to smash that like button And again, make sure you guys are subscribed with that bell notification on so you are notified every single time these bootcamp videos go up. Comment down below if you did enjoy, and I will see you guys in tomorrow's video at 7 p.m. Eastern time. All right, so in bootcamp day number 2 yesterday, we went over the individual candlesticks that I personally pay attention to, as well as volume. Today, we're going to be piecing that together, which we kind of did yesterday, but I do want to add more context of what we are actually seeing on the screen. So when looking at actual price action, and I believe over the next few days, I'm going to be showing you guys how to actually find levels of importance. But to add on to what we discussed yesterday, like I said, we do want to pay very close attention to the wicks, because the wicks are going to tell us the overall story. If price pushes all the way up to here and then sellers sell price all the way back down to here, what is that telling us? Sellers are active in that area. If you piece it together with the volume, that was the largest volume spike right here on the 5-minute time frame since way over here. What is that telling us? Sellers are active, and yes, this is a green candlestick, and no, I am not colorblind. This is just how I like to have my candlesticks. The blue one is going to be a green candle. The black candle is going to be a red candle. So looking at this green candle right here, even though it was green, look at this upper wick and piece it with the volume. Sellers were active. This was the highest volume we had since way over here. What's more than likely going to happen? Price is going to drop, and sure enough, there it went. So it's going to be very important to pay attention to the wicks, because we're not always going to get a bullish hammer, a bearish hammer, a Greystone Doji, a Dragonfly Doji, a normal Doji. But if you actually look at the wicks and you look at the volume accompanied with the wick, that is what's going to tell you the story, and that is where reading price action is going to come in handy. So what we're going to do is we're just going to look at a few different charts. Right now, I just have the NASDAQ futures pulled up on a 5-minute time frame, but we're going to look at NASDAQ, and then we'll look at the S&P 500 futures, and then I'll just pull up some random stock after that. Regardless of what you're trading, price action is going to be very, very important. And again, when we piece it together with levels of importance going into these next few days, it's going to give you a better understanding on confirming a long entry, a short entry, or if you shouldn't even be trading at all. So if we are looking at the NASDAQ today, actually here's a really good example. As we see in the morning, price dips down to the downside, buyers buy it up. So we have this nice lower wick right here, nice lower wick right here, nice lower wick right here. Yeah, they sold it off right here. But as we can see, price pushes to the upside. It tries to break above this high point right here. But what do we notice? Small body, wicks are about equal on both sides, maybe a little longer to the upside. This one right here, same exact thing, small body, nice little lower wick. However, that upper wick actually got longer. Now, if we look at this next candlestick, small body, small lower wick, but look at this upper wick. And judging by the overall price action right here, we can sit here and assume that sellers are very active in this area. And piecing that together with the volume, as we can see, we get a low volume push up, denial. Right here, a little bit of spiked volume lower than the previous one. But then on this one right here with this super long upper wick where they tried again to push it above these highs and hold it, look at the volume right there. Look at the volume spike. Piecing together the volume spike with where that longer wick is, we can conclude that a majority of this volume came from the sellers up here. And then from there, what ended up happening? A nice little dump to the downside. Price tried to bounce right here, and then they weren't able to hold it, and price continued to flush to the downside. Now from there, what ended up happening? We talked about bullish engulfing candlesticks yesterday, so price flushed all the way down into the opening print towards the low of the day. We get this red candlestick right here, but then a very large green candle right here that swallows up the previous candle. What does that tell us? That there are very strong buyers in this area. And then from there, what do we get? Another bullish engulfing to the upside. So looking at this, we could then say, okay, buyers are showing their presence right here. And then watching the next candlesticks, we can see buyers try to support it right here. Buyers try to support it here. And then price dip down into this FVG, which we will be talking about in a future lesson. As we see, price comes down, wicks into the area of interest, and then buyers bought it right back up. If that did not confirm an entry for you, well, the next bullish engulfing candlestick definitely did. So if you didn't get long here, which again, we will talk about sniper entries and how you can use them to skew the risk reward in your favor. But if you didn't get long here, this definitely confirmed it right here. Piecing together the price action with an area of interest with the volume lets us know, okay, the buyers are here. We have more green volume right here than the two previous red candlesticks right here. We have a level of interest. We have a nice lower wick right off of that area. Let's try a long entry with a stop loss right below here. Or when we go into future lessons using a sniper entry, you could have gotten long maybe around here, maybe up here, depending on the lower time frames, with a stop loss right below here. And as we see, price pushes up into a new high a day. We get a nice little pullback, but again, look at those lower wicks. They are supporting it. So buyers right here, buyers right here, buyers right here, nice little dragonfly doji. And then they push it up into a new high a day yet again. Price pulls back. They hold it right here, and then price continues going up from there. So that's just a little rundown of today. And I know that this is in hindsight because this already happened, but I am doing this every single day live inside of Team Bull. I am telling people exactly where I am entering trades and why I am entering trades. So once you're able to fully understand the price action and the volume, that is really going to help you understand, okay, is this a good entry? Is this not a good entry? So let's just go ahead and look at another example right here just because I saw it. So as we see, this is in the overnight session on the NASDAQ futures. Price ends up pushing to the upside. We have a nice little pullback right here, pullback again, and then pullback. But look at this volume compared to the two previous red candles right here with this lower wick right here. What is that telling us? Buyers are present in this area right here. Also at the same time, again, we will talk about fair value gaps in the future, but what do we have? Fair value gap. So wicked right off the area, volume came in, nice little bullish candlestick. Sure enough, what ended up happening? Price continued to push to the upside. Maybe you didn't get long right here. Maybe you wanted to wait for a candle close above this area right here. If that happened, where was your entry? Right here. And as we see, price continues to push up, pulls back, buyers, 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 and sure enough, what happens from there? Next leg up, nice bullish candlestick, bullish engulfing, continue to push, 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 and then eventually we top out and start dropping to the downside. Let's head on over to, I do want to say, in scenarios like this, when we do consolidate, just try to avoid it. So as we see, this was on Tuesday on the NQ futures. This was actually a really nice candlestick right here, and we will look at that. But as we can see, price ended up dropping in the morning. A lot of sellers over here, price ended up dropping. And then we had this very high volume lower wick right here. So again, this is how you could have used price action to understand, okay, this might actually be a bottom. And if you had an area of interest down here as well, that would help confirm. So as we see in the morning, price ends up dropping to the downside. And then on this large flush down, I want you guys to notice this. Look at this very bearish candlestick right here. Large flush to the downside. Price continues to drop right here. And I remember actually watching this as price dipped to the downside. A lot of volume started to come in during this candle right here as we drop, and then they push price back up. What is that telling us? There are a lot of buyers in this area. This is the highest volume candlestick since the open. Look at the opening volume compared to this volume right here. This is letting us know that yes, there are buyers in this area. So as a result, again, using smaller time frames, sniper entries, you could have gotten long on this candle right here, or maybe you wanted to wait for a little more confirmation before getting long. But again, a majority of the volume started to come in down towards these lows as buyers started entering the market. And then from there, we have a nice bullish candlestick, bullish candlestick, bullish candlestick, a little upper wick right here. But again, that's not going to scare you out of a trade. Push to the upside, and then we go into this consolidation right here. Being able to identify consolidation is going to be very important as well, because when we're consolidating, you typically want to avoid taking any trades. So this right here, this was just chop. But then from there, as price broke below that consolidation right there, we then pull back. It might have been to a Fibonacci. Let's see. Let's take this pivot low right here to a pivot high, right to the 50% retracement. Bingo. So we have an area of interest. Again, we will go over on how to find these areas of interest. Price pulls back. We have a very nice bullish candle. Look at that lower wick and then piece it together with the volume. So nice bullish candlestick, a very long lower wick, heavier volume since all the way over here. And this was selling volume. So a lot of buyers coming in, get long with your stop loss right below these lows. Again, looking at the price action, combining it with the volume and a level of interest, then confirm the trade and price pushed into a new high of day. Here's another really good example on NQ. So as we see in the morning, price pushes up and then it flushes to the downside. But what I want you to notice, again, the price action, look at that lower wick, look at the volume. What can we conclude? A majority of this volume came in from this lower wick right here. As price dipped to the downside, buyers were buying it up. And as a result, a majority of the volume ended up coming from there. Next candle, we had a low volume retest of that area right there. Again, buyers absorbing the sellers, giving another bullish candlestick right here, nice bullish wick. And as a result, what happened? Price pushed to the upside. I actually believe we even took this trade inside a Team Bull. I'm like 99% sure this is the actual trade that I ended up taking. So very nice bullish candlestick and price action over here. A little later in the day, what do we notice? Price comes down, tests that area again, even over here. Again, notice high volume spike, lower wick. What can we conclude? Buyers are in this area. Again, later in the day, price comes down, tests the area again. A lot of volume comes in compared to the previous volume candlesticks right there. And what happens? Price pushes up, comes back, sets a higher low, and then pushes from there. Let's look at one more example on NQ. And I'm actually curious if this was a retracement right here. Let's take this pivot low. Let's take this pivot low to pivot high. And sure enough, that was a retracement zone. So as we see on NQ a little later in the day, pivot low, pivot high, price flushes to the downside. Buyers enter at the 50% retracement. Nice little dragonfly doji right there. And then price dips down. Look at the lower wick. Look at the volume. Again, highest volume that we have had actually since here, right? But highest volume before that all the way over here, which is telling us, piecing together the wick with the actual candlestick and the volume, buyers are entering at this 61.8. At the close of the candle, you get long, stop loss right below this low. Price came back down, retested it again, held it as support. If you didn't like any of this price action right here, this bullish engulfing definitely got you interested in the trade. And then from there, what ended up happening? Price continued to push to the upside, came down, set a higher low, and then continue to push back to the upside. So that was just many examples on NQ on the 5-minute time frame, the Dow Jones futures on the 15-minute. All right, so here's the Dow Jones on the 15-minute time frame, and right off the bat, you can see an area of interest right here. As we see in the morning, price continues to climb to the upside, price pulls back. Look at this 15-minute candle right here with that volume spike. Highest volume that we had since way over here, plus two nice lower wicks right here. So we can conclude, again, more than likely a majority of that volume came in down here as buyers entered the market. Price then came down and retested it again. Again, a nice volume spike with a nice lower wick right at that same exact area, and then buyers entered the market, push price even higher. So that's one example. Let's take a look. Let's go right on over here. So as we see to the upside, as price continues to climb on the 15-minute time frame, we start climbing on lower volume, which is typically a hint that more than likely price is getting ready to top out. And then as price pushes up, we can actually see that this candlestick is the same size as this candlestick over here, but the volume is slightly elevated. What can we conclude from that? That more than likely there's some selling activity going on up here. And then the next candlestick, a lot of volume comes in and then price pulls to the downside again. I don't know exactly what ended up happening, if there were buyers right there, or if a lot of the selling ended up happening up here. But then from there, price started to flush to the downside. A very bearish candlestick right here with a very small lower wick. And then price sits here, breaks, sets a new low, and then continues to drop to the downside. If we head on over, let's see, that's right off the open. Let's continue right on over here. Right here is actually a really good example. So as we see, 15-minute time frame, going into the market open, price is just consolidating. But as the market opens, this is what I want you guys to notice. Price wicks down all the way down to here. Buyers push price all the way back up to here. This candle then consolidates. This candlestick then comes down, retests the same exact level, and then engulfs both of this previous two candles right here. And then from there, price pushes up, sets a higher low, maybe at a fib. Let's see, pivot low, pivot high, right at the 50% retracement. So again, using a smaller time frame, could have sniped an entry right off that 50% retracement, maybe the 5-minute, 2-minute, 1-minute, whatever it may be. Very nice candlestick right here. This was actually a very nice one as well. Price dips down to the downside, pretty much hits it there, hits it right here, confirming an entry long. And then from there, as we can see, price pushes to the upside. And then we finally start getting some selling activity. So there was a lot of selling going on right here. Very huge 15-minute volume spike. And then as we can see, next one's a gravestone doji. Price kind of sits here, consolidates. And then the final push to the new high a day was an inverse hammer with elevated volume. Again, higher volume than these previous candlesticks right here. And then look at the upper wick. As a result, what is this telling us? More than likely, price is ready to drop. Then we get a bearish engulfing. Price then goes into consolidation. Again, using smaller time frames, maybe there was an FVG. You can see that there is a 15-minute FVG right here. Maybe there's one on the 5-minute, whatever it may be. And then price ends up continuing to drop to the downside from there. We can look at this example over here. Price continues to push up in the morning, sits in consolidation. Again, this is what you want to avoid because there's literally like, you can't read this price action at all. Like the wicks are pretty much the exact same. The only thing I could say is these two wicks right here because you know, the upper ones, they're slightly higher than the lower ones right there. So we have these two longer upper wicks right here. Price then pushes into a new high day. But what do we notice at the top of this uptrend on the 15-minute? A Gravestone Doji, which we talked about yesterday in bootcamp day number 2. Gravestone Doji, elevated volume, which is telling us what? Sellers are active in this area. And then from there, we get a consolidation candle and then a nice flush to the downside. And then finally, we're going to look at the S&P 500 futures, but this time on the 30-minute time frame. So price action you can literally use on any time frame. It just really depends on what time frame you want to validate your setups. So if we're looking at the 30-minute time frame on the S&P futures in the overnight session, as we can see, price is climbing to the upside, and then from there, what happens at 8:30? We have this nice upper wick right here. Elevated volume, maybe news based. I don't know exactly what happened on whatever day this is, July 27th. Maybe there's news, but look at the upper wick. Nice selling volume right there. Price then consolidates on the very next 30-minute candle. What happens from there? Price then has this nice little doji, and then the following 30-minute candlestick from there, what happens? Bearish engulfing. This is letting us know that price is more than likely going to drop. So what are we going to wait for? We're going to wait for some kind of retracement, whether it be an FVG. We got a nice 30-minute one right there. So here's our 30-minute zone right there. Price comes up and it dojis inside of the FVG, which tells us what? Buyers are uncertain about pushing prices higher and that sellers are actually active in that area. So you could then get short at the end of that candlestick, 46.22, stop loss right above here, 46.26, 46.27. And what happened from there on the 30-minute time frame? Flush to the downside, small body candle, flush, flush. And then we're just going to take a look at this example right here. Again, we went over the S&P 500 yesterday on the 15-minute, but as we can see, we got nice buyers right here, nice buyers right here. Price consolidates, breaks into a new high day. Price comes down, sets a nice dragonfly doji, pushes price higher. And then on the 30-minute, at the end of the day, we got this nice upper wick to the upside with very heavy volume. Now, again, I know this is the end of the day, and that's typically where the volume is going to be elevated. But again, nice upper wick, bearish candlestick, and what happens in the overnight session? A nice little drop to the downside, nothing crazy. And actually, we'll just do one more example. So as we can see, 30-minute time frame on the S&P 500 futures, very bullish candlesticks to the upside. Price continues, and then we have this small candlestick right here. So we have this small green candle, lighter volume, and then the next candlestick engulfs the previous. What is that? Bearish engulfing. So again, what can you do? Use smaller time frames to identify setups, but we did have a nice little bearish engulfing candlestick right there. And then from there, what happened? Price continued to flush to the downside. So that is going to wrap up bootcamp day number 3. Hopefully that helped you guys read overall price action. And then going forward, when we start piecing together levels plus the overall price action and volume, that's really when you're going to understand, okay, is this a good entry? Is this a bad entry? Should I wait for more, etc.? So if you guys did find value in bootcamp day number 3, what I need you guys to do is comment down below letting me know. Again, make sure to do your daily check-in. Let me know that you guys are still rocking with me. And if you haven't already, make sure to smash that subscribe button and make sure you guys have that bell notification on so you are notified every single time these boot camps are uploaded. But that is going to wrap it up for today. So as always, I hope everybody has an amazing rest of your day, and I will see you guys in tomorrow's upload for boot camp day number 4. Alrighty, so levels of interest. There is many different ways that you can identify a level of interest. Some of them being support and resistance, some of them being Fibonacci, supply and demand, or you could just use indicators, VWAP, moving averages, Bollinger Bands, Keltner channels, and there's just so many different ways that you can identify levels of interest. That's why throughout these next few days, I'm going to be showing you each way that I identify levels of interest. I want to keep today's video relatively short. It is Friday, and I can guarantee most of you guys don't want to be sitting here for 20 minutes watching a YouTube video on your Friday evening. So I do want to discuss 2 trades that I ended up taking today using levels of interest, plus the 2 previous videos that we had on price action, volume, and I believe it was piecing together the price action, volume, and candlestick. So now we're just going a step further and we are including the levels of interest. So one of the trades today, this was the second trade that I ended up taking, well, technically third trade, but so on SPX today, I realized that SPX was coming down to a whole psychological level of 4,500. Again, we are going to be discussing this throughout these next few days, but this was just basic support at 4,500. Now, as price starts flushing to the downside, as you guys saw in yesterday's video and the video before that on today's Friday, so on Wednesday, as we can see, the price action confirmed the level of interest because look at the wick and look at the level of interest. 4,500, very nice lower wick, and SPX doesn't have volume. So if we head on over to SPY and we look at that exact candle, head on over here, look at the volume on this 5-minute candle on SPY as SPX hit the level of interest at 4,500. Look at the volume, look at the lower wick. What does that tell us? Buyers are present, we have a level of interest, and the price action confirms. You don't need any indicators to tell you that this is a good entry. So we ended up getting long inside of Team Bull, and we actually caught a very nice move to the upside off this trade right here. But again, having that level of interest plus the price action plus the volume confirms for a high probability trade. So that was one of the trades that I ended up taking today. The other trade that ran 170% today on Apple. So if we pull up my daily watch list, I do go live here on this YouTube channel every single morning at 8 a.m. Eastern time and give you guys this watch list for completely free. You guys watch me draw my levels and everything. But on this watch list, I put Apple very interested in a bounce at 184.85 all the way down to 184.15. So we have our levels of interest. The reason being these were two Fibonacci levels. As you can see, 61.8% retracement, 50% retracement. And if you are looking to learn more about my overall day trading and swing trading strategy, how I find bounces, rejects, support and resistance, price targets, Fibonacci, all the indicators I use, and so much more, make sure to check out my 450-page book on Amazon titled The New Age of Technical Analysis. Tons of amazing reviews. Definitely make sure you guys check out the reviews. But if you are interested in learning more about my strategy, make sure to check out my book, The New Age of Technical Analysis, on Amazon. The link will be down in the description. So in the SPY trade, I was using a basic support level off of SPX. In this Apple trade, I am using Fibonacci. Again, there's many different ways that you can identify a level of interest. So looking at this Apple, again, 184.85, and then this 184.15. We could see in the pre-market that there was a lot of support at this 185. So now if we pull up Apple, and again, 184.15 was the lower one right there. If we pull up Apple, I literally got long the very first minute of market open. So as we can see, my bounce level was down here at this 184.15 level, and price dipped below the level. Now, what I want you guys to keep in mind, and again, we're going to see this throughout many examples going into these next few days, we're not always going to hit a level to the exact T. Sometimes we're going to break below it. Sometimes we're going to bounce just short, or if you're looking for a reject, we might reject just short, or it might overshoot it a little bit and then start rejecting. So I had my level of interest on Apple at 184.15. Price dropped to the downside and actually dropped all the way down to a low of 183.25, which was 90 cents below the level. But here's the thing. The buyers entered the market and they drove prices right back up to the upside very quick and very strong. And as a result, we ended up getting long with our stop loss right below this low. And as Apple pushed to the upside, obviously locking in the profits on the way up, the contracts ran to a high of 170% all the way up here. So again, looking at this 1 minute candle, yes, the first opening candle is going to have higher volume, but piece together this wick plus the level of interest plus that volume. What do we have? Price action, level of interest, volume, confirmation, get long, stop loss right below the lows. And since I have the 21 EMA on this chart, we can just go ahead and throw that on as well. Again, there's so many different ways that you can identify levels of interest. But if you like to use the 21 EMA, for example, and actually I'll show you Amazon because I didn't take this Amazon trade, but it actually looked really good. And I thought about it. I just didn't take it. And then of course, Amazon exploded to the upside. But as we see later in the day, Apple comes up, rejects the level of interest, 21 EMA, rejects it here, and if you like to use that as your level of interest and you have a game plan seeing something like this, you could have gotten short with a stop loss right above these highs. As you can see over here, maybe you could have done it here, maybe you could have done it here. Obviously, it didn't drop too much and then it came back up. So again, that's why having a plan and having a proven profitable strategy around your level of interest is going to be very important. So from there, Apple ended up dropping to the downside. The trade that I did not take on Amazon, there was actually a 5-minute squeeze, which I believe there is a class about the squeeze, but pretty much when there's a squeeze, a 21 EMA is going to be very important. So as we can see on Amazon a little later in the day, it broke above and then it came down and it had a nice wick right off of that 21 EMA and it reclaimed it with a bullish candlestick. The very next candlestick, what did it do? Came right back down to the 21 EMA, had a nice lower wick, bullish candlestick to the upside. Volume elevated, letting us know buyers were present, level of interest, and look at that wick. So again, what do we have? Price action confirming, level of interest, volume behind it. High probability setup, and as we can see, Amazon climbed all the way up to a high of 143.6 before then pulling to the downside. Let's just go ahead and make this an 8 EMA real quick. So boom, now we have the 8 EMA on the 5-minute time frame a little later, as you can see on this one right here. Again, if you have a plan around using the 8 EMA and that's how you identify levels of interest, because I really like to use the 8 EMA and 21 EMA to identify entries as well. So as we see, as price pushes up and it comes back down and it retests the 8 EMA, what does it do? Same exact thing, low volume retest, nice bullish lower wick right here. Price then comes back up, giving an entry stop loss right below here, or actually below the 21 EMA, because the 21 EMA wasn't too far. And then sure enough, there went Amazon. We ended up taking a swing on AI earlier in the week, and we actually got a very good entry right off of the daily 8 EMA. So we added a little earlier in the day, and then as price came down towards the 8 EMA, 8 EMA was actually a little lower. As we know, moving averages are going to move throughout the day and as more price action comes into play. But I told everybody to watch the 40 mark for an add to the position, because that is where the daily 8 EMA was for this swing. So we ended up getting an earlier entry somewhere up here as it started to break above a 4-hour bull flag. But then as it came down towards 80, that is when we added to the position, and these contracts literally exploded. This thing climbed all the way up to a high of 44.93 before pulling back. It was a beautiful trade. So this is why having levels of interest is going to be very important, because we don't simply want to buy just because we get a bullish hammer at some random spot in the price action, or we don't want to go short just because we get a gravestone doji in the middle of nowhere. Like, yes, sometimes we can do that, but a majority of the time, I don't want to do that. If we come down to an area of support, whether it be, Fibonacci, support, demand, an 8 EMA, 21 EMA, whatever, if it is an area of interest and I'm going to be looking to use that as support, then I want to see bullish price action off of that level. Bullish hammer, dragonfly doji, bullish engulfing, etc. So if that happens at a level of interest, that then increases the probability of a trade. Again, if it happens in the middle of nowhere, I don't necessarily care about that setup. I always want to take trades at my level of interest. If price is coming up to resistance, whether it be supply, normal resistance, another Fibonacci level, 8 EMA, 21 EMA, whatever it may be, and we start seeing bearish price action, bearish hammer, gravestone doji, bearish engulfing, etc., then that's what confirms a trade. So when you piece together price action, level of interest, and volume, that is what sets up for a high probability trade. So again, throughout these next few days, I'm going to be showing you guys multiple different ways that you can identify your levels of interest. I'm going to be showing you 3 different ways, and it's going to be an in-depth breakdown on each of them. So if you need to, make sure you guys go back and watch day number 2 and day number 3 of this boot camp, because that is going to be very important when piecing it together with these levels of interest. And other than that, everybody enjoy your Friday evening. And if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And get ready for boot camp day number 5. I'm super excited for you guys to see that video. Everybody have an amazing rest of your day, and I'll see you guys tomorrow. Alrighty, so let's start off with what support and resistance even is. So starting with support. Support is going to be an area that price comes down to that buyers think is a good level to buy into the market because they believe price is going to go up, which as a result, they can profit off of it. So let's just imagine that price is trading above this support zone right here. And let's just use a little line chart right there. Price is trading in this range. It's coming up, back down. And then we have this strong support area down here. And let's just say 45.6875. Through using support, we can assume that if price were to come back down and test this area down here, buyers are then going to enter the market, buying up the underlying asset. And as a result, if those buyers are strong enough, should send prices higher. So because they see a support zone, that is where they want to buy, because their stop loss would be right below support. They see this as a discount in the stock price. And again, they are assuming that price is going to bounce at this area right here and continue going up, which as a result is going to lead to profits. So again, support is going to be an area that price comes down to. Buyers are going to enter the market, which as a result should push prices higher. Now on the flip side, we have what is known as resistance. Resistance is an area where selling pressure hits the market. So it could be the buyers down here are thinking that price is overextended to the upside, and as a result, they want to lock in profits. Because if they were buyers all the way down here and price is now all the way up here, more than likely they are going to lock in some profits because they don't want to lose those profits. So they think price is getting overextended, which as a result, they are going to start selling to lock in those profits. Now, on the flip side, we actually have what is known as short sellers. Short sellers are people that think price is overextended, and as a result, they end up selling shares that they do not own, and that's a topic for a whole nother video. But they go short in the underlying market, meaning they have negative 100, negative 200, negative 300 shares, etc. And they are selling this to somebody else, and they are hoping for price to drop to the downside so the short sellers could profit off of this move right here. So again, if you're a buyer, you're buying down here, and if price goes up, you're going to make money. Short sellers, they can sell the equity, sell the futures, whatever it is, up here, and if price drops, they are going to profit off of that move. Now, as price comes down towards support again, the people that shorted up here, what are they going to do? They're more than likely going to want to lock in some profits. So as a result, if you're short, you have to buy to then cover your position. So the short sellers are then becoming buyers. Buyers in general who are waiting for the support touch are buying as well, which as a result should send prices higher. So that is essentially what support and resistance is. Again, resistance is where selling pressure enters the market. Support is where buying pressure enters the market. But there's also something that you do want to pay attention to when price does approach these areas of resistance or support, because it can set up for a high probability trade. Now, going back on over here, let's just say that price actually broke through resistance at this point right here. What can we assume is more than likely going to happen? Price is going to continue to drop to the downside. Why? Because buyers tried to buy at support, and there's also short sellers who are covering their position at support. What do you think happens if price breaks below support? The buyers who entered right here are going to scramble to exit their positions for as close to break even or slight loss as possible. But also at the same time, you have the short sellers that sold at support and then they saw price drop lower. FOMO is going to start hitting. So what are they going to do? As price starts to come back up, those buyers who try to buy right here are going to cover their position, as a result becoming sellers. And then you might have those short sellers re-enter the market to try to catch the next leg down. So as a result, when price breaks support, it is more than likely going to become resistance, as you can see right here, which again can set up for a high probability trade because you have the buyers scrambling to exit their positions, as well as the short sellers trying to get back into the position. So remember, when support is broken, more than likely it will become resistance. Now on the flip side, let's just say you are a buyer down here. Price is pushing to the upside, it comes up to resistance, and as a result, you're like, okay, I'm going to lock in my profits. Now, also at the same time, you have short sellers that are trying to enter short to try to catch this move back down. Now, what happens if price breaks through resistance? Well, the people who sold short are going to try to cover their position as close to break even or slight loss as possible, becoming a buyer. I just sounded like I was from New York or Boston, jeez. Anyways, as a result, becoming a buyer. And then those people who bought down here and sold at resistance, they're like, crap, price broke through the resistance. It's more than likely going to continue higher. So what are they going to try to do? They're going to try to get in as close to the price that they sold at as possible. And as a result, resistance should then become support, and price should get the next leg up. So that is the basic breakdown of support and resistance, what it is and how we can use it to identify high probability setups. So again, when price is coming up towards resistance, you want to look for a rejection. If price is coming down towards support, you want to look for a bounce. If price breaks resistance, you can look for a high probability trade in that way. And if you are looking to learn more about my overall day trading and swing trading strategy, how I find bounces, rejects, support and resistance, price targets, Fibonacci, all the indicators I use, and so much more, make sure to check out my 450-page book on Amazon titled The New Age of Technical Analysis. Tons of amazing reviews. Definitely make sure you guys check out the reviews. But if you are interested in learning more about my strategy, make sure to check out my book, The New Age of Technical Analysis, on Amazon. The link will be down in the description. If price breaks resistance, you can look for more upside. If price breaks below support, you can look for more downside from there. Now, if you haven't seen Bootcamp Day number 2, 3, or 4, I highly suggest that you guys go watch those videos, because we're not simply going to be entering short just because price comes up to resistance. We're not simply going to be entering long just because price comes down towards support. We want to piece together the price action plus the actual candlesticks plus an area of interest to then validate the setup. So again, make sure you guys definitely go and watch the previous days if you have not already. Those links will be down in the description. Anyway, so now when it comes to identifying your areas of support and resistance, the very first thing that I like to do is start on the higher time frames. So typically like a weekly time frame. Now, when plotting areas of support and resistance, what I want to mainly do is pay attention to the wicks. The wicks are going to tell us a very important story. The reason being, that is how low or how high price traded throughout that time frame. So on the weekly time frame, that's typically where I start. Sometimes a monthly, it just depends on, what stock I'm trading, if it even has a monthly level. So sometimes a monthly, sometimes a weekly, but mainly the weekly is where I'll start off. Now, what we want to look for is an area where we have at least 2 to 3 hits on the wicks. If I hit a body directly, then I will count that. Like, as you can see, if I were to just draw a line right here, you can see it hits a body directly. I will count that, but if it just like cuts through the wicks or cuts through the body, I don't really count that. So again, I want to hit as many wicks as possible, and if it hits the body directly, then I will count that. So again, I'll start with the weekly levels. Other areas that we want to know about for support and resistance is going to be previous higher lows, previous lower highs. So as we see over here, price was downtrending on the weekly. So this was a previous lower high. This was a previous lower high right here. And then this was all-time high. So as price came up to this previous lower high, look at what happened with ES. We rejected right off of it. And now we have this bearish engulfing candlestick. Over here, this would be an area that you want to know about. Price broke above it, therefore resistance is now invalidated, and it should become support if price comes down and test it. Now, if we're looking at this uptrend over here, as price starts pulling back and setting these higher lows, we want to know about this area right there. That could become support. This previous higher low right there could become support. This previous higher low right here could become support. This previous higher low right here could become support. So again, previous higher lows or previous lower highs can also become support or resistance zones. So if we're looking at the weekly time frame for ES, right here, right off the bat, I can identify an area of resistance. As we can see, we have this area where we hit one wick, and actually if we go on over here, we hit 2 more. So one right there, another one right there, another one right there. We cut through on the wick right here, but then we pretty much hit it directly here and here, and then we hit a few bodies over here as well. As price finally gave a bullish close above it, notice how it came back, made a support, and then pushed back on to the upside. If we look right here on the weekly time frame, this was a very strong weekly resistance as well. 1 hit, 2 hit, 3 hit right there. As we can see, price had a little bit of rejection at that area, came back up, hit that previous lower high, and then price pulled back down to the downside. So pretty much what I'm doing, like I said, start on the weekly time frame. Then from there, I want to break it down to a daily time frame. So actually, if we're looking at ES right now, what did price just come down to, where it's actually getting very close, was this previous, actually it closed right on top of it. So this previous resistance point right here, as we can see on the daily time frame, 1 hit, 2 hit, 3 hit, 4, price broke above it, never came back to test it as support. And as we can see on Friday, price came down and finally tested it as potential support. So we're going to see on Monday if this is truly support and if price pushes to the upside. So that would be an area that I would want to know about, especially over here until price broke above it. So over here, it's resistance. Now it's support. Now we will see what ends up happening from there. This previous resistance point right here, as we can see, we had a lot of price action right there, tons of resistance, and price finally was able to break above it and get the next leg up. Same thing here when we sat in this consolidation. Where was resistance? Right around this 4303 level, 4300. So again, those intervals of 100 are also going to be important. 4600, 4700, 4800, etc. So I'll plot my levels on the daily, then I'll break it down to a smaller time frame like the 4 hour. Same thing, I'm looking for wicks. So as we can see right here on the 4 hour, if you weren't able to see it on the daily, you can definitely see it on the 4 hour right here. So I would plot that as an area of resistance. Over here is an area of support as well. So I would plot that. Over here was an area of resistance as well, plus support right here. So again, would plot those levels. And then after I'm done on the 4 hour, I will then go finalize it on the 1 hour time frame. I will say a majority of the intraday levels that I like to trade are based off the 1 hour because those are newer levels. So as we can see on the 1 hour time frame, we actually have a really solid level right here. Previous resistance, support right there. We made it support a bunch of times until price finally broke below it. And then what can we see? Price came back up, made it resistance at that 45.59, and then ended up dropping yesterday. So as we see, support right here, price broke below, came up, hit it, made it resistance, right down to the next support zone. So that is how I plot my support and resistance levels. Now again, when it comes to using these areas, if price broke above resistance, we would be looking for more upside. Price broke below support, we would be looking for more downside. When price comes up to resistance, we want to watch price action. Why? Because price action is going to tell us if price is going to reject or bounce at our area of interest. So if price starts coming up to resistance, we're going to be looking for bearish candlesticks, gravestone dojis, bearish hammers, bearish engulfing, long upper wicks, etc. If price is coming down to support, we're looking for bullish hammers, bullish engulfing, dragonfly dojis, long lower wicks, etc. And then also piecing together the volume with those candlesticks at the level of interest, support and resistance. That is what's going to help us understand, okay, is price truly rejecting this area or is it truly trying to bounce? If you're looking at the price action and the volume at the level of interest and you're not seeing confirmation, what do? You do not take the trade. So that is how I plot my areas of support and resistance. Now, the other thing that I did want to bring up this video, and I do have a video later in this boot camp that we're going to be discussing this more in depth, is we can actually find really high probability trades if price breaks a resistance and fails to hold above, or if price breaks below support and fails to hold below. So yesterday I actually ended up missing out on this trade. This is a different setup that we are going to discuss later in this boot camp. But if we are looking right here, this was the pre-market low, which is also another area of support that we want to know about. But price broke below the support, but reclaimed it. As a result, that actually sets up for a high probability trade in the opposite direction. So price came up to a really strong resistance, broke through it, slightly held above it, but then immediately started reclaiming the opposite side with bearish price action. That is actually going to lead to a high probability trade to the downside. Reason being, if price were to break below support, what do you think's happening? Stop losses are getting hit. People are entering short because they think price is going to drop lower. But then as it reclaims it, those people that got short, what are they going to do? They're going to cover their position, becoming buyers. And as a result, that's exactly what happened over here. I literally talked through this trade yesterday in my live stream. I just didn't end up taking it. And I had a little bit of FOMO because this thing moved 18 points from where I was looking to enter. But I talked about this trade before it even happened at this area of support and the possibility of it coming down, false break, reclaim, and then a push back up into this high right here. And as you can see, that's exactly what it did. Same thing with resistance. If price breaks above resistance and starts reclaiming the opposite side, there's more than likely stop losses that are getting hit up there. And then people who are looking to go long because, oh, price broke above resistance. And if price starts falling below that resistance, again, it should become support. What's more than likely going to happen? They are going to cut their position, becoming sellers. And as a result, we should see price continue to drop to the downside. So you can look for high probability trades at those false breaks of support and resistance, but also we can watch support and resistance for rejects or bounces. Now, if price breaks above resistance and makes it support, you can look for a long entry with your stop loss right below. If price breaks below support, comes back up, makes it resistance like it did in this example right here, what can you do? You can look for a short entry with a stop loss above resistance. But that is going to wrap up day number 5 on support and resistance. Throughout these next few days, I'm going to be showing you guys other ways that you can identify levels of interest. Again, if you guys haven't already, definitely make sure you guys go back and watch the previous bootcamp videos. Also, make sure to do that daily check-in. And if you guys did find value in this video, make sure to smash that like button, make sure you're subscribed to the channel, and also make sure you guys have that bell notification on so you do get notified every single time these bootcamp videos are uploaded. Other than that, everybody have an amazing rest of your day, and I'll see you guys in tomorrow's bootcamp video. All right, so yesterday we discussed support and resistance. Supply and demand is going to be slightly different. Support and resistance is more so like an exact level that we want to pay attention to. So if we're just looking at ES on the daily time frame, like this is the resistance level that we want to pay attention to here to here. So it's more so direct levels. But when you're drawing supply and demand, it's more so an area that you want to pay attention to. It could be a very small area. It could be a very wide area. So starting with demand, I'm going to show you guys exactly how to draw this here in a little bit. But demand is going to be an area of support. So if we're looking at the daily time frame on ES, demand is going to be unfilled buy orders waiting in the market to be filled. Because you got to imagine these big funds that are trading with a lot of size, they're not going to be chasing the market up. They're going to wait for the market to come back to their buy orders. And as price comes back down towards those buy orders, also known as demand, they start to get filled. And as we can see, price then made another continuation to the upside. Here's another example right here. Again, I am going to show you guys exactly how to go about this. There was unfilled orders, price came back down, filled those orders, and then we saw a nice push to the upside. So again, demand is going to be unfilled buy orders in the market. As price comes back down towards that area, we should be looking for those buy orders to get filled. Look for bullish price action. And if we start seeing that bullish price action, that then confirms that support area, that demand area, and we should be looking for more upside from there. So if I was looking at ES at this time, as price is coming down into demand, I don't want to short ES. I actually want to be looking for buy orders. So this also helps us understand, okay, should we even be looking for shorts in this scenario? Or if price is coming up towards supply, should we even be looking for longs in this scenario? So this entire zone right here would be a no short zone. Same thing over here would be a no short zone until price broke below it. So that's what demand is going to be. Now on the flip side, we have supply, which is going to be unfilled sell orders in the market waiting to be filled. Again, large funds trading with large size, they are not going to chase the market. They are going to wait for price to come back to their sell zone and wait for their orders to be filled. So as we see, we have supply, and don't worry, I'm going to show you guys how to draw these. Price comes back up towards supply, the sell order. So again, supply is going to be resistance, an area of resistance, waiting for those sell orders to get filled. Price comes up, tests supply, pushes to the downside. Price comes up, tests supply, pushes back to the downside. Again, this is letting us know that we ideally should not be looking for longs in this area right here. Instead, what we want to look for is we want to look for bearish price action to then get short. So again, demand is going to be a support zone. Supply is going to be a resistance zone. Now, how do we go about drawing these areas of supply and demand? The very first thing that you want to look for is going to be a basing candle. So if we look on over here in this demand example right here, you can see that we have this smaller candlestick right here and then this very large aggressive move to the upside. You want to look for that basing candle and then the strong aggressive move. Over here was a small green candle before a large aggressive move down. When we get this strong aggressive move, it leaves orders that are unfilled in the market. And again, these big funds, they are not going to be chasing the market to the downside or to the upside. They're going to wait for price to come back and retest that area to then either get their orders filled to sell or orders filled to go long. So as we see right here, we have a small green candle, large aggressive move down, small green candle, large aggressive move down, small red candle, strong aggressive move up, small red candle, strong aggressive move up, small red candle, strong aggressive move up. And I could probably point out hundreds of different examples on this, and supply and demand actually ranges from multiple different time frames as well. And we will be going over the time frames that I personally use to identify supply and demand. Now, when it comes to drawing your supply zone, Again, we want to see that small basing candle before a strong aggressive move to the downside. For your notes, the basing candle for supply has to be green. If it is red, I do not care about it. It has to be a green candle before a strong aggressive move down. That's where I see a lot of people get this mixed up. They'll just take any basing candle before the aggressive move to the downside. It has to be green. So because this basing candle was green and then we had a large aggressive move down, this would be considered supply. Because this was a small green candle before a strong aggressive move down, this would be considered supply as well. So one more time, again, the candle has to be green before the strong aggressive red candle move down. As far as demand, the basing candle needs to be red before the strong aggressive move up. So because we have that basing red candle right here before a strong aggressive move up, that is going to be considered demand. We have a basing red candle here before a strong aggressive move up, that is going to be demand. If this basing candle is green before a strong aggressive move up, it is not demand. It has to be a red candle before the strong aggressive move up. If that is the case, then yes, that is going to be a demand zone. So now, how do we draw these zones correctly? So going back to these two supply examples over here, there's actually a couple different ways that you can draw it, and it depends on the wicks. So as we can see in this example right here, the red wick is higher than the green body right here. What I would do is take the high of that red wick down to the opening of that green candle right there. I'm not taking it down to the wick, even though the wick was, hardly below it. I take it to the body. Some people take it the whole way down to the wick. It's personal preference at that point. But again, I'm taking the high of that wick all the way down to the opening of that green candlestick. Same thing over here. I am taking the high of this red candle wick down to this opening of the green candle right there. If you want to, you can take it down to the wick. It's just going to make the level a little larger, which personally, when I'm drawing supply and demand, I like to keep my zones smaller. So again, it's just personal preference. Now, if we head on over here, we actually have another supply zone. As you can see, we have this basing green candle before a large aggressive move to the downside. But this time, notice how the green wick is above the high of the red wick. Because of this, I would take the high of the green candle down to the opening of the green candle. So right there. So again, in this scenario right here, I would take the wick of the red candle down to the opening of the green candle. In this scenario, because the green wick is above the high of that red candle, I would simply take the high of the green candle wick down to the opening of that green candle. So it depends on how price action forms, which is going to decide, okay, am I taking this high to this open or this high to this open? Whatever the highest point is, that is what you are going to take. And it's going to be the same thing when it comes to demand. It's going to really depend where is the lower wick. So as we can see right here, this red wick is lower than the green candle wick. We have the basing candle and we have the strong aggressive move up, but the red lower wick is lower than this one. Well, if that's the case, I am going to take the low of that red candle up to the opening of that red candle, and then I am going to project it forward. Same thing over here. We have this basing candle right here. The red wick is below the green, so this would be my demand zone right there. Again, if you really want to, you can put it all the way up to there. Again, I just personally don't. So you could do that. Again, same thing here. Red lower wick up to the opening of that red candlestick. In this example right here, you can see that the lowest point is going to be this green wick right there. So as a result, now instead of taking the lower red wick to the opening of that red candle, we would take the low of the green candle to the opening of that red candlestick, and then we would project it forward, and that would be our demand zone. So again, it's really going to depend on the overall price action between the large aggressive move down or up and then the basing candle. So that is how you are going to draw your supply and demand zones. Now for me, when it comes to drawing these zones, I usually will look at a weekly time frame to see if there is any weekly supply. So as we see over here on ES, there is actually weekly supply all the way up at these all-time highs up here. If we look over here, there is weekly demand right here. And if we look over here, depending on next week's price action, there could potentially be weekly supply right there. Just like everything else, when it comes to chart patterns, support and resistance, Fibonacci, etc., the higher the time frame, the more important it is going to be. So if we form weekly supply up here, that's going to be a really important level. This weekly supply right here, you can see that we came back up and we tested it and then never came right back up to it. So if price were to come back up into this like 47.20 area, I would be looking for possible reject. Right here, you can see that there was weekly demand on ES, and as we see, price came down, tested it, pushed back up until price finally broke below it, and then it was invalidated. We also had weekly supply right here. What happened? Price broke below it. So I will start on the higher time frames to start looking for supply and demand zones. As we see over here, there is a demand zone right there on ES. Boom. But I'll start on the weekly and then I'll break it down to a daily, start looking for any other areas of supply and demand that are actually applicable to where current price is. So price is coming down towards weekly demand right there. If I don't see anything on the daily, I'll then break it down to a 4 hour. As we can see on the 4 hour, we actually have a zone inside of the weekly. And this is something that I did want to bring up. So the fact that we're seeing it right now, this is very important, is we can find smaller zones inside of larger zones. So when we see this happening, where we actually have a smaller zone inside of a larger zone, I actually prefer to watch that area right there. So we have a mixture of weekly demand in this area, but then also we have 4 hour demand right at the bottom of the zone. If I am going to be using supply and demand, I want to watch personally this entire 44.26 all the way down to like 44.10 for a bounce. That would be the area that I would prefer. Again, I don't like these very large zones. I like to keep my zones smaller. So that could be a possible area, even all the way over here after price were to break below that weekly demand. We do have 4 hour demand all the way down here. So if price came down to it, this is a relatively small zone. I would be looking for price to potentially bounce. Same thing over here. There was a demand zone. Price just broke right through it. Try to hold it here, but once it broke below it, it was no longer applicable to current price. So after I'm done on the 4 hour, I then will go down to a 2 hour. Are there any other zones that I could potentially watch? There was a 2 hour zone right here. Price didn't really respect it too much. We had 2 hour supply right here, which as you see, price came up. And this was an area that I drew out live in my live stream in the morning before price started rejecting these areas. But as we see, price comes up, it starts rejecting it in the overnight session, rejected it more on Monday, rejected it on Tuesday in the overnight session. And then as we see from there, price started to flush. There is now a new 2 hour supply zone right here. So if price were to come back up into this area, I would be looking for a potential reject. After I'm done on the 2 hour time frame, I'll also look at a 1 hour, and actually we had a zone right here on the 2 hour. Price got very close. I might have already showed that one to you guys, but anyways, after that, I will then go look at the 1 hour time frame and see, are there any 1 hour zones that I could look at? And sure enough, inside of that 2 hour zone, we actually have a 1 hour zone that we could watch. So this area right here becomes higher probability because we have 1 hour supply inside of 2 hour supply. So if I'm going to look for a high probability reject, it would be 45.50 all the way up to 45.61. So again, when we have supply inside of supply or demand inside of demand, it makes it a higher probability area that we can watch. After the 1 hour, I'll break it down to a 45-minute sometimes, and then a 30-minute. And again, I'm not marking every single supply and demand zone. I'm only plotting what is actually applicable to where current price is. So if we're looking at the 45-minute time frame, we had supply right here on the 45-minute time frame. As you start getting on these smaller time frames, like a 45-minute supply way over here, you can see price actually came up, and again, we had supply inside of supply. But in a few days, a week from now, I'm not going to be going back here and looking for 45-minute supply and demand zones. I'm going to be looking for hourly, 4 hour, and higher time frames. So if I really can't find anything on any of the higher time frames, I will break it down to a smaller time frame just to see, okay, is there any 45-minute supply zones that we could watch? Like, if we were trading Friday or Thursday, yes, I would break it down to a 45-minute and start looking like, oh, are we near any supply zones? But again, come next week or the following week, I'm not going to be breaking it down to a 45-minute time frame to start looking for supply and demand. That would make no sense. I'll then break it down to a 30-minute time frame. And pretty much, again, same exact thing. I would be looking for, more recent price action. And in the 30-minute time frame, As you see right here, we had that previous supply zone, then we had another supply zone, and then on top of that, we have another supply zone. So we actually have 3 supply zones inside of this one area right here. So if price were to come up to this area, that would be a very high probability reject that I would be watching. So that is going to be how you draw your supply and demand zones and the timeframes that I personally use when plotting them. Typically with supply and demand, if I don't see any clear areas of support and resistance or Fibonacci, this will be what I end up resorting to, and it can help me identify price targets when I am day trading. But again, through supply and demand, remember, typically if we're in supply, we want to more so avoid trying to go long, and then if we're inside demand, we more so want to avoid trying to go short. Now once price ends up breaking through the demand or supply zone, I just go ahead and delete it. So because price, as we see, didn't even respect this, it just broke right below it, I don't care about it anymore. I go ahead and delete it. If price came up and it just broke right through this area right here, I don't care about it, I'll delete it. This one can still apply just because price actually only traded halfway into it. But that is going to wrap up bootcamp day number 6 on supply and demand. If you guys have any questions whatsoever about supply and demand, definitely make sure to leave them down in the description. I will be answering them. And again, make sure you guys are doing that daily check-in if you haven't already. And if you found value in this video, make sure to smash that like button. Make sure you are subscribed and make sure you have that bell notification on so you are notified every single time a brand new bootcamp video goes up. Everybody have an amazing rest of your day, and I'll see you guys in tomorrow's bootcamp video where we will be discussing Fibonacci. Alrighty, so hopping into Fibonacci retracements, I'm going to be discussing what the retracements even are and how we can use them to identify high probability setups, as well as discussing what I personally look for when price is trading at the retracement. So hopping right into it, the Fibonacci retracements, pretty much what this does is it lets us know areas that price can pull back to. So if we were to just go on up here into a blank space, if a stock is uptrending, setting higher highs, higher lows, higher highs, higher lows, higher highs, we can use Fibonacci retracements to understand where this higher low could be, or this higher low as well. As a result, helping us prepare for a potential trade if price does come down and hit the retracement. It's going to be the same thing to a downside. So if price is setting lower highs, lower low, lower high, lower low, we can use the Fibonacci retracements to understand where this lower high could be or this lower high. As a result, helping us identify a low risk short entry on the stock. So as far as drawing these Fibonacci retracements, what you are going to do is you are going to find the lowest point of price action. So as we can see in this example right here, this is the lowest point of price action. I'm actually going to show you on real stocks as well, but this is the lowest point of price action before price makes a strong move to the upside. Once price finally starts topping out in an uptrend, we're looking for bounces. So as price tops out and starts pulling back, that's when you can take the lowest point of price action to the highest point of price action, and that is how you are going to draw your Fibonacci retracements. Now, there are multiple different retracements that you can use, like the 23.6, the 38.2, the 0.5, 0.618, or even the 0.786. I just prefer to use the 50 and the 61.8% retracement. So I take everything off and I just leave the 0.5 and the 0.618, as those are the most important areas when it comes to retracements. So now looking at this pivot low, this was the lowest point of price action, and this was the highest point of price action. Highest point before price started pulling back. As a result, we can take that low point to the high point, and as we see, price comes down and it tests a retracement before the next move up. Now in a downtrend, or actually going back on over here again, remember in an uptrend, we're looking for bounces. So we're taking the low to the high and looking for a bounce. As far as rejects, we are looking for the highest point of price action before price drops to the downside. As price continues to drop and it finally sets a clear-cut pivot low and price starts to push back up, that is when we can take a pivot high to a pivot low, and we know, okay, let's watch the 50% retracement, or let's watch the 61.8% retracement for a reject. I'm even going to show you guys a trade that I took today using the Fibonacci retracements. So that would be the first pivot high to pivot low. And then as we can see right here, highest point of price action, lowest point of price action before price starts pushing back up. As a result, we can take that high point down to the low point and look for a rejection at the 50 or the 61.8% retracement. And as we see, price continue to drop to the downside. So again, remember, in an uptrend, we're taking pivot low to pivot high for a bounce. In a downtrend, we're taking pivot high to pivot low for a reject. So now, actually drawing these on some charts. You can draw Fibonacci retracements on so many different time frames. It just really depends on the overall price action. But looking at CRWD on the monthly time frame, I actually believe this did hit a Fibonacci retracement. So if we take the pivot low, lowest low to the highest high on the monthly time frame, we can actually see right here, price came and tested that 61.8% retracement before having the next move up. So if we just go ahead and mark this and we go to a daily time frame, and let's put on a 3-year, head on over here, we can see that price came down, bounced right off that 61.8% retracement, had a nice daily close above the level, which would have validated an entry long. You can use this for swings, you can use it for day trades. And as you see from that point right there, once price closed above it at 140, it rallied all the way into a high of, it looks like, around 205.87 before then pulling back. If we head on over to SPY on the monthly time frame, how could you have known that this 350 area was the low last year? And I made a video the day before we hit this level telling everybody to watch it. If you take the lowest low, the 2020 low, to the all-time highs at 480, you can see that 349.12 was the 50% retracement. If price were to break below that, it would have likely tested 318.25. Sure enough, what did we do? Pretty much tested it to the dollar, and then we rallied all the way up into 460 from that point. Again, I made a video the day before we touched it telling everybody to watch that. If we head on over to QQQ on the monthly time frame, if we just go ahead and delete this, take the pivot low, again 2020 low, all the way up to the high point right here, I told everybody to watch 258 the day before we touched it. And as you can see, price had a nice drop below and then reclaimed it, held it here, held it here, held it here, and now price has rallied all the way to a high of almost 390 off at that point. If we go to the weekly time frame on QQQ, let's start looking. We have a pivot high, pivot low here, pivot high, pivot low here, pivot high, pivot low here. So what can we start doing? Let's take this pivot high to pivot low. Price got very close to 61.8, however, did not hit it. Let's take this one right here. Price hit the 61.8, denied it, and as we can see, price then moved into a new low. We have another pivot high, pivot low right here. Let's take that one. 50% retracement, 50% retracement, started moving to the downside. How about let's just take this highest high all the way down to this lowest low. And it looks like we had a little bit of price action at that level, but not too much. Actually, it ended up breaking above it. But if we head on over to SPY, SPY actually did have the reaction. I remember the level, 429.61, because I was waiting on it for literally ever to hit. And it hit it, and we took a beautiful trade off of that 429.61. We go to the daily time frame, we see that we rejected it multiple times right here. So again, you can use this for swing trades, you can use it for day trades. It just depends on what your trading goal is going to be. So now let's look at a daily time frame. Let's take this 348.11 all the way up to this high point right here. We can see that price held that 50% retracement multiple times. What about this pivot low to pivot high right there? You can actually see price hit the 50% retracement to a T right there. So you can draw these on the daily time frame. You can draw them on the 4-hour time frame. So if we go to a 4-hour, there was an area that I think it actually hit on ES and then we bounced on Friday. Yeah, so if we look at the 4-hour on ES, we can see that price came down and it closed on top of that 61.8. So here is our pivot low on ES, lowest point of price action, highest point of price action. As we can see, price closed right on top of that 61.8% retracement on Friday. And now we have rallied all the way up to a high of 45.30. Now, as far as earlier, because I had this drawn on my chart, I go live on my YouTube channel every single morning at 8 a.m. Eastern time and give you guys a completely free watch list for the day. Look at the 1-hour time frame. What do we have? A pivot high, pivot low. What does that say? Hey, we should watch the 50% and the 61.8% retracement for a potential reject. And I told everybody to watch these levels as well. So if we look at ES, what happened? 61.8 right in the morning at 9:35, dropped to the downside. Let's head on over to NQ. Same thing, had a 1-hour downtrend. As you can see, pivot high, pivot low. Pull up a 1-hour time frame so you guys can see it. Pivot high, pivot low. What did price reject right in the morning? The 50% retracement before dropping all the way down to a low of 15,334. So now what about an intraday fib? Because this is exactly what I use today to find a beautiful put entry on SPY. So looking at SPY today, price came up, it hit that 50% retracement and made a move to the downside. So as a result, what was I looking for? Price to come back up, potentially set a higher low, and then take price lower. So as price rejected that 50% retracement, dropped to the downside, I noticed, okay, we have this high point, we had this low point as price started to move up. So what did I do from there? I took this pivot high to pivot low, and this was traded live inside of Team Bull Trading today. Traded live. We had an entry here, and we had an entry right up here. So again, we rejected the 50. We made a strong move down. I took the pivot high, pivot low. I told everybody exactly where I was watching for a rejection. 449, 449.12, and then my stop loss was at 449.3, which was above here. So now breaking it down to the smaller time frames, exactly what I was seeing as price came up, started rejecting just short of the level. I started the position, and then right here is where I entered full position. And then from there, we were able to catch this all the way back down into a new low of day and all the way down into 448. And I told everybody that I was fully exiting the position because we had strong buyers on ES, which I was able to see through Bookmap. And if you guys do want a video on Bookmap for this bootcamp, definitely let me know down in the comments. But again, you can use these Fibonacci retracements on any time frame. It just depends. Where is that clear-cut pivot high, pivot low? So if we're looking at a 1 hour time frame, yeah, we had this pivot high, pivot low right here. And what happened on Friday? Price came up, hit the 50% retracement at 452.9, and then sure enough, what ended up happening? We dropped down and set a new low. These Fibonacci retracements are everywhere. Now, what invalidates these setups? If price breaks it. So as we see, price broke the 50% retracement. If it breaks it, I don't care about it anymore. I delete it off my chart. If it breaks the 61.8, I go ahead and I delete it. I don't care about it anymore. So as price broke through right here, immediately just delete it. It's no longer valid. As long as price does not break and hold the level, it is still valid. This one right now, however, 452.9 is invalid because price set a new low. So at this point, there's actually no other clear-cut pivot high, pivot low that we could use for a good reject besides there to there. So maybe price comes up today and it tests 450 to 450.25 and it rejects. Maybe it doesn't. Maybe it just blows right through it and it continues to the upside. But the reason why I like Fibonacci retracements is because it lets us know an exact level to watch. With supply and demand, it's more so an area that you want to watch. With Fibonacci retracements, it's very precise on what level you should be watching. That's why I prefer to use it. And again, it's very easy to use. All you have to do is find a clear-cut pivot high to pivot low, or a clear-cut pivot low to pivot high. And then it lets you know what areas you should be watching. If we're looking over here on SPY on the 1 hour time frame, pivot high, pivot low. Price tried to bounce that 61.8, but ultimately it failed. If we head on over to the 5-minute time frame and we actually look at price action when it hit it, and this is another reason why I really like the retracements, because you can try it off of the level, and then if price breaks it, you just get out of the trade. So your invalidation point is right on the opposite side. So as we see, price comes down, it tests the 61.8, try to hold it as support, try to hold it as support, try to hold it as support. Where's your stop loss? Right on the opposite side of those candlesticks. So as price dropped right here, this would have stopped you out of the trade for a very small loss. And as you can see, price continued to downtrend throughout the day. Now, what I see a lot of traders do is they're entering off of these intraday setups and they don't necessarily have an area where they can say, oh, this is my invalidation point for the trade. So the losses start to get larger and larger and larger. That's why with the retracements, you can look at this and be like, oh, price rejected the 50% retracement. Let's go short with our invalidation point right above here. Or if price comes up to the 61.8 and it denies it at 450.26, depending on how the price action reacts and you got short, where's your stop loss? If price starts showing strength right above this level right here. That's why I love the Fibonacci retracements, because it lets you know an exact level that you should be getting in, and it lets you know exactly when you should be getting out. Here's another example of a trade that I ended up taking with Fibonacci. I believe this was last week. When was this? 7/27. So whenever that was, like a week and a half ago. But as we see with QQQ, I took this pivot high, pivot low right here. Look at what price did. Right to the 50% retracement. We sniped it off a smaller time frame, so a 1 minute or 2 minute time frame. We sniped an entry at the strong rejection of the level, and we were able to catch it back down into the low of day. And again, I did all of this live. I told everybody I'm watching 383.05 up to 383.43 for a reject. And as price confirmed the level short, that is when we got short and we're able to catch this down to the downside. So pretty much what I'm looking for when price is coming to these Fibonacci retracements is exactly what we discussed in previous classes. If you guys haven't seen the previous bootcamp videos, I highly suggest that you guys go and watch those as soon as you're done with this. If price comes down to our retracement, so we're looking for a bounce, what are we looking for? Bullish hammers, bullish engulfing, dragonfly dojis, or long lower wicks to suggest that buying is happening at that level. Piece it together with the volume, and the volume is going to tell us if orders are being filled and buyers are entering the market at that bounce. If we're looking for a reject, we're going to be looking for inverse hammers, gravestone dojis, bearish engulfing, long upper wicks, and then piece that together with the volume at the area of interest. That is going to let us know if sell orders are being filled up at that area and if sellers are entering the market. If we start seeing the volume in the price action confirm at the level of interest, what does that do? It confirms an entry. And now that we've gone through how to identify all of our levels, support and resistance, supply and demand, Fibonacci retracements, tomorrow we are going to be piecing everything together, price action, volume, and all of the levels of interest. And I'm going to be showing you guys how to find high probability setups combining all of those. So if you guys did find value in bootcamp day number 7, as always, make sure you guys smash that like button. Make sure you are subscribed to the channel if you aren't already. And make sure you do have that bell notification on so you are notified every single time a bootcamp video is uploaded. And if you haven't already, make sure to do that daily check-in down in the comments. Other than that, everybody have an amazing rest of your day, and I'll see you guys in tomorrow's bootcamp video, bootcamp day number 8. All right, so hopping right into it. Today, I actually ended up taking a trade on SPY, and I gave everybody the exact bottom on SPY. So I want to go over how did I find this level, why it was important, and I believe we discussed it yesterday in the Fibonacci video, if I'm not mistaken. So if I pull on over today's watch list, and I do go live every single morning on this YouTube channel at 8 a.m. Eastern time, you can see right here that I said SPY interested in a bounce at 445 to 445.3. 445 just because that's a psychological area of support, but 445.3 was a Fibonacci retracement. So now if we head on over to the chart, and that was the exact bottom today, was that 445.3. So if we go to the 4-hour chart right here and we take a pivot low to pivot high, again, if you guys watched yesterday's video, you should know how to draw Fibonacci retracements. If you have any questions about it, definitely make sure to leave them down in the description. But as we see, taking that pivot low to pivot high, and then this pivot low to this pivot high, we actually had a really nice Fibonacci cluster, which we have the 61.8 and the 50% retracement at the same exact area, making it a higher probability for a bounce. So now if we break it down to a 5-minute time frame, the trade that I actually ended up taking was right here, and I caught a nice 80-cent scalp to the upside and eventually was stopped out towards break even. Now a little later in the day, it came down and it hit the exact level, as you can see, 445.28, missed it by 1 penny, my bad. And then from there, price just absolutely exploded. So now, digesting, why did I like this entry right here? And also, how could you have identified an entry over here? So if we break it down to a smaller time frame, what I was watching on the 1-minute time frame was look at how price reacted as it came down to our area of interest. Again, to find high probability trades, we need an area of interest, we need bullish or bearish price action, depending on if we're looking for a bounce or a reject, and then we need volume to confirm the level. That is how we find high probability setups. So as we see, as price is coming down, we have a very large volume spike right here. But then as price comes down, we get a nice bullish hammer with a long lower wick, and then look at that 1-minute volume. We have elevated volume at the level of interest. So what does that mean? That gives us our entry in the trade. That is personally why I ended up entering long today. Price action at the level of interest confirmed the long entry, and our stop loss was right below 445.28. And again, we were able to catch this up into that 446.25, a nice little 80-cent scalp. Nothing crazy compared to this move right here. But then as we can see a little later in the day, as price came down and retested this area, it got bought up at the 50. And then we had a very small candle right here on the 1-minute time frame right off of the level of interest. As a result, you could have gotten long with a stop loss below 444.15, 445.10. And as you can see from there, price just absolutely exploded. Now, say that you ended up missing that entry right here. It doesn't mean you can't get into the trade. In another video that we have in this bootcamp, we're going to talk about FVGs, which you can see we had one right there. But if we go to a 5-minute time frame and we start looking at this, we can see price came down, had a nice little bullish candlestick, came back down, retested the area, continued to push to the upside. dipped back down, and it actually set a higher low. So typically when we are trading at areas of interest, we want to try to get in as close to that level as possible, because we do know our stop loss is right on the opposite side of that level. Now, as price came back down, what do we see? We have this nice lower wick right here. Buyers entered the market, and we start setting this higher low, and then from there price continues. You can look at multiple different time frames to help confirm entries as well. Look at the 15-minute time frame. As price comes down, very heavy 15-minute volume. This 15-minute sell right here, not really that much volume compared to previous candlesticks right here. Price comes down, very nice 15-minute candle right here as well. Price pushes up, comes back down, sells off on decreasing volume, 2 15-minute candlesticks in a row, and then we get a bullish engulfing candlestick right here with heavy volume. So again, you always want to watch the price action at your areas of interest. If the price action does not confirm the level, you do not take the trade. If we look at this trade that I ended up taking yesterday on SPY, the entire reason why I like this trade was because what I did was I took the previous day's high down to the previous day's low. Price came up, it rejected the 50% retracement on QQQ, it actually hit it to a T. But as we see on the 15-minute time frame, price came up, and again, you could have went in short based off of this. I was watching the 61.8 personally, but you could have went in short based on this entry right here. Price tried to break above, very bearish candlestick, 5-minute candlestick closed below, could have went in short, stop loss right above this high. So as I was looking at this, I was like, okay, let's take this pivot high to pivot low, and let's watch the 50 and the 61.8% for a potential reject. So when I ended up entering this trade, I went back and journaled, probably shouldn't have gotten the first entry at the 50% retracement, really wasn't too much confirmation there, but that 61.8 did validate an entry. If you look at this 1-minute candlestick before, we had slightly elevated volume with that upper wick right there, showing that sell orders were getting hit, but it didn't necessarily hit that 50% reject. I really like the 61.8 in this example. We had this nice upper wick right here, and then price started to reject. We added to the position, and we were able to catch this down into a new low of day. Now, if we're looking at the 5-minute time frame, we can talk about the SPX trade that we ended up taking on, what was it, Friday. Well, it wasn't on SPX. We used SPX to trade SPY. So if we look at SPX, we have a level of interest, 4,500. Psychological areas on SPX and ES are very important, 4,500, 4,600, 4,700, etc. We can see that SPX came down to the 4,500 mark. Nice 5-minute candle, bullish candlestick right here. Look at this lower wick right off the area of interest. So now if we head on over to SPY at the on the 5-minute time frame, and we look at Friday, what do we see? Elevated volume at the level of interest, bullish candlestick. Piece that together. We have the price action, we have the area of interest, and we have the volume confirming the trade. What does that do? Sets up for a high probability trade, and we were able to catch this move to the upside. Something else I told everybody to watch on the watch list today was Apple for a reject at this 1 hour 21 EMA. So again, we have a level of interest. As we see, price push up, and it missed this level by like 2 cents pretty much, right? Came up, pretty much tapped it, and then dropped to the downside. Let's break it down and start looking at the price action. So as we see, price comes up, it tries to test it in the pre-market, gets very close, and then we have this hard sell-off right here. So price came up, pretty much hit the level, and then reacted off of that level. Now, the market wasn't open at this time, so obviously you wouldn't have been able to get an entry, but maybe a little later you could have caught an entry. So as we see, we have this bearish engulfing candlestick right here. Price tries to push up to the upside. What do we think this did? Probably made a retracement, 50, 61.8. Sure enough, right to the 61.8% retracement. Let's break it down to a smaller time frame on the 1 minute, and then look at that price action. Price comes up to the 61.8. Again, piecing everything together, multiple time frames. We also have a class on that later in this boot camp. But price came up to an important area, rejected off of it in the pre-market, had a bearish engulfing sell-off right as the market opened. We want to look for a pullback to then get short. As we see, price comes up, 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 and then we get this nice bearish candlestick right here with elevated selling volume. Again, price comes up, and we can look at this volume right here and this small upper wick and conclude that sell orders are being hit up at this area, or sell orders are being filled. So you could have gotten short with your stop loss right above this high. And as we see, price sold all the way down into 177.50. If you didn't like the 1 minute time frame, you could have looked at the 2 minute time frame. Same exact thing. Elevated volume, nice upper wick. We could conclude that a majority of that volume came in at this 61.8. Again, area of interest, confirming price action, confirming volume. That is what we want to see when entering a position. Now what we're going to do is we're going to look at some previous trades that I've taken in the past. I just pulled up, a few random ones to show you guys. But in this example, as you can see on QQQ, I took the pivot high down to the pivot low right there. We were watching the 50 and the 61.8% retracement. As price traded up to that 61.8, you can see that it hit it to a T, which then confirmed the entry to get short. And as you can see, price was able to sell down into 379 before rebounding on the day. Again, level of interest, confirming price action, confirming volume on a lower time frame. You could have gotten short with a stop loss right above this high right here. And as you can see, price continued to flush down. Looking at this example right here, I ended up taking the pivot low to pivot high. And what you're going to notice is a lot of my trades are fib based. That's just because Fibonacci is my all-time favorite trading strategy when it comes to intraday trading. But as you can see, I took this pivot low to pivot high right here. And as price traded down to the 61.8 and even the 50, I just didn't enter at the 50. I entered at the 61.8. But as we see, price came down, hit the 61.8% retracement. Look at that candlestick right there. Even if you wanted to add half at the 50% retracement and then the rest at the 61.8, they both confirmed an entry. Look at the price action at the level. Look at the price action at the level. Price had a very nice lower wick, pretty much a bullish hammer, whatever you want to call that candlestick right there. Very long lower wick off that level of interest. And then as you can see, price continue to push to the upside. I'm pretty sure with this trade, I just caught it into VWAP, but it did continue higher on that day. If we look at this example right here, taking pivot low to pivot high right here, you can see that I had a different 50% fib. I guess I didn't end up taking the trade down there. But as we can see, pivot low, pivot high right there, 50% retracement right at VWAP. And as we can see, price made a very nice move to the upside off of that level. Again, breaking it down to smaller time frames, you could have sniped an entry. Look at that, right at VWAP, right at the 50% retracement. Very nice bullish candlestick, elevated volume, 1 minute time frame, get long, stop loss right below that low. And as you see, price continue to push up into a high of 437.44. And at this setup right here, this was just a basic bull flag, which we might discuss throughout this boot camp. I don't know yet. But typically what we'll see with bull flags is we'll get 3 bars of consolidation back to an 8 EMA, which validates the entry, and then you get long with your stop right below the 8 EMA. So we were able to snipe this right off of the 8 EMA. Again, price action confirmed, pushed into a new high a day, and we were able to catch that move right there. If we move on to the next trade, the 429.61 level that I discussed, I think it was yesterday, I was able to take a trade based off of that. So as price comes up on the 5-minute time frame, we can see that we have a lot of volume on this 5-minute candlestick right here, but it's a smaller candlestick with a nice upper wick. What does that suggest to us? That sell orders are being hit because you have an area of price action. You look at the volume, you look at the wicks, and you can conclude that a majority of this volume probably came from up here, right? So as price came up to that 61.8% retracement, we got short with a stop loss. I forget where it was. I think it was like 429.8, 429.9, something like that. And we were able to catch a nice move to the downside. Unfortunately, didn't catch all of that, but that is okay. But either way, you can see the risk was very limited. Price action did confirm at the area of interest, and we were able to catch a nice move to the downside. If we look at this SPY example, you can see I took the pivot high, that high of the day, down to the low of the day right here. We had a really strong support zone right here. So it took the high to low and was using the 70.7 retracement. As price trades up into the area, we get a nice little doji with elevated volume right at the area of interest. What does that tell us? Sell orders are being hit. Get short with your stop loss right above this area. And as you can see, we were able to catch that down into the low of day. Now with this final trade that I'm going to be showing you guys, again, yet another fib trade, but I took the high of day down to the low of day, and as price pushed up to the level, I can't remember if we got short on this candle or like halfway through this candlestick, but either way, look at the volume at the area of interest, right? We have a smaller candlestick than this one right here, but very high volume on this. Little upper wick, what can we conclude? Sell orders were being hit at this area. Again, area of interest, volume, and price action confirms that more than likely sell orders are being hit right here. And actually I have an arrow pointing at this candlestick right here, so I'm pretty sure I got short on this candlestick right here. Definitely not all the way down here, probably like halfway through the candlestick, but either way, again, price action, level of interest, and then the volume confirming the trade. So that is what I want you guys to recognize. We have areas of interest, we watch price action, we watch volume. If it confirms the trade, then we enter the trade. So right now I'm in a swing trade on SLB. I will say, entered a little late on this, but I am looking for more upside on it. Reason I like it is price came down to my area of interest and we're having a very bullish reaction off of it. So as a result, we got long and I am looking for more upside. If this thing can crack this high right here, I think I said 58.7 was the level, or 57. Yeah, 58.7. If we can crack this, SLV has more upside. But that is the most important thing I want you guys to get from these last few videos that we have discussed. We can even go to Meta. We caught a very nice Meta reject last week. If we go to the 1 hour time frame, and I believe, let's go to a 5 minute, because I'll be able to tell you when we caught it. It was this trade right on over here. So I actually caught a really nice Meta reject right down into VWAP. So if we just go ahead and mark this so I can tell you guys why I like this level. So if we go to the 1 hour time frame, I told everybody I was watching Meta for a reject up at that 1 hour 21 EMA. And as price came up to the level, watching the smaller time frames, 1 minute and 2 minute, as I started to notice the rejection, that is when we ended up getting short. And we caught like a nice, I think it was like a $2 move to the downside off of that. Yeah, so if we look at this right here, we can see that Meta had a nice push to the upside. Look at this candlestick right here. 1 minute time frame, very bearish candlestick. We got short like halfway through this candlestick because the volume started to come in. Stop loss was above this high and we were able to catch it down into VWAP. So like 314 down to like 312.30. So not a $2 move, like $1.50, $1.70, but either way, it was still a very nice trade. There's VWAP right there. I could literally do this for days, guys. All you want to do is find a level of interest, watch the price action, watch the volume. Because price action by itself, it's pretty rare that I'll take a trade just based off of price action. Like if we got a bullish hammer down here with elevated volume, there's a good chance I don't really care about it. But if we get a bullish hammer with elevated volume at an area of support, then I care about it. But that is going to wrap up bootcamp day number 8, pretty much piecing together everything we've learned over these last 8 days. Going into these next few days, I do have new topics that I am going to be teaching, and I am very excited to teach them to you guys. So again, if you guys did find value in this video, make sure to smash that like button. If you haven't already, make sure you are subscribed to the channel with that bell notification on so you are notified when a brand new bootcamp video goes up. And if you haven't already, make sure to do your daily check-in. Let me know you guys are still rocking with me down in the comments. Other than that, everybody have an amazing rest of your day, and I will see you guys tomorrow in bootcamp day number 9. Alrighty, so let's do this for the 3rd time. Now, when trading, there's 3 different trends that price can be in. Either an uptrend, a downtrend, or consolidation. So an uptrend is going to be when price is setting higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, so on and so forth. A downtrend is when price is setting lower lows, lower highs, lower lows, lower highs, lower lows, so on and so forth. Consolidation is when price is setting equal highs, equal lows, equal highs, equal lows, and so on and so forth. Now, when price is in an uptrend, remember we talked about how to use demand, support, or even Fibonacci to identify where this higher low could be to then catch the next leg up. We can also use supply, resistance, and Fibonacci to identify where these high points are going to be to then catch the next leg down into that higher low and potentially even lower. So we can use everything that has previously been discussed to identify where this point can be and this point, and we can identify trades on both sides. We're setting lower low, lower high, lower low, lower high. We can use Fibonacci, resistance, supply to identify where this point can be. We can also use demand, Fibonacci, and support to identify where this area could be. So we can identify bounces at these lower lows, but we can also identify rejects at these lower highs. Now, in order for trend to change, it needs to do 2 things. The very first thing most commonly that we are going to see is, first off, price will come down and it will set a higher low, but then what it will do is set a lower high. That is your first, price might end up changing trends, but this isn't enough confirmation to get short right then and there. What needs to happen is price needs to set a lower low for the trend to then be confirmed that it's going to be changing. So again, we have a higher low here, a lower high kind of hinting, okay, maybe trend's about to change. And then we get a lower low and price starts moving down. And then that's more than likely when we'll see our downtrend. Now, in order for a downtrend to change trends, is first, we're more than likely going to come up and set a lower high. But then after that, price will come down and set a higher low, pretty much hinting, hey, price might end up changing trend here. And then from there, to confirm the trend shift, we want to see a higher high. When we get the higher low and then the higher high above the previous lower high, that is what confirms the trend, and that is when we will more than likely start seeing an uptrend. So that is how trend changes are going to happen. In an uptrend, we need a lower low and a lower high to confirm that it's going to downtrend. In a downtrend, we need to have a higher high and a higher low to confirm trend shift. Now, in consolidation, this is typically where you want to avoid taking trades, but if consolidation happens at the top of an uptrend, it increases the likelihood that price is going to break to the upside. We want to wait for the actual break, but if price were uptrending and then it just went into consolidation, the odds favor that price will continue to break out to the upside. But in a downtrend, if this were to happen at the bottom of a downtrend, the odds then favor a downside move. Again, we want to wait for the actual break and confirmation. So if this is at the top of an uptrend, we want a breakout in confirmation. If this is at the bottom of a downtrend, we want a breakdown and confirmation. So that's uptrends and downtrends, how you can identify trend shifts as well as consolidation. So let's just go ahead and let's start looking at a monthly chart on SPY, because these trends can happen on multiple different time frames. So if we're looking at a monthly time frame on SPY, it's clearly in an uptrend. All price did was come down and set a higher low right here, which again, we talked in the Fibonacci class. If we take this low over here in 2020, all the way up to the all-time high, what did price hit? 50% retracement. The odds favor that more than likely price is going to come back up to this high and potentially set a new high in the coming years. Of course, I could be completely wrong, but typically when we see these higher lows, it's going to lead to a higher high, right? So just looking at the monthly time frame, we have a higher low and potentially a new higher high coming. If we go to a weekly time frame, looking back here, what do we see on the weekly time frame over here? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, higher low, higher high. But then what do we notice? Price comes down and actually set a lower low first and then came up and set a lower high, which confirms, okay, price is more than likely going to downtrend. If you wanted to wait for the lower low, you ended up getting that right here. Price went on, lower low, lower high, lower low. Now, one thing I want to point out to you guys is during trends, you're going to have minor trends and you're going to have major trends. So again, lower low, lower high, lower low, lower high, lower low. But then if you were looking at the minor trend, you would see this as a higher high. But if we're looking at the major trend, here's our lower low, here's our lower high, here's our lower low, here's our lower high, and then here's another lower low. So again, in trends, we have minor trends and we have major trends. Now, as we see on over here, price comes up and it sets a lower high. But then from there, what happens? It sets a higher low, breaks above, higher high, pulls back, higher low, and now currently we're in higher high. Price is eventually going to pull back. Maybe it sets a higher low at the weekly 21 EMA. We'll have to wait and see. But as of now on the weekly time frame, price is in an uptrend. If we break it down to the daily time frame, price is still currently in an uptrend. As we see, we break above, higher high, higher low, higher high, higher low, higher low, equal highs right there. So pull back, higher low, and then higher high. And it could potentially be setting a higher low right now because price did just come down today and hit the 50 and 61.8% retracement that we've been talking about previously. So on the daily, we're in an uptrend, but I want you guys to notice something. When we break it down to a 4-hour time frame, what do we actually have now? Price is in a downtrend. So as we see, we get these lower highs right here. Price breaks down and sets a new lower low. Pulls back up, lower high, lower low, lower high, lower low, lower high, lower low. So we can get multiple different trends on multiple different time frames. If we go to a 1-hour time frame, what do we see? Same exact thing. Lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now if price comes up and starts breaking above these previous lower highs, more than likely it will come down, set a higher low, and then we'll start uptrending. Now, when you start combining all of these things together and understanding the overall trend, that is what can set up for high probability setups. But don't become so focused that you only trade what the higher time frame trend is, because you can also use smaller time frames such as the 5-minute or 15-minute to identify intraday setups as well. So because my bounce level today was down at this 445.3 on SPY, there wasn't much bounces that we could trade off of until we got down there. Well, if we look at the 5-minute time frame, we had a big old dump to the downside, consolidation. Then as price broke below the consolidation, you could have went short and been able to take this thing potentially all the way down into the low. Had a nice little bear flag right there, pull back up, lower high, and then as we see, lower low. If we head on over to Amazon today on the 15-minute, or actually you can see it on the 5-minute as well, I did take a nice short position on this earlier as well. We have this massive drop to the upside, pullback setting a lower high, get short, and then catch that lower low. But this video is going to be a little short. Again, I've already gone through it and edited it twice, so previously it was longer, but I do have something I have to do at 2 o'clock, which is literally in 1 minute. But I wanted to get this video uploaded for you guys, just breaking it down, uptrend, downtrend, consolidation, how to identify trend shifts, and how you can use these for high probability setups. Again, I'm very sorry, but I will make it up in a future video for you guys. As always, if you guys did find a lot of value in this, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me, especially because this was the 3rd time. Tomorrow, definitely make sure you guys are here at 7 p.m. Eastern time because I am going to have a fire boot camp video for you guys. Have an amazing rest of your day, and I will see you guys then. Wait, so how do I come up with my daily trading plan? I do go live here on this YouTube channel every single morning at 8 a.m. Eastern time and come up with this plan completely free for you guys and give you guys my exact game plan for the day. I want to talk about how I go about coming up with my daily trading plan. So the very first thing that I do is, first off, I only have a 21 EMA in the TTM squeeze when I am doing my analysis. The very first thing that I want to do is I want to start with analysis on SPY and QQQ. Reason being, these are the two most important ETFs or names that we need to have on watch. If tech is going to be weak, then we're going to see it in QQQ. So stocks like Apple, Microsoft, Meta, Google, so on and so forth, we can typically get a gauge on which way they are going to go based off of what is happening with QQQ. Now, we do have relative strength and relative weakness when it comes to individuals, but I always want to start by looking at SPY and QQQ. Now, what I'm doing is I'm going through multiple different time frames, which we will have a class on multiple time frame analysis, but I'm looking at the daily time frame, the 4-hour time frame, and the 1-hour time frame. The main thing I am looking for when I'm doing my analysis is, again, just our levels of interest, support and resistance, Fibonacci, or supply and demand. Supply and demand is going to be more so on the futures. When I'm looking at QQQ and SPY, I'm going to be using a lot of support and resistance and Fibonacci retracement. So as you guys saw, QQQ bounced off the 50% retracement from this pivot low over here to this pivot high right here. 2 days in a row, we have bounced off of that 50% retracement. Told everybody yesterday and earlier in the week that I was watching this 367.59 level for a potential bounce. Now, if QQQ were to lose this level, because a lot of tech stocks are going to move with QQQ, we could assume that tech is going to continue to be weak until QQQ gets down towards this 61.8% retracement, which is also going to be an important level. So if QQQ were to trade down here, this would be a bounce area that would be on watch. So again, I'm going through, I'm doing all of my analysis on SPY and QQQ, finding areas of resistance, areas of support. So this was a previous support turn resistance point at this 375 to 375.19 level. So once I'm done with QQQ, same thing, I head on over to SPY, do all of my analysis there. And then once I am done with SPY and QQQ, as you can see, we have a really strong resistance point right here at this 444.12. So if SPY were to get down towards this area, that would be my bounce area for the day. Now, what I do from there is I type it up. Where am I watching bounces? Where am I watching rejects? That way, I already have it planned on what I am going to be looking for the day. So you can see today, SPY bounce at 445 to 445.3, rejects 452.25 and 454. Also mark 44.70 on ES, which we actually fell just 3 points short on ES from that level. So you can see the low today on ES was down at this 44.73, so really close to the bounce level. So I'll type it like this, and I'll type out where exactly I'm looking for entries, either for bounces or for rejects. Now, once I'm done going through SPY and QQQ, the next thing I do is my analysis on ES. The reason we want to do analysis on ES and NQ, because SPY and QQQ only trade from 9:30 to 4. So the chart setup can be slightly different. Most of the time, the levels are going to be the same, but there's also plenty of times where they're different. So I also want to do analysis on ES as well as NQ. Reason being, ES actually never hit that 61.8, but SPY actually hit that 61.8. So you can see how there's a little bit of a difference there. So that's why I want to do analysis on both. But then also at the same time on the futures, that's where I do my supply and demand. So if we go to the, I believe, 1 hour time frame, yeah, there's still a supply zone that I'm watching on ES way up here. Now, if you want to do your supply and demand on SPY and QQQ, you can. I just prefer not to. I prefer to do it on the futures. But do yourself a favor. If you do trade SPY and QQQ, definitely do your analysis as well on ES and NQ, because sometimes there's going to be a specific setup on ES and NQ that you're not going to see on SPY and QQQ, and it could cause you to miss out on the trade. There's been plenty of times where I took a trade based off the technicals on ES and NQ, but I just traded SPY and QQQ options. So again, do yourself a favor, do your analysis on both of them. Once I am done with my SPY and QQQ, ES, and NQ, I then have a basket of stocks that I flip through every single day. You want to keep this basket very basic with just highly liquid stocks. Now, stocks are going to come and go off of this list, but typically you want to stick to the most basic names. Again, SPY, QQQ, Apple, Amazon, AMD, Google, Meta, Microsoft, Tesla, and you can add a few different ones in there. So if you want to look at my current watch list, I definitely got to narrow this one down because I don't trade UPST anymore. AI is kind of dead. Roku don't really trade that anymore. Snow don't really trade. Shopify don't really trade. So if you want to pick and choose some of these off the list, you can feel free to do so. But this is just what I have on the list right now and is what I flip through. So now from there, what I do is I go to a 1 hour time frame, and when I'm flipping through these stocks, I will flip through multiple different time frames just to see if there's any different time frame setups. So what we're going to do is we're going to click on Apple. I'll look at Apple, and I know that Apple is actually bouncing off the 100-day SMA, which it hasn't tested in a really long time. So if I just go ahead and type in simple moving average, add this, and then we'll just make it a 100-day SMA. We'll keep it that light blue. We can see the last time Apple tested this level was way over here. February 1st was the last time that it touched it. What has it bounced off of these last 3 days? Pretty much that 100-day SMA. It bounced right off of it yesterday. So I could conclude, okay, I am not bearish on Apple and ideally shouldn't be looking for puts on Apple until it breaks below that 177 or wherever that 100-day SMA ends up being. So I could look at that and be like, okay, maybe Apple is something that I can keep on watch. Let's put it on the watch list for the time being. Then I'll flip on over, again, go to the 1 hour time frame, but I'll look through multiple time frames, 1 hour, 4 hour daily. We can go on over to Airbnb. I could look at Airbnb and be like, you know, this thing looks like crap. All I'll do is I'll skip right over it. Let's look at AMD. Okay, AMD had a bear flag this morning, and this actually went on the watch list as something to watch if the market got weak early in the morning. As we can see, AMD just pushed to the upside, therefore there was no reason to get short. So I didn't end up taking this trade. But being able to recognize the weakness and say, okay, if the market were to get weak, this is something I could rotate to. So if we pull on over the watch list today, you can see right here, AMD, if the market is weak, I'm interested in puts below the 1 hour bear flag. And I would be interested in a bounce down at 107.2. Why would I be interested in a bounce down there? If we go to the daily time frame, look at 107.2. It's been very strong support. So again, using multiple time frame analysis, I can start looking at this and I can start coming up with a game plan for the day. So I liked AMD today. I also liked Amazon. Amazon was on the list, and this is actually a trade that I did end up taking today. Contracts didn't move too amazing. Honestly, I thought they would move better, but I was able to get an early entry before price broke out of this flag and was able to catch a nice move to the upside. Ideally would have liked to see more out of it. It pulled back and it hit my stop loss in profit. So reason I liked it, this 1 hour flag right here. Look at this trend line. Unfortunately, wasn't able to hold, but had it held and had the market continued to have strength, Amazon would have definitely been the one to go. So I like that. That's why I was on the watch list today, and that's why I traded it. So that's pretty much what I'm doing when I'm going through this watch list is I'm just flipping through stocks. I'm looking for individual setups like you can see on Caterpillar. I told everybody I was really interested in a bounce at 274.18. Unfortunately, it just bounced a little short at 274.75. That's okay. If it doesn't hit my level, I won't take the trade. But what I'm looking for is clear trend. Are there any clear fibs that I can start using? Is there chart patterns? Is there previous support or resistance, etc.? So something I'm watching on Coin right now is this weekly flag that is developing. We're going to have to see how Coin closes tomorrow, but this might actually be a trade that comes into play next week and could potentially be a swing trade as well. So Coin could be something on watch. If we head on over, Costco don't really care about. Google is just in consolidation, so don't really care about that. IWM, I told everybody today to watch this bounce at 189.75. It looks like it got very, very close to that level. The way that I found it was on a 4 hour time frame. As we can see, low is low, high is high. price comes back, pretty much hits that 50% retracement. So if I was here, I knew that I would be watching 189.75, and as price comes down to the level, all we're going to do is watch smaller time frames and try to identify an entry. So IWM could have went on the list today. Meta, don't really care about, didn't see anything I like there. Microsoft, still watching that flag there. Again, that's something that could come into play. Netflix, don't really trade. Nvidia, don't really care about. We looked at QQQ. Shopify, don't really care about. I guess Tesla, nothing's really going on Tesla. So once you flip through that entire list that we just talked about, actually Tesla, this could come into play if it broke below 240.85. So if Tesla broke below 240.85, I could be looking for a gap fill down into 235.23. So that might come into play tomorrow based off of the PPI. If it starts breaking below there, Tesla's more than likely going to go on the list tomorrow, and I'm going to be looking for puts. So by the time you flip through that entire watch list, you're probably going to find 3, 4, 5 setups that you like. And then from there, what I like to do is narrow it down to my top 3 to 4 stocks. So actually 2 of them being SPY and QQQ. These are always on my watch list, but then I'll narrow it down to my top 2 stocks for the day. That way I'm only watching 4 things: SPY, QQQ, and the futures. So I guess a couple more. And then AMD and Amazon were on my watch list today. So that is how I come up with my daily game plan. I get all of my levels. I mark out exactly where I'm looking for bounces or rejects and exactly what I am looking for the day. Now, what you want to do is stick to that plan. As soon as you start breaking your plan and making unplanned trades, you're going to start feeling uncomfortable in the trade, and you're more than likely going to end up losing money. But that is going to wrap up bootcamp day number 10, how to come up with your daily trading plan. If you guys did find value in this video, as always, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and make sure you guys tune in tomorrow night, 7 p.m. Eastern time, for another bootcamp video. As always, I greatly appreciate everybody. Everybody have an amazing rest of your evening, and I will talk to you guys tomorrow. Yeah, let's just hop into some of the trades that I ended up taking this week. We can actually start with the trades from today, and I'm not going to go over every single trade that I took this week, but I want to go over my favorites. So the very first one was actually today on SPY. Now, the way that I found this level was, as we can see, if we zoom out to a higher time frame, I really like to use SPX for gap fills. So as we can see with SPX over here, there is this nice little gap fill from this low all the way down to this low. If we just mark this point right here, that 44.63, all the way down to this low point right here at 44.43, we can see that we have a nice little gap on SPX. Now, typically when gaps are filled, the opposing line, support or resistance, is going to act as a bounce or a reject. So because this was a gap to the downside, if SPX broke below, we should be looking for a bounce at this 44.43.64. So that was my gap fill on SPX. And as we can see, we have that little Fortnite llama formation right here before the continuation up. Anyways, so I told everybody that I was going to be watching this 44.43.64 for a potential bounce on SPX. Now, we can use SPX to trade SPY. Also, at the same time, SPY had a really important level around, it was like 443. So as price started dipping down towards that 443, which you can see was a gap fill on SPY as well, I saw SPX had already filled the gap. So as a result, I tried some longs on SPY and was willing to add all the way down into SPY's gap fill all the way down at 443. And we pretty much smacked the exact bottom on this trade, and SPY went straight up from there. So it was a very simple trade, just SPX filling the gap, SPY getting really close to filling the gap. The risk to reward was definitely there, so that was the whole reason behind why I took that trade. So that was just one of the trades that I ended up taking today. Now, I want to go over a trade that I took on Monday, which was also on SPY. This was using the Fibonacci retracement. So if we zoom out and we go on over to Monday, on Monday, what I was seeing was price actually came up. So I had this rejection zone up here. If we take the previous day's high on the Fibonacci retracements down to the low, I actually had this rejection zone up at 449.6. So with this trade, I saw that SPY came up and it hit that 449.6 and then started to move to the downside. Now, I wasn't able to catch it up here. Unfortunately, I was actually watching it a little higher towards that 450 to 450.4, but price ended up rejecting that 50% retracement. So I started looking at this and I was like, okay, price just rejected off of a level, a key level, and we saw a pretty hard pullback. Let me look for a potential lower high to then get short. So as price came up to that 61.8% retracement, as always, I break it down to a smaller time frame, 1 minute or 2 minute, and I watch it very closely. So if we head on over to Monday and we look at the price action right at that area, what do we see? Price comes up, hits the 61.8% retracement on the 1 minute time frame. Look at that elevated volume with that upper wick right there. So as a result, I ended up getting short, and we were able to catch this thing down into the new low of day. And then Bookmap from there pretty much told us to exit because there was a lot of orders sitting there on ES. So that was another trade that I ended up taking this week. 2 trades that I ended up taking this week were actually at the same exact spot. Now with these trades, same thing, it was a Fibonacci retracement. If we zoom out to the 4-hour time frame, and I talked about this level a lot going into it. So if we take this low right here to the high point right there, and then this low to this high right here, we had a Fibonacci cluster plus 445 support at this area right here. So 445.3 was my key area. So as we can see on Tuesday, that was the first time I traded it. Wednesday was the second time I traded it. So if we go to a 5-minute time frame. Now, as price was coming down towards this level, this was when I personally ended up taking the trade. Could have had a much larger win off of this. And honestly, going back and journaling through it, there was no reason why I should have sold this. I should have just kept the remainder of my stop loss right below this 61.8% retracement right here. But hey, we live and we learn, right? So we have a nice little move to the downside on SPY, and we have this doji right here with elevated volume on the 5-minute. As always, I am using smaller time frames to snipe my entries, but as price started coming down towards the retracement, that is when I ended up getting long with my original stop loss below this low. Obviously, as we popped to the upside and we got close to that 8 EMA, I was taking profits off, and then eventually was stopped out on the remainder of my position because I moved my stop loss up. Again, what I should have done was just kept my stop loss right below these fibs right here, and I should have let it run because came down and hit that 445.27 to a penny, and then just ripped to the upside for the rest of the day all the way up to 449. So that was the first time I took this level. The next time, I actually made the same mistake. Now the next day, I took the same exact trade and made the same exact mistake. I actually sat here a lot longer this day and waited for price to come down into my area. But as we see, we got the same exact reaction as the day before. Price came down, it hit the fib, elevated volume, and then this 5-minute candlestick right here, we entered slightly before. So if we were to break it down to a 1-minute time frame, like 2 minutes before this, but price dipped down to 445, immediately got bought back up, reclaimed the level with very heavy volume. So again, same thing, took profits on the way up, and eventually was stopped out on the remainder of my position as I moved the stop loss up. I'm not gonna lie and say that I caught this entire move. I really wish I did, but I did make the same mistake 2 days in a row. So what I should have done was, because I already took a decent amount of profits off the table, was just left my stop loss right below this low and then let the remainder of the position still run. That way I could have taken advantage of this move right here. So yes, I definitely fumbled the bag on those 2 trades this week. Could have been just massive days back to back, but the market will offer new opportunity next week. Now going into yesterday, I actually took a pretty decent loss off of this trade over here. So what I was seeing with SPY was that price had this pretty big move to the upside. We're just gonna go ahead and delete all that. SPY had this pretty big move to the upside, and what I was looking for was a pullback for a higher low. Now, at the same time, I took this pivot low to pivot high right here. You can see that we had this bounce at 449.84. We had the VWAP sitting at 450.2. Also, psychological support at 450. Remember, those intervals of 5 are very important. And also, there was this fair value gap. So we had a lot of confluence in this area right here for me to enter long. Now, as price came down towards VWAP, I noticed that we had a pretty strong reaction. A lot of buyers came into the market. That's where I entered my first position as we started holding VWAP. And then I entered my second position as price dipped below the 50% retracement and reclaimed 450. Now, with this trade, I just oversized a little bit, so a little larger of a loss than what I would have liked. But as price started breaking down below my invalidation point, that is where I got out of the trade. Again, identifying where's your invalidation point. If we break it, we get out of the trade. I didn't even lose 20% on this trade. I think it was around like 15% that I ended up losing on this position right here. So literally a paper cut as far as percentages. I just went a little heavier size because I liked all the confluence, but hey, it is okay. So when I went back and I journaled and I started looking through, okay, why do I think that this was a losing trade? The reason I think this ended up being a losing trade was because we could see that SPY had this move to the upside, and then we tried to bull flag right here on the 5-minute time frame, right? We could see buyers held it here, buyers held it here. We came up and we tried to break, but that bull flag broke down. So because bull flags are a continuation pattern, price breaking below that bull flag should give us a warning. So that was warning number 1. Warning number 2, these are the 2 reasons why I think this trade went against me. But warning number 2 was the fact that the 15-minute time frame, we had this nice move to the upside, and then Gravestone Doji with pretty much equal volume right here. Then we had a little less volume right here, and then as this 15-minute candle closed, we had elevated selling volume. So those are the 2 reasons why I believe that trade went against me. But either way, I really like the confluence there. I saw the risk to reward, so it was worth taking it in my opinion. And then the final trade that we're going to go over is going to be on, it was SLB, the swing trade that we ended up taking. So we actually ended up talking about this trade on Tuesday and the whole reason why I liked it. When I swing trade, I only liked swinging squeeze setups. So because we had this nice squeeze on the TTM squeeze, as always, I want to look for an entry as close to the daily 21 EMA as possible. Unfortunately, got a little later of an entry because I hit it earlier in the day and I wasn't paying attention. But as I came back in the afternoon and noticed that we hit that 21 EMA and had a strong reaction off of it, that's why I ended up entering long, and we were actually able to catch a nice like 52-53% gain overnight on this swing. But yeah, that's gonna wrap up today. Just a quick little check-in, see how everybody's doing, as well as going over some of the trades that I took this week. As always, if you guys do have questions about anything we've gone over in this boot camp previously, make sure to leave them down in the comments. But if you haven't already, make sure you are subscribed to this channel with that bell notification on. I do go live here on this YouTube channel every single morning at 8 a.m. Eastern time, so make sure you guys tune in, keep me company there, give you guys a completely free watch list for the day, and you get to watch me draw my levels. But yeah, everybody have an amazing Friday evening. Make sure you guys tune in tomorrow night because I am going to have a very special video up for you guys for that boot camp, and on Sunday I actually have a really fire video as well. So make sure you guys tune in 7 p.m. Eastern time, and I'll see you guys then. Hopping into how I go about my SPY and QQQ technical analysis. So before I even start on the analysis, what I like to do is look at the economic calendar. So if you head on over to Google and just type in economic calendar, you want to find marketwatch.com. This is going to show you all the important economic news that we need to pay attention to next week. Some news is going to be more important than other news, like the US leading economic indicators on Thursday at 10 o'clock. If you're in an open position, definitely want to pay attention to that. FOMC at 2 p.m. Very, very important. So this is the very first thing I do. I hop on here and I look and see, is there any news that I need to be aware of heading into next week? So once I go through there, then I start on the charts with SPY and QQQ. Now what I have on this screen is just a 21 EMA and the TTM squeeze. I like to keep it very simple when I'm doing my analysis. So we can start by looking at, let's start with QQQ. So I'll start on QQQ, and then I personally start on the higher time frames like the monthly or the weekly. So if we're looking at the monthly time frame on QQQ, we can see that we are potentially forming a monthly cup and handle. That definitely is a possibility. But as far as levels, not really seeing any that I'm too interested in on the monthly time frame. Sometimes you will find levels on the monthly, sometimes you won't. But then we can start looking at the weekly. Now, when I was doing my analysis a couple weeks ago, or actually a few weeks ago, I did bring up that this weekly inverse hammer right here had the most selling volume on the weekly since way over here when price was down at that weekly 21 EMA. So that definitely sparked my interest at a possible pullback in the market. And as you see what has happened these last 2 weeks, we have started to pull to the downside. So again, looking at the weekly time frame, looking at the overall price action and the volume, we could conclude that, okay, we might actually start getting a pullback. So as far as any weekly levels I'm interested in right now, honestly, not too much. The only thing that I'm actually really interested on the weekly time frame is actually a possible retest of this weekly 21 EMA. You can see we haven't tested this in a really long time since March. So it's been about 5 months since we have tested that level. So looking at the weekly time frame and the importance of that weekly 21 EMA, well, because we haven't tested it in a while, ideally would like to see a pullback down into that area. So currently that's around 350. That would take us around $16 to the downside. So it's definitely possible that we could pull back down to that area. Again, that's why it's important that we're doing multiple time frame analysis. But as far as just weekly levels in general, not necessarily seeing anything that I'm super interested in besides that one area. And then after that, I go down to the daily. On the daily time frame, we start looking for any other levels as well. Again, I really like to use Fibonacci retracements. We did have a previous resistance area right here on QQQ, and you can see that price was able to break above it. So because price was able to break above it, that then should act as a support area. And as you can see, price tried to hold it as support, but then eventually broke below it. So since price broke below it already, that's no longer an area that I'm interested in. Now, for me, what I would start doing is start taking Fibonacci retracements. We have this pivot low to pivot high. So we have 351.88, which is close to that weekly 21 EMA, which could be a key area. We also had this pivot low to pivot high right here, which you can see price got very close to on Friday at 363.38. So if price were to break below there, I would start watching these areas down here. Also, if price is trading near any interval of 5, I like to mark that as well. So 365, 360, 370, 375, etc., because those tend to be psychological areas of support and resistance. Now, as far as previous resistance turns support, you can see we had this resistance point right here at 357.75. Price broke above it, made a support right here, and it continued to push. So I would actually be very interested in a bounce down towards that 358.77 all the way down to 357.5. Now, depending if this were to be the bottom, we could start taking some Fibonacci retracements and look for any rejects next week. So we could take that pivot high to pivot low. We could take this pivot high to pivot low. It just really depends. Is that the bottom? If that isn't the bottom and the market continues to pull, then we're going to start looking for bounces down at our bounce area. Once I'm done going through all that, that's where I stop when I'm doing my weekly SPY and QQQ technical analysis. I stop on the daily. So now that QQQ is done, I also like to head on over to NQ to see if there's any confluence. So you can see on NQ that I do have a bounce area way down here. I pretty much have it marked out. NQ is getting very close to a psychological support of 15,000. So again, psychological areas, 15,000, 14,000, 13,000, etc. I will mark on NQ. We've talked about this previously, how the futures trade 23 hours a day from 6 p.m. all the way to 5 p.m. SPY and QQQ only trade 9:30 to 4. And because of that, the price action can be slightly different on the futures than SPY and QQQ. Sometimes the futures will validate a setup. Sometimes SPY and QQQ will validate a setup. That's why I like to do cross analysis between the two, because if you're only doing analysis on one, you could miss the entire setup. So because we had that 15,000 plus that 61.8% retracement, I would be watching that very closely for a possible area to bounce price next week. If price breaks below there, I have nothing until 14,694.75, which was that previous resistance turn support. And remember, QQQ actually hit the support area while NQ has not tested it yet. So I would be watching that very closely. And you can see I already have a supply zone marked out up here. And this Fibonacci retracement can get deleted because that's not valid. But again, if this were to be the bottom, pivot high, pivot low, look for rejects at the fib. So once I'm done with QQQ and NQ, I will then head on over to SPY. Again, we want to go through multiple different time frames. So looking at SPY, if it were to continue to the upside, this is the one area that we want to pay attention to, 462.07. That was that previous lower high, which should act as resistance. And ES actually hit the level, and you guys are going to see that here soon. But that was the only area I was interested in to the upside as far as resistance. Now, again, on the weekly time frame, an area I would like to see is going to be that 430.93, that weekly 21 EMA. Haven't tested it since April, so it's been about 4 months since we tested that level. Now, as far as the weekly time frame, we can see that there is a weekly Fibonacci retracement that we could use. That would take us all the way down towards 420, and we're all the way up at 445. So maybe in the future, as price starts to pull, we can start watching that area. But once I'm done on the weekly, I'll then go to the daily time frame. You can see that this was a huge resistance area on SPY right there. So that 443.9 all the way up to 444 was the key area. Now, price is trading in a daily gap. It hasn't filled it yet. It got about like 30 cents short. So I would watch 443 as well for a potential bounce next week once price fills the gap. Now, at the same time, we have pivot low, pivot high that we could use right there. And then the next pivot low, pivot high we have is all the way over here. So if I'm going to be looking for any bounce on SPY after that 443, it's going to be down at 442 because that is where that 61.8% retracement is. Now, if SPY were to break below 442, we really don't have any support as far as fibs until 434.66 and then 428.8. So those would be my bounce areas if the market were to continue to pull. Now, as far as rejects next week, depending on if this is the bottom, maybe we come down and we bounce right here, we start taking pivot high, pivot low, and start looking for a reject on the way up. Now, once I'm done with SPY, I then take a look at ES, and because sometimes ES is going to have a level that you can't see on SPY. So if we're looking at the weekly time frame on ES, we can see that that hit that previous lower high at 46.31 and it started pulling back. I'd be interested in a weekly bounce at that weekly 21 EMA, but also at the same time, price is inside a weekly demand on ES. So that would be an area I would be interested in. We're just going to have to wait and see how the market reacts next week. Remember, when I do supply and demand, it is only on the future. So we do have weekly demand right there. Once I'm done looking at the weekly, and then we have this previous resistance zone right here. If price really started to pull back, 4208.5 would be interested in that. And then go down to the daily, same thing. I'm going to be looking for Fibonacci retracements, pivot low, pivot high. You see price actually ended up breaking below that 61.8 on Friday, but it did reclaim it by the end of the day. So that area is still important to me. We do have nice confluence between weekly demand as well as that 61.8. If price breaks below this low right here at like 44.60, I would be looking for more downside, or 44.59. I would be looking for more downside on the ES futures. Now, after that, I mean, we have pivot low, pivot high there. So that would be a pretty hard pullback. And that's pretty much how I prepare for the coming week when it comes to SPY and QQQ, ES, and NQ. These are going to be my weekly levels. Those are the ones that I mainly want to pay attention to. And then as the week progresses, obviously, we're going to get different setups, but these are the higher time frames. These are the ones that we want to mainly pay attention to. So as always, if you guys did enjoy this bootcamp video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Get notified every single time I upload a brand new video. And if you haven't already, make sure you do your daily check-in down in the comments. And make sure you guys tune in tomorrow night at 7 p.m. Eastern time for the next bootcamp video. Everybody have an amazing rest of your Saturday evening, and I will see you guys in the next video. Alrighty, so yesterday I ended up uploading how I go about my SPY and QQQ weekly analysis. So as soon as you guys are done with this video, definitely go and watch that when you're done. That link's going to be down in the description. But as far as coming up with a weekly watch list, the very first thing I do is I like to look for day trade setups first, and then we'll head on over to swing trades and how I find those. So I believe last week I talked about how to come up with a day trading watch list. So make sure you guys are watching that video as well, because I go over the stocks that I look at every single day. So on Sunday, what I like to do is I like to flip through that same list, but instead I am looking at the higher time frames, the daily time frame and the weekly time frame, to identify weekly setups. So we're going to start off with Apple. I know that Apple is bouncing off of that 100-day simple moving average. So we just throw that on real quick, and let's put on the 100-day SMA. Apple hasn't tested this area in a really long time. As you can see, last time was way over here. So if I'm going to be watching Apple this week, first off, there's no good bounces if price breaks below that 100-day SMA. There's no good bounces until way down here at 161.2. And depending on where that 200-day SMA is at, let's see. Yeah, that's all the way down there as well. Plus, there's a nice daily gap fill right here on Apple. So I could conclude, okay, if Apple breaks below that 100-day SMA, it has no support until 170.76. And then if it breaks below there, it has a nice daily gap that it could fill to the downside. Also, what I could conclude is that Apple is holding this area as support for 4 days in a row or 5 days in a row. Let's see if price can bounce off of this area and make its way back up to the daily 21 EMA. So that is the setup that I would be interested in next week. So Apple, boom, that's something I'm going to watch. Let's see, Airbnb, really not interested in. AMD, I'm interested in this. Why? Because price has been bouncing off of this 107.2 for a very long time, actually. Held above it on the daily, and it pretty much hit that 100-day SMA. We have this strong area of support. Price just bounced off of that 100-day SMA. Let's look for a potential bounce for more upside on AMD. If AMD fails to hold that 100-day SMA, I will look for more downside. Where is a possible bounce area that we could use? Pivot low, pivot high. As you can see, we're holding the 50%, the bounce, plus that previous support and SMA. So if price broke below there, there's no support until 100.8 and then 100. Boom. That's something that we could watch next week. Let's look at Amazon. Amazon, I'm very interested in the upside on this. If the market were to gain some strength, very interested in the upside. Reason being, you could see the bull flag on the daily. You can see it better on the 4 hour. But if the market gets some strength, I would be very interested. Where's this color button? There it is. I would be very interested in the break above the trend line and then a continuation to the upside. So Amazon right now, that's at the top of my list. So what we're going to do, we're going to put this on a little scratch pad, and we like Apple, we like AMD, we like Amazon. So those are 3 day trading stocks that I can look into next week. Boeing, honestly, don't really care about. Let's see, Caterpillar. Coin, I believe, had a weekly flag, but it's not holding. Yeah, so Coin, really not interested in this. Let's go back to the daily time frame. Let's go to Google. Google has a nice daily gap. So we could conclude, okay, if the market is weak next week, we have a nice daily gap that we can watch to the downside from 127.4 all the way down to 123.14. So we can put Google on the watch list. So let's just go ahead and put Google. And then IWM. So if we head on over to IWM, that actually hit the daily 50% retracement right there. I'm pretty sure it hit it to a penny yesterday and pushed it upside. Yeah, literally straight to the penny, 189.74, and then it rallied all the way to a high of 191.7. We went over that in the morning live streams. If you guys didn't know, I'm live every single morning, 8 a.m. Eastern time here on this YouTube channel. So we could say, okay, if IWM were to bounce right here, we can look for more upside. If it breaks below and the market's weak, I can watch 187.6 as a potential area to then get another bounce on IWM. So I like that setup as well. Let's go ahead and put IWM on the list. Take a look at Meta. Meta pretty much already filled the gap. Honestly, not really seen anything I'm too interested in, so we'll skip over that. Microsoft's about to test its 100-day SMA, which it hasn't tested since March 13th. So it's been about 5 months as of tomorrow. So we could say, okay, let's watch Microsoft for a bounce at this 100-day SMA. That can go on the list too. So we already have, what, 6 stocks that we can watch next week that actually have really good setups. So there's Microsoft. The video looks like it's about to fall off a cliff. Let's see, Shopify has a daily gap as well. You could watch that. And then next one's going to be Tesla, which Tesla honestly doesn't look too hot, but it still has some unfinished business. It's just I'm not entirely interested in how this is currently setting up. So Tesla just going to avoid that overall. But as far as day trade stocks, we have Apple, AMD, Amazon, Google, IWM, and Microsoft. They all look really good. So those are the main stocks I'm going to be watching for day trades next week. Now, as far as finding swing trades, I have a little watch list that I just call priority swings as I start seeing things throughout the week. I like to flip through that. So we can just flip through that real quick just because I have some setups. Rumble, I'm looking for a little earnings lotto on that. MAT, I mean, nice daily squeeze holding that 21 EMA. Maybe I can get it set up, but I do know that I want to watch this HPQ very closely for a possible retest of that daily 21 EMA. So that could potentially go on the list this week. FLS, no more with that. SLB, still looking for more upside. And the only other one I was really liking was Activision. So as we can see with Activision, I'd like to see a pullback down to this daily 21 EMA. The only issue is, I think with the buyout news with Microsoft, I don't think this is actually going to play out like I would expect it to, but I don't know, we'll see. And then actually UNH, I do like that one a lot as well. Nice daily flag right here. Maybe a swing we can catch off of that. But now, as far as actually finding these swings, I have scanners that I like to run through. And before you guys ask, no, I cannot share these scanners. These are all paid scanners besides one that I have for sale on my website. If you guys want to buy the one scanner that I personally made, that link is going to be down in the description. I use it to find all of my swing trade setups. So we're going to flip through that one real quick and see if it can pick up on anything interesting. So let's just put it right here and let's see what it picks up. All right, so it picked up on 4 different setups. One of them that we're already in, SLB, but it also picked up on BK. So that's currently trading above that daily 21 EMA with a squeeze. Honestly, not too interested in the setup. And then we already looked at UNH, but this is exactly how I found it, I was using this scanner. So would like to see a retest of that daily 21 EMA and 500, possibly get long, but also Costco. Maybe I could get a butterfly spread here, maybe a debit spread. Would like to see a pullback down to that daily 21 EMA for a possible long. So boom, Costco, put that one up. And then I have one more scanner, again, one that I made. So let's just pop that one up and see if it picks up on anything else. These two, they're very similar as far as what they're scanning for, but this one is slightly different. This one sometimes, yeah, you can see this one picks up on more sometimes. So let's just go ahead and let's flip through this. We have MQ, which I don't like. SLB, we already looked at. CCJ, nice daily squeeze. Maybe a pullback, retest of that daily 21 EMA at like 33.4. Maybe we could watch that. We already looked at BK. We looked at UNH. UUU, I have no idea what that is, so we're just going to go ahead and skip over that. PCT, not too interested in. This FSLR, honestly not too interested in that setup either. Uranium, which we're already in for a nice monthly squeeze that I'm actually looking for more upside on. So the way that this came to my radar was I have a nice monthly squeeze scanner that I like to flip through, and we were able to pick this one up. Right now we're just in the equity, but that did pick up on a daily setup on UAR, so you could have been watching that for a possible swing to the upside. And then again, we had Costco and LFMD. Again, sometimes it's going to pick up on a lot, sometimes it's going to pick up on very little. Sometimes the setups are going to be amazing, sometimes they're not going to be. But the reason I like to use scanners is because I programmed it to specifically pick up on what I look for in swing trades. And this is how I find 99% of my swings is simply through those two scanners right there. And I have a couple other scanners that I'll flip through, but I'm not going to share those. Again, those are paid scanners that I personally pay for to use on a monthly basis. I forgot to add some of the swings that I was interested in. But as far as what I'm liking this week, Apple, AMD, Amazon, Google, IWM, Microsoft, and Costco. And then there's a couple other swings that I'm going to be keeping on my radar, like one of them being that Activision, depending on, how the options are, if there's even any liquidity in them. But that is how I come up with my weekly watch list. I simply flip through my day trading watch list, use the higher time frames, look for any setups, and then I'll flip through my scanners and see, does anything fit my swing trading criteria? And then I'll put it into a list, my highest probability setups for the week, and then those are the stocks that I mainly am going to focus on throughout the week. But that is going to wrap up how to come up with a weekly watch list. As always, if you guys did find value in this, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Make sure you guys tune in tomorrow night at 7 p.m. Eastern time for another boot camp video. As always, everybody have an amazing rest of your day, and I'll see you guys tomorrow. So stop losses. There are a bunch of different stop loss orders that you can use in the market, but personally, I only use one kind, and that is going to be a hard stop. So just STOP. Now I get asked a lot, there's different stop loss orders that you can use. Again, like I said, I just use a stop. So pretty much what this is it's a market order saying get me out as soon as price hits this level on my stop loss. So pretty much a normal stop is going to be a market order, and it's saying get me the F out right now, right? So if you have this hard stop in, if price just starts going significantly against your position, as soon as where you set your stop loss is hit, it's going to sell the position no matter what. You might get filled a few dollars right below your level, you might get filled right at your level, but this is essentially a market order. Remember, a market order is just telling us, hey, get me in the market at the best possible price, get me out at the best possible price. So that is what a hard stop is going to be. Now also we have a stop limit, which is saying only sell at this price. So if you were to set a stop limit at 1.82, if price on the option or whatever you're trading comes down to 1.82, it's going to sell out of your position only at 1.82. Now, if the position goes significantly against you and your order isn't able to get filled, well, guess what? You're stuck there because you told the broker that you're only willing to sell at 1.82. That's why when I use stop losses, it is always a stop, again, market order, because I want to get out right then and there if my stop loss is hit. And again, a stop limit is saying only sell at this price. Your position could get skipped, and as a result, you end up missing out on your stop loss and the position goes significantly against you. Now, the final stop loss that I have a lot of people ask me about is a trailing stop. Personally, I don't use these and I don't like them. I know some people who do use them. But pretty much a trailing stop would be, say you buy a contract at, let's just say $100, it goes up to 1.20, and you put a trailing stop of $20. So if price pulls back to 1.0 on your option, it'll stop you out. But let's say that price goes up to 1.3, now your stop is going to be at 1.1. If the option goes up to 1.4, now your stop is going to be at 1.2. Option goes up to 1.5, now your stop is at 1.3. So it's going to trail $20 under wherever the option ends up being at that time. If it pulls back $20 from the high, you're going to get stopped out. Again, personally, I don't like using these. If you like them and you want to use them, go ahead. But personally, I don't. I am always using a hard stop. Get me the F out of the market right now because my stop loss is hit. I'm not trying to sit there and figure out if the position wants to continue to go against me or if it wants to go back in my favor. So as soon as my stop loss is hit, I'm out of the trade. So those are the different stop orders that you can use. Now, as far as being able to identify where your stop loss is going to be, it's really going to depend what was your reason for entering the trade and where did you enter the trade, right? So as we saw in the previous bootcamp videos, there's so many different ways that we can find levels and so many different ways that we can find setups. If you were to watch the 5-minute time frame right here on SPY and you were watching this bull flag, say you got long at this 8 EMA right here as price pulls back. Well, if this is a bull flag, what are you looking for? A continuation to the upside, right? Where should your stop loss be? Right below these lows? Because if it starts breaking below the bull flag, it's more than likely not a bull flag anymore. So as soon as it starts taking out these lows, you want to exit your position. But what about if you were like me, who tried to go long at 450, the 50% retracement and VWAP? Where's your stop loss? Right below the 50% retracement, right? So I added some here as we broke and reclaimed this 50% retracement at 450. And as soon as price started breaking below the lows, I was out of the trade. So it's always going to depend where is your invalidation point, and it depends on the setup. Everybody's going to be using a different setup. Everybody's going to have a different invalidation point. Right here, we had a little falling wedge later in the day. Say you ended up getting long as price pulled back to this FVG right here. Where would your stop loss be? Right below the low of the FVG, right? So it's really going to depend. I ended up taking a losing trade today. I took a losing trade and I took a winning trade. If we look at NVIDIA, I tried to short this thing at the 1 hour 21 EMA. That was my reject spot. So as price came up and tried to reject off of that 1 hour 21 EMA, I ended up getting short and my invalidation point was right on the opposite side. So as price started to break above my invalidation point, that is when I got out of the trade. Again, I'm not sticking around to find out, does this thing want to come back and start moving in my favor? If it hits my invalidation point, I am out of the trade and I will look for another setup. I told everybody that I was watching this rejection on the 1 hour time frame. If we take this pivot high to pivot low right here, told everybody I was watching this 447.52 for a reject on spot. As we came up to the area, I started my position, added more to my position as price started to confirm this reject. So right here, we have a lot of volume at the level of interest, and then price broke above and reclaimed the opposite side. Both of those were entries for me, and as a result, my stop loss was above, I believe it was 44 or 45.03 on ES. So as we see over here, price came up, got very close to that 50% retracement. So I said, okay, if price starts trading above 45.03, I will get out of this trade and I will accept my loss. So when it comes to identifying your stop losses, again, I'm going to keep repeating it. Where is your level of invalidation? And that's why sniper entries are so helpful, because if we can get in for as close to the level as possible, our stop loss is right on the opposite side. Now, if you were to enter late, that's when the risk to reward starts to get significantly skewed against you. Like say you didn't enter up towards the 50% retracement and instead you entered down here, you're gonna have to use a smaller position size, but you also have to understand that your risk is now a lot wider than what it originally was. So as soon as you enter the trade, or actually before you even enter the trade, you should be asking yourself, at what point is this trade invalid? Again, you could be entering off the 21 EMA, you could be entering off a VWAP, you could be entering off of a retracement, an FVG, a supply and demand, whatever it may be. Before you enter the trade, ask yourself, where is my invalidation point? And if that invalidation point is hit, that is where your stop loss is. Now, tomorrow we're going to be reviewing how to identify what your position size should be. How much are you actually willing to lose on the trade? I'm going to show you guys a cool little tip and trick with that. So definitely make sure you guys are tuning in for that. But stop losses are so important. That is what's going to keep us profitable in the market. In reality, if you were right 50% of the time and your losses were only negative 10%, negative 20%, when your winners were 20, 30, 40, 50%, you can be a profitable trader just based off of that. Obviously, using technical analysis and proven profitable strategies, we will significantly have that accuracy higher than 50%. Risk management is very important. A 50-cent dollar move against you should not blow your account. If you are blowing your account based off of a tiny move against you, you are significantly oversized and you did not know what your stop loss was. So before ever entering the trade, again, identify what your invalidation point is and then position yourself correctly if your invalidation point was hit your account should not be blown. You should be accepting that risk before you ever enter the trade. So remember, stop losses is what's going to keep us alive in the trading game. So make sure you guys tune in tomorrow for stop loss part 2. And as always, if you guys did find value in this, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Don't forget to do that daily check-in, and I will see you guys in tomorrow's video. All right, so this is exactly how you are going to identify what your potential max risk is per trade. So this is how I have my day trade set up. I like to use a 5-minute time frame, either a 15 or a 10-minute, and then a 1-minute or a 2-minute. And as you can see up here, what I have set up is my active trader, buy the ask, buy the market, sell the bid, sell the market, etc. What I don't see a lot of people talk about is link your active trader with a chart, right? So if we were to look at, let's just pull up Apple today, right? Let's head on over to Apple. We can see Apple had a really nice VWAP bounce earlier today. What was that, like 12:30? That ended up happening. So say you were watching Apple for this pullback down to VWAP, and as price started pulling down towards VWAP, you notice, okay, we bounced here, we bounced here, we bounced here. Also on the 15-minute time frame, we had a lot of buyers that entered right at that VWAP. You could tell by the volume on this candle, elevated volume, nice lower wick. What can we conclude from that? That there's buyers entering off of VWAP. Also, you can break it down to a smaller time frame, start looking at possible sniper entries. But say you were interested in this setup, right? More than likely, you would end up going with the 180 calls in this scenario. So what you would do is pull up Apple, and then you would pull up the 180 calls. Now, as we can see, price bottomed out at what, 12:20 all the way to 12:35. So you had about 15-20 minutes that you could have entered this position, right? Now, at that same time, as Apple is trading down at those lows, using the option chart, we can see Apple, when it was trading at this exact low right here at 178.62 or 63, whatever, was trading at a low of 1.01 per contract on the 180 calls, right? As Apple came down and dipped down again towards that 179.6, we can see that the option contracts hit a low of 0.99. Now we could say, okay, if our invalidation point on this trade is going to be around, I'd say 178.50, 178.4, because what would that mean? Well, if Apple started breaking and closing below VWAP, a logical stop loss would be down at this 178.5 to 178.4, correct? So we have our invalidation point picked out. Now, how do we understand how much we are willing to lose on this trade? Say we entered long, I don't know, after this candle right here as price started to push up. Let's say we got filled at 1.06 on this trade. We can conclude that if Apple were to start breaking below and getting down towards 178.5 to 178.4, that our stop loss should be around, I don't know, I'd probably say around like 0.9 to 0.93, give or take. So if we entered at 1.06, let's just go with 0.9 for simple math, we should be willing to lose $16 per contract, which is a very tiny loss, because as we can see, the contracts ended up, Apple moved all the way up to 179.5, which at that point would have taken these contracts all the way up into around 1.33. So you're willing to risk about $16 to make about $27 per contract. If price were to move all the way back up into these highs, you could have had it go all the way to 1.5. Maybe it still wants to move all the way up to those highs. But using this method helped you understand exactly how much you were willing to risk on this trade. Let's take another look at, I don't know, let's pull up, take a look at AMD. I don't know what AMD did today. Okay, we can look at AMD right here. So as we can see in the morning, price pushes up, pulls back, bounces right off the 8 EMA, and you can see VWAP and the 21 EMA are very close at that time as well. So if we were to pull up AMD options, at that time, AMD was trading at around 107.6. You could have went with the 108 or the 109 calls. Let's just pull up the 108s because those were at the money. And let's put this on a 5-minute time frame. So as we see, this was at 9:55 when price pulled back down to this 8 EMA and VWAP area. So if we go ahead and we find 9:55 on the actual option chart, which was right here, you can see that at the low, when AMD pulled back to 107.5 at 9:55, the option contracts hit a low of 2.13. Okay, 2.13 when AMD was trading at 107.50. We could conclude, where's our invalidation point? Because we have VWAP in the 21 EMA right here, let's just say our stop loss is down towards 107.10 to 107, right? Just for a safe stop loss, we could look at this and be like, okay, well, if we entered at 2.4 because we saw the reaction off of the 8 EMA, right? Let's enter at 2.4. We could conclude and look at this and say, okay, 107 to 107.10 was at the beginning of this candle right here. So this candle right there, we could say, okay, our stop loss has to be down towards like 2, right? 2 to 2.05 for a stop loss. So if we're entering at 2.4, our stop loss is down at 2. We should be willing to lose roughly $40 per contract. And then from there, that is how we can go about our position size. Can we afford to lose $400? If yes, then you could go with 10 contracts. If you don't want to lose $400 and you're willing to lose $200, then go with 5 contracts. This is what's going to help you so much with identifying how much you could potentially lose. And then from there, you're able to use it to identify your position size. And then you can see from there, AMD rallied all the way to a high of 110.7, which ended up being a high of around 3.8 on those contracts from an entry of 2.4. Let's take a look at one more example. Let's take a look at potentially Amazon, because I know Amazon was a ripper today. Not really a fan of that setup. Let's go ahead and take a look at Meta on the 5-minute time frame, 5-minute, 15-minute. As we can see on the 5-minute time frame, Meta had this nice little falling wedge right here to the downside. Plus, at the same time, it had a nice little FVG from that point to that point. And as we can see, price traded into that FVG and had a nice bullish reaction. So at this time, Meta was trading at around 302.2. So you'd probably go with the 305 calls. So if we go ahead and we pull up Meta, we take a look at the 305 calls at that time. Let's see, Meta pulled back into the FVG at 11:10 a.m. Eastern time. So let's find 11:10. That was right here. So as Meta is pulling back and is trading into that FVG, we can see that the options were trading at a low of 3.7 all the way down to a low of around 3.65. Now for this FVG, again, it's going to depend on the setup. Sometimes you have a really good stop loss. Sometimes you're going to have a wider stop loss, right? So we can look at this and be like, okay, well, where's our invalidation point? Our invalidation point would be below that FVG, which would be around like 301.5, right? So if we look at this 5-minute candle right here at 10:30, where were those contracts trading at that point at 10:30? They were trading around 3.5 to 3.4. So let's just say we went with the 3.4 and we ended up getting long at, let's just say 3.9. in this scenario, right? Because that's when we saw price start breaking above that 5-minute falling wedge and the reaction off of that fair value gap. Let's just say we got the long 3.9. We could conclude that we are willing to lose around $50 per contract. So then from there, we can determine what is our position size. And then that's how you determine, okay, this is how many contracts I am going to buy. And from there, Meta went up to a high of 4.7 on those contracts. You were willing to risk about 50 and you made about $80 per contract. And then I often get asked, how do you actually go about placing a stop loss? If you guys didn't see my video on how to set up Active Trader, I definitely highly suggest doing so. But if we just got rid of this chart right here, let's just say that we entered this position right now at 3.95. All you have to do is scroll down and you can see that it automatically pops up with sell however many contracts you have, stop. So if I put this on 20 and I scroll down to 3.3, they're trading at 3.95 right now. So if I just went ahead and bought these right now at 3.95 and I put a stop loss at 3.3, all I have to do is scroll down and then you can see sell negative 20 stop. If I want to buy 50 contracts, right? Whatever you have in here, that's however many contracts is going to pop up. So if I scroll down, sell negative 50 stop, it will automatically put my stop loss at whatever level I click down here. But that is how you can put your stop loss in. So again, use the chart of the actual option to determine how much am I willing to risk. And then from there, you can determine your position size. And if you want to use a hard stop, you just go ahead, scroll down, find where that place is going to be, and then click there and put in your stop loss. But that is going to wrap up stop losses part 2. So as always, if you guys did find value in this, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. get prepared for more boot camp videos. I have a lot of fire this week, so make sure you guys are tapping in every single evening at 7 p.m. Eastern time. Everybody have an amazing rest of your day, and I'll see you guys in the next video. Alrighty, so what is liquidity? Liquidity is basically orders being filled in the market, right? So as long as orders are being filled, there is liquidity. If no orders are being filled, there's no liquidity. But the trick to trading with liquidity is being able to identify where are these orders going to be filled at. So these orders can consist of many different things. They could be stop losses being hit in the market. They could be limit orders being filled in the market. They could be market orders being filled in the market. So if we're able to identify one, where stop losses are being hit, two, where traders are entering either at a limit order or a market order, we can identify an area of liquidity. And I want to show you guys a really good example. So pretty much when it comes to trading with liquidity, the way that I use it is simply I only mark these levels on like a 5-minute or a 15-minute, and I'm simply just looking at previous lows or previous highs. That's where I notice the highest probability liquidity trades end up setting up. So again, it's either going to be on a 15-minute or a 5-minute that I mark these points. But there was a really good example this morning when I was live on my YouTube channel. Now, I do go live every single morning, 8 a.m. Eastern time, and give you guys a completely free watch list for the day. If you guys aren't tuning into those, definitely highly suggest you do so. But if we're looking at NQ this morning on the 5-minute time frame, what do we notice? We start basing out down at this low right here. So as we see, price comes down, tests this level at 15,159.50, bounces up, comes down, and it sets a higher low. What is this suggesting to us? Buyers are in the market. Again, if you guys have watched the price action video, this is a solid buyer's candle right here. They push price up. Notice how price comes back down and we have these nice lower wicks. What is that suggesting? Buyers in the market. So if people are getting long right here and getting long right here, where do you think their stop loss is going to be? Right below this low right here. So that is one area of liquidity, possible stop losses if price were to break below it. Now, also at the same time, what you're going to have is people who are trying to short below this low right here. So as price comes down and it dips below this low, stop losses are being hit and traders are either having their limit orders filled to go short or they're market ordering to get short, right? So we have an area of liquidity. Stop losses being hit and traders entering short. Lots of positions being filled, creating liquidity. Now, when those traders are going short, where are their stop losses going to be? If price starts to reclaim the breakdown level. So these people who were getting long over here got stopped out right here. As the traders got short and price reclaimed the level, what happened to them? They got stopped out as well, creating enough liquidity for the market to then give the next leg up. So that's just one example of what liquidity is going to be. So now let's head on over to ES. Let's look at another example. We could actually look at this one from yesterday. So if we're looking at yesterday and we head on over here, we had an area of liquidity, right? So as we can see, price pushes all the way up into this 45.01 area in the overnight session. And if you are looking to learn more about my overall day trading and swing trading strategy, how I find bounces, rejects, support and resistance, price targets, Fibonacci, all the indicators I use, and so much more, make sure to check out my 450-page book on Amazon titled The New Age of Technical Analysis. Tons of amazing reviews. Definitely make sure you guys check out the reviews. But if you are interested in learning more about my strategy, make sure to check out my book, The New Age of Technical Analysis, on Amazon. The link will be down in the description. As you see, price comes up, pretty much double tops up here. Right now, to me, this isn't necessarily considered a liquidity sweep. I would see this more as a double top. But as traders got short at that double top, where do you think their stop losses are going to be? Right above these highs, correct? As we see, price pushes up, hits the stop loss orders. More than likely, what are other traders trying to do? They're trying to long the breakout and catch the next leg up. Where are their stop losses going to be if price starts breaking and reclaiming the opposite side, right? So we have these sellers having their stop losses hit, and then we have buyers trying to push price higher, having their stop loss hit, creating enough liquidity for then price to start dropping to the downside as both sides are stopped out in the market. Let's look at an example that actually ended up playing out today, and this is a trade that I ended up taking. So looking over here on the 5-minute time frame, price actually came down to 45.59 all the way over here. This was a very important level. And as we can see, price dropped all the way down to this 45.59 on Friday, right? So that is an area of liquidity. This is the lowest low of this pullback that we have had recently. So that's going to be an area that we want to pay attention to, right? So as price starts trading down towards this area, what do we notice happens? It breaks the opposite side of that liquidity zone, 45.59, and then it reclaims the opposite side. As a result, setting up for a high probability trade to the upside with your stop loss right below this low. And that is exactly what I was seeing going into this trade. This previous low at 45.59, I was looking for price to grab liquidity, reclaim the opposite side to then get long and catch a nice move to the upside. Let's take a look at some other examples. Again, I'm just on the 5-minute time frame right here. Here's a really nice liquidity setup. So as we see in the pre-market session around, what is this, 7:50, we ended up setting this low right here. And again, I talked about this one live on my live stream in the morning. As we see, we had some news. Price broke below that previous low. Again, more than likely traders went short. Any traders that were long got their stop losses hit. And as price reclaims that previous low, the ones who were trying to short ended up getting stopped out of their position, again, creating liquidity in the market, and price ended up pushing all the way back up towards that news high, and actually even higher after that. Sure enough, doing a nice liquidity sweep to the upside. As we see, this was that previous high point right here. Price tried to trade above it, ultimately failed, creating liquidity. And as we see, price made a move all the way back down towards these lows right here. As we see over here, we set this low in the morning. Price ended up breaking below it, immediately reclaiming the opposite side. Any traders who were long near this level more than likely got stopped out. Any traders who went short, where's their stop loss? Right above these highs right here. As price reclaimed the opposite side, both sides of the market ended up getting stopped out, and then they moved price even higher. Same thing over here. If we're looking in the overnight session, we can see that we set this nice high point right here. As we see, price ended up pushing up into the area, maybe hit some short stop losses, and then also traders who were trying to get long were trying to long the breakout, creating liquidity, both sides of the market getting stopped out, and then made the move all the way down into this liquidity right here, the pre-market low. Any trader who was looking to go long, any trader who was long over here, where's their stop loss more than likely going to be? Right below this low. Any trader trying to short the new low of the day break ended up getting stopped out, creating liquidity, and then creating the next move to the upside. Then as you can see, it came back down later in the day, retested it, created more liquidity, and then they ended up pushing price even higher. So again, pretty much what I am doing with liquidity. And if you go onto a 5-minute chart, you're going to notice that this literally happens like almost every single day that we start getting these liquidity grabs. There was even another one right here. We have this low, price breaks above, fails to break above, creating liquidity in the market, and then they made the next leg to the downside. So you're going to notice that this happens a lot in the market. So your homework is going to be going onto a 5 or 15-minute chart on the NASDAQ or S&P futures and back testing this strategy. Again, it is super accurate. All you need to do is look for previous high and low points. And what you're looking for is failed breaks above or failed breaks below an area of liquidity. Now, when that happens, you're looking for both sides of the market to get stopped out. And with that, all you really need to understand is if you were a trader in that scenario, where would your stop loss be? And if you can conclude that, okay, there's more than likely sellers getting stopped out and buyers getting stopped out at this area, that sets up for a high probability liquidity spot. Make sure you guys do your homework, because tomorrow we're going to be having liquidity part 2, and I'm going to be showing you how you can trade these areas. And then here's another example. Again, they are literally everywhere. So make sure you guys are doing that homework. But as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. If you haven't already, make sure to do that daily check-in, and I will see you guys tomorrow for liquidity part 2. Alrighty, so hopping into it, liquidity part 2. Today we're going to be discussing exactly how we can identify trades using liquidity. So again, remember from last video, pretty much what I'm doing is looking at a 5-minute or a 15-minute time frame. I'm identifying areas where sell orders are going to be hit, as well as buy orders, buyers trying to buy into the market. So when we go through and we start marking these areas of liquidity, here's another one right here, right? What are we looking for? We are looking for bearish price action or bullish price action. So we just go ahead and delete all this, and we look at this example right here. We have a high point made at around 10.55. If there were people who tried to get short around this high, their stop loss is likely above this high. Now, as far as traders who are trying to trade the breakout above the previous high, where their stop losses more than likely on the opposite side. So as we see, price trades up. If anybody got short, where's their stop? Right above here, that got taken out. Any buyers who are trying to buy the breakout, where's their stop? Right down here, they're getting stopped out. We then can take that to our advantage and identify a low risk, high probability setup. So from there, we're looking at these candlesticks right here. Look at the wicks. Again, the wicks is always going to tell us a story. Are there buyers? If so, there's going to be long lower wicks. Are there sellers? If so, there's going to be long upper wicks. So as we see, price fails to break this high, grabs liquidity, stops out both sides of the market. As a result, setting up for a low risk, high probability trade to the downside. So your stop loss would have been above this high point right here. You can see price, if you were to get short on this candle right here, hardly broke above it. So yes, you always want to give yourself a little wiggle room. I typically give myself 20 to 30 cents of the opposite side. So as we can see on this candle right here, the high was around 55.03. So as a result, my stop would have been around 45.05 on this trade. That's why I like to give 20, 30 cents, which is about 2 to 3 points on ES. And as you see, you would have never been stopped out and price ended up dropping to the downside. Let's look at an example over here. So as we see, we have really strong support over here. Buyers buying it up here. Bought it up here, bought it up here, here, and then a little later in the day, price just came down, broke below that low. If anybody had their stop losses too tight, they got stopped out in this trade. Anybody who tried to short the low a day break, what more than likely happened to them, they got stopped out as price started trading on the opposite side, and then from there, price made the move to the upside. So what are we looking for if we're looking for downside liquidity sweeps like this? We're looking for bullish price action and a bullish reclaim of the level. You can typically tell if it's going to be a liquidity sweep due to the volume. If we break below a level and we reclaim it with heavy volume, that is telling us that a lot of liquidity is entering the market. Again, stop losses being hit below here. Anybody who's trying to short is adding to the liquidity, and then they get stopped out as well, adding even more liquidity. So a lot more orders being filled in that general area. So a lot of volume right there, plus the reclaim, you could have went long with your stop loss 2 to 3 points right below this low. So that's another example. Let's just start scrolling back and let's just literally go super far back and see if we can find more examples. So let's just stop right here. Let's see if there are any liquidity sweeps. Let's see. One right here, bingo. So here's a good one. Actually, here's another good one. So there's two of them, right? So as we see, price ends up setting this low point right here towards the market open, 935. And as we see later in the day, price pulls down to that area, snipes the liquidity, makes the move back to the upside. Now here's a really good one. As we see, we have this nice high. Again, all I'm doing is simply just going to a 5-minute or a 15-minute chart and just marking highs and lows. So as we see a little later in the day in the overnight session, price trades up into this 5-minute liquidity zone, takes out any stop loss orders. Maybe people try to get long at that new high and then they end up getting stopped out. And as price starts trading below, you could have went short with a stop loss right above this high. And as you see in the entire overnight session, price dropped to the downside. Here's a really good example right here, actually in the pre-market. So as we see right here, we have this solid overnight low right there. And as we get, it looks like we got news at that level. Price broke below it, reclaimed the opposite, or actually this is during the trading session, my bad. We have this nice low during the trading session. Later in the day, price comes down, takes out the stop loss orders below here. People are trying to get short, and as a result, where are they going to stop out? Right above this high. Price reclaims that side, stopping out anybody who tried to go short, gave a nice liquidity sweep, and price started to move to the upside, even came back and retested the level. So that's a really good example of a liquidity sweep. Let's head on over here and see if we can find any more. All right, so here's a nice one in the overnight session. So as we can see, we have this nice high point right here. Price trades up into the zone. Maybe somebody went short here. Maybe somebody went short here, or even as price is getting close to that area again. Where's their stop? Right above this high. You also have people who are going to try to long above that previous high a day break. Again, both sides getting stopped out. Gave us an opportunity to go short, low risk, high reward. You could have gotten short at the end of this candle. Stop loss a couple points above this high. And as you can see, price made a nice drop to the downside. Again, that's in the overnight session, so nothing crazy happening over there. Let's head on over. Here's a nice little one right here. Previous high, price broke above, reclaim. Caught a nice little drop to the downside. And then let's take a look at, I don't know, 2-3 more examples. Same thing over here. During the market open, we had a solid low set in right here. Nice 2 bottom wicks. Price then bounces off of the area. A little later in the day, what do we see? Breaks below, reclaims the opposite side, again grabbing liquidity. Did it again right here, grabbing more liquidity. And then from there, you could have gotten long either at the end of this candle or this candle with a stop loss a few points below those lows. And then you can see price had a nice little rally to the upside from there. And then we will take a look at this last example right here. So again, as we can see, we have this nice high point right here. Price trades up into it, breaks it, couldn't hold it, grabs the liquidity, and then from there sets up a bearish candlestick. You could have gotten short with a stop loss a few points above this high, and it was able to make a nice drop to the downside later in the day. So that is pretty much what I'm going to be looking for at these liquidity zones. If price is able to break a previous high or low, either on the 5 or 15 minute time frame, and reclaim it either with bearish price action, bullish price action, and heavy volume, that is what sets up a high probability liquidity sweep trade for me. So if price is coming up to this previous high point right here and it fails to break above, I am looking for bearish price action to then confirm to go short. So a very long upper wick right here probably had news. Yeah, it was 8:30, so we definitely had news. But we can see that price failed to break above and hold above that high. That's set up for a liquidity sweep. A little later in the day, we had that same high point. Price trades up into the area, tries to break, grabs liquidity, very bearish price action, and then from there, what happens? Price moves to the downside. So if price is coming up towards liquidity, we are looking for bearish price action. If price is coming down towards liquidity, we are looking for bullish price action. So if price comes down to a liquidity spot, we are looking for price to break and reclaim with bullish price action and bullish volume, which as a result is going to set up for a high probability trade to the upside. But that is going to wrap up liquidity part 2. So if you guys did find a lot of value in this video, as always, make sure to smash that like button as well as clicking that subscribe and that bell icon. Make sure you guys tune in tomorrow night for another bootcamp video at 7 p.m. Eastern time. I got a very special one for you guys this weekend, so make sure you guys tune into those as well. Everybody have an amazing rest of your day, and I'll see you guys in the next bootcamp video. Alrighty, so what I have pulled up is the ES futures on the 5-minute time frame. The one thing that I do want to point out about these fair value gaps, and I'll show you guys, is you can identify these on multiple different time frames. It really just depends on what time frame you want to use. So I find a lot on the 5-minute, but you can also use them on a 1-minute, a 15-minute, an hour, a 4-hour, a daily, a weekly. Like literally they are everywhere. So let's start off with what is a fair value gap. Pretty much what this is, or actually what this is a 3-bar setup. So what we are looking for is the first candle, right? Let's just say it's a green candle and we have a little upper wick right here. And then we have a nice lower wick right here. So this is the first candle, right? The second candle, we want to see a large move away from that first candle. So a pretty large green candle in this scenario, right? We want to see that large aggressive move away. And then on the third candle, what we want to see is it could be, again, a green candle. It could be a red candle. It doesn't really matter on this one or this one. The main thing we want to pay attention to is this large green candlestick right here if we're looking for an upside fair value gap. But as long as this wick right here on this third candle does not intersect with this wick right here, a fair value gap can be drawn. And as long as this body does not intersect with this wick right here, a fair value gap can be drawn. Now, what this is implying is that price made a really strong aggressive move away from this level without finding any acceptance in between with sellers, right? So if it's just a strong green candle like we see right here, there was no price acceptance with sellers. There was basically no sell orders inside of this candlestick right here. It's a bullish engulfing candlestick, right? So there was no acceptance down here, meaning price is likely going to come back down and look for some kind of acceptance from both sides. So what we can do is draw this fair value gap. What you're going to do is you're going to take the high of this first candlestick wick and you are going to connect it up to the low of the third candlestick wick. So this would be considered your fair value gap. What we would be looking for from there is for price to come down into this area, start setting up some bullish price action, start coming back out, and then we can look for an upside move. So that's what an upside fair value gap is going to look like. Now we also have downside fair value gaps. So from there, what we're looking for, again, it could be a green candle to start off, or it could be a red candle to start off. The main thing that we want to pay attention to, though, is this second candle. We want to look for a strong, aggressive move away from that first candlestick, right? So as we start getting that, and then we get the third candlestick, again, this could be green, it could be red. So let's just go ahead and let's make this one a green, just for this scenario, right? We have this red candlestick right here. Again, it could be green, doesn't really matter. And then we have this red, strong, aggressive move away, right? The main thing that we want to look for is make sure that this upper wick does not intersect with this candle's lower wick, right? So if this wick were to come up and start hitting up here, then there's no longer a fair value gap there. There was no price acceptance in this area right here as far as buyers. This is a bearish engulfing candlestick. So more than likely, price is going to try to retest this area and look for acceptance from both sides. So what we're going to look for, or actually from there, what we can do is take the low of this first candlestick right here to the high of this third candlestick right here. And what we're going to be looking for from there is for price to trade up into this area, start forming some bearish price action, and then look for a move to the downside, right? So there's multiple different ways that we can find retracements in the market. This is just one of the ways that I like to use. Now, I personally don't only base trades off of fair value gaps. I like to look for other confirmations, VWAP, moving averages, Fibonacci retracements, previous support and resistance, supply and demand, etc., right? So if we have multiple confluences inside of this fair value gap, that then adds even more confirmation to the trade. Now, if we were to enter in this scenario right here, say we got long right at 45.50, our stop loss on this trade would be if the S&P futures fell below the fair value gap. So all I had to do was start breaking below here, and you're immediately out of the trade. If you were to go short over here at, let's just say 45.58, your stop loss was if price started to break above this fair value gap. So your stop would have been right up here, and as a result, giving you a low risk entry. So again, this is just showing us where price could potentially retrace to. Now, what we want to do is look for multiple confirmations at that level. So looking at this example right here, there's actually two fair value gaps that you could have drawn. One was right here, right? So as you can see, we have this nice upper wick, nice little strong aggressive move away, and then we have this strong aggressive move away. So we got a little fair value gap there, and then we also have another one right here. So we have two fair value gaps in this scenario. As you can see, price ends up pulling down into these areas. Again, it's showing us where can price retrace to. So if you were to get long on this candlestick, your stop loss would actually be below this low. Again, two fair value gaps in that scenario that you could watch. So that was just one example to the upside. Let's take a look at another example right here. Here's one to the upside as well. We have this nice upper wick, strong aggressive move away. Third candle's wick does not come anywhere close to that first candle's wick. So what are we going to do? We're going to draw our fair value gap. A little larger of a zone than I would prefer, but I know that we had moving averages down at this level. Let me just pop them up for you guys real quick. We had the 8 EMA and 21 EMA both at that area. Again, adding confluence. But as we can see, price retreats into that fair value gap, saw a nice little bullish reaction, and then they continue to push price higher. What about this one right here? There's another one. Look at this upper wick, strong aggressive move away. The bottom of this candle doesn't come anywhere close to this one. What can we do? Look for a fair value gap, and as we see, price traded into this one, push back up into high a day. What about over here? As we see, price made a strong aggressive move to the downside, and then ended up having a nice pump to the upside. We have a nice fair value gap, taking that high to this low. Price came down, wicked off of it here, wicked off of it here, and then pushed to the upside. What about right here? There is a bearish fair value gap. So as we see, taking this low, a strong aggressive move to the downside, and then this third candle's wick was nowhere near this first candle's wick, right? So what can we do? Fair value gap. And as we see, price trades into the area, ultimately rejects it, and makes a strong move to the downside. Let's see if there's any other scenarios. Here's another one right here that you could have identified. This one was to the upside, right? So nice little fair value gap, price dipped into it, saw a nice little push to the upside, nothing crazy, and then ultimately fell apart from there. So here's one right here. This was a very quick one. But anyways, we have this low point right here, strong aggressive move down, price trades back into the fair value gap, rejects the very top, makes a quick little new low a day, before pushing back to the upside. Now, obviously, when you are identifying these fair value gaps, you want to be trading with the trend, right? If the trend is clearly up, we're not going to be looking for price to come up and start rejecting off of 5-minute fair value gaps, right? We're looking for retracements in a 5-minute fair value gaps to then look to get long. So that's one thing to keep in mind when you are trading with fair value gaps. Trade with the trend. Don't just trade against the trend just because you see a fair value gap going the opposite way. If anything, you can use other fair value gaps for price targets, right? So if you were to get long and then you ended up seeing, oh, there's a fair value gap right here, you could use that fair value gap as a potential price target, right? So say you started getting long down here and price is moving to the upside, you could say, oh, well, let me aim for this fair value gap as a potential price target, right? But we always want to trade with the trend. You don't want to trade against the trend because that is when you are going to make a lot of mistakes in the market. There was a really wide fair value gap right there, but I'm sure you guys see the point by now on this 5-minute time frame. Let's try a 2-minute time frame, right? I want to show you guys that these literally form on so many different time frames. It's your job as a trader just to identify the setup. So let's see if we can find a good 2-minute one. Okay, here's one right here on the 2-minute time frame. You know, we have this little right here, nice little gap down. We actually had a bunch of them, so let's just take this one right here. It's right there. That's a 2-minute fair value gap, right? Let's head on over here. Here's a 2-minute fair value gap to the upside. They are literally everywhere on multiple different time frames. It just depends on what time frame you identify the setup. If you're going to be using 2-minute fair value gaps, I wouldn't be using them unless you actually have reason to believe price is going to bounce or reject at an area. So those are going to be more so for sniper entries, but already at a level of interest. But the higher the time frame that these fair value gaps occur, the more important they're going to be. Even over here was one to the upside. You can see nice little fair value gap. Let's take this and then boom, there's our fair value gap. Price retraces into it, makes a tiny little move to the upside. But again, they're literally everywhere. We can take one more look at the 15-minute time frame and then we'll wrap up the video. But let's just pull up the 15-minute right here. Let's see if we can find any good ones. So there's one right here actually, and as you can see, price ended up breaking above it, and then it went and set another one right there. So they're just literally everywhere. The main thing you want to keep in mind though, and I'm going to keep repeating it, trade with the trend. Just because, you know, price is coming down to an area, but let's just say that the trend is to the downside, you don't want to just go long because you see a bullish fair value gap. You want to go long with other reasoning behind it, like a super strong support level or a super strong Fibonacci or a super strong demand, whatever it may be. And then you can use the fair value gap to help you identify or give you more confluence at that area of interest. But here's one on the 15-minute, right? So we have this nice little lower wick right there, strong aggressive move away. This could have been a fair value gap. There was one right here on the 15-minute time frame. So if we just go ahead and take that high up to this low point right here, you can see price retrace right into it and then gave a nice move to the upside. So high to low, price retraced into it, gave a nice reaction to the upside, and then price continued for the remainder of the day. But that is going to wrap up fair value gaps part number 1. I just wanted to discuss how you can identify these and what they even mean. So tonight I got some homework for you guys. Go back on a 5-minute time frame and start looking for some of these fair value gaps. Just take 15-30 minutes to start identifying them. Again, it's going to be that repetition that helps you identify it in real time in the market. So definitely make sure you guys are doing your homework. And as always, if you did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And I will see you guys in tomorrow's video for fair value gaps part number 2 with a special guest. Everybody have an amazing night, and I'll see you guys then. All right, so as discussed yesterday, you can identify fair value gaps on many different time frames: 5-minute, 1-minute, 2-minute, 3-minute, 15-minute, 30-minute, hour, 4-hour, etc. Right? They are literally everywhere. So as far as actually trading these areas of interest, let's just go ahead and let's find one. We actually had one right here in the morning. So if we break it down to a 5-minute time frame, we can actually see right in the morning we had this high point right here, this upper wick, a very strong aggressive move away from the area, and then a retracement into it. So this is going to be our fair value gap. Remember, we're looking for price to trade into the area, and then from there, what we want to look for is we want to look for an entry. So typically what you can do is break it down to smaller time frames. Because this is a 5-minute fair value gap, you can break it down to a 1-minute or a 2-minute and start looking for bullish price action. We can also look at the moving averages. If we have moving averages inside of the fair value gap, that gives us a better understanding of, okay, we should ideally be looking for price to come, down to this level and have a reaction, or down to this level and to look for a reaction. Or what you can do is actually take your Fibonacci retracement and you can measure the difference between the first candle wick all the way up to the second candle wick. And then from there, what you can look for is for 50%. So halfway through that fair value gap, that is where you can start looking for an entry. Now, depending on how large that fair value gap is, if it was a lot smaller, let's just say, if we were to shrink this here to here, okay, that's a much smaller zone that we could use. So at that point, I would just be looking for price to dip into it and then have a bullish reaction out of it to then validate the entry. But if we're using a wider fair value gap, this is exactly what I'm going to be looking for price to confirm an entry. Again, I'm going to be measuring between those 2 points to identify where's the 50, so the halfway mark between it. And then also you can use those moving averages to also identify an area of interest for an entry. If you were to get long in this area right here, either at the 50 or as price reacted off of that 5-minute 21 EMA, your stop loss would have been right below this fair value gap. So if price started breaking below, you would have stopped out. And as you can see, price made a move right back into high a day. So that's just one example right there. If we were to look, let's see, we didn't have any good ones to the downside today. Let's just head on over to yesterday, see if we had a good one. Okay, so this was a little smaller of a level. So as we can see, and personally, I wouldn't be taking a trade like this. I just want to show you guys an example. But as we see, we had this large move to the upside. Personally, if I would have been trading a fair value gap like this, I would have been watching this one right here. This was the very first one. You can just see that we literally had a bunch of them. But again, I just want to show you guys this example right here. So as we can see, price ended up having that fair value gap right here. Price dipped down into it and then got bought right back up. Again, you can use smaller time frames, 1 minute, 2 minute, 3 minute to identify an entry and look for bullish price action in that area. And as price came outside of it, you could have gotten an entry and caught a nice little scalp to the upside. But also, if we just go ahead and measure the difference, I'm sure it did 50%. Because, yeah, pretty much right at that 50%, got bought up and then pushed to the upside. So maybe you got the entry as it came outside of it. Maybe you got the entry right at the 50% retracement and your stop loss was right below here. Either way, you could have identified an entry for a nice scalp to the upside. Again, that's personally not a trade I would have taken. But here's another one right here that you could have traded to the downside because the market has been pretty weak. So as we see, difference between this wick low, strong aggressive move down, and then we have this opening wick, or actually the opening of that candle right here. We do have a nice little fair value gap that we can then watch. So again, there's a couple different ways that you could identify an entry, and this is a little smaller of a zone. So what can you do? You can measure the difference, which is going to give you that 50% right there. You also have the 8 EMA and 21 EMA both lining up around this area right here. As price started to come up and started rejecting, again, watching the smaller time frames, so 2 minute, 1 minute, whatever you want to use, you could have watched that and then identify some bearish price action to then get short with your stop loss right above this high. Or if you waited until the candle closed, it's just your risk would have been wider in this scenario if you waited for the candle close. But if you broke it down to a smaller time frame, you can identify a earlier entry. So if you got short up here, your stop loss was right above this high. And as you can see, price made a nice flush to the downside. Now, again, using multiple confirmations, this is where the halfway mark was in the fair value gap, but also at the same time, if you took pivot high down to pivot low with an actual retracement, you can see that's where price ended up pulling right into. So you had a lot of confluence in this one area, the actual 50% retracement, the midway point of the fair value gap, 8 EMA and 21 EMA. So a lot of confluence in that one area confirming the trade. Let's see if we can find another one. Let's go ahead and, I mean, you could have used this one. That one's not the best, but I mean, there was a nice little fair value gap there. You can see price kind of just held in it before it pushed away. Let's find a different scenario. There's one right here, actually. So if we just go ahead, same thing, high, low, we can see that price dipped into that fair value gap and got bought right up out of it. So again, you could have done the same thing. You could measure the difference between these 2 points and you can see right at the halfway point, that 50 is where it got bought up. Price dipped into it, got bought up here, could have confirmed an entry, either or, right? If you wanted to buy here with your stop loss right below this low, or as price started to come out and confirm, again, breaking it down to a smaller time frame, you can identify an earlier entry. At the same time, we had a falling wedge, which is typically a bullish continuation pattern, which again, piecing everything together, you have a lot of confluence in that one area, which could have led to a low risk, high probability trade. And then from there, you can see price continue to the upside. Let's head on over right here. And actually, yes, that is a very good example. So right here, it looks like this was in the overnight session. We can see that we had this low point right here during the London session. Very large reaction to the upside, and then price comes down and it just dips into the very beginning of that zone. Again, sometimes that's going to happen. Sometimes it will retrace the 50% or even deeper into the zone. That's why we want to watch price action. So as we see, price immediately came down, got bought right back up. Again, breaking it down to a 1 minute or 2 minute could have led to an entry up at this spot right here. And price was able to give a nice little pop to the upside, pull back, new higher high, higher low, and then a higher high before finally falling apart. So that's another good example right there. Let's see if we can find, almost hit that one right there. Here's a good one right here, actually. So go ahead and draw this. You can see that we had this low right here before a strong aggressive move to the downside at 8:30. Again, setting up for a fair value gap. So you would just take that low to that high point right there. And then what you could do is you can measure in between the two, get the 50%, which ended up lining up right here. At the same time, you have the 8 EMA and the 21 EMA inside of that zone. Again, breaking it down smaller time frames, 1 minute, 2 minute could have led to a sniper entry inside of this area right here. Either way, you can see that the price action did confirm. Just if you enter down here, the risk was again significantly skewed against you. So if you got short up here, your stop loss was right above that fair value gap. Use the smaller time frames to identify your sniper entry, and you could have gotten short and taken advantage of that move to the downside. So that was another example right there. Here's another one right on over here. So actually there was two of them right in this area. So let's just go ahead and take a look at this one right here. This one just made a deeper retracement into the fair value gap, but ultimately it ended up failing. You see price tried to push up, large sell-off right here, came up, set a lower high, and then ultimately rolled over, started flushing to the downside. Then after that, in the overnight session, there was another fair value gap. So if we take this low down to that high point right here, you can see price traded to the very high of that zone in the overnight session and then ended up selling off. Again, if you were able to identify an entry off of this bearish price action, your stop loss was right above this high before price continued lower. Here's another really good one. So as we see, price starts flushing to the downside. If you start piecing together liquidity sweeps, and I think I'm going to have a video combining liquidity sweeps into fair value gaps, because that's a strategy that I personally really like, is when price goes and it sweeps liquidity, has a strong move in the opposite direction, and then sets up a fair value gap. That is what I have noticed is a very high probability setup. So in this scenario, maybe there was a liquidity sweep. I don't know what day this ended up being, but if this ended up being a liquidity sweep, it took out the liquidity, had a nice strong move to the upside, and then retraced right into that fair value gap, which set up for a high probability trade to the upside. So again, here's the fair value gap, very bullish price action right out of that level. Could have gone long with a stop loss right below this low. This would be a scenario where I'm actually looking for the candle to close outside of the fair value gap, just because you can see we had a really strong move to the downside previously. So we come down, we have bullish price action, buyers buy it right up. You could have gotten long, stop loss right below this low. And as you can see, price made a really strong move to the upside right after that. So I'm actually going to make a video on the liquidity sweep into the fair value gap. I just got to find a bunch of examples for you guys. That way I'm not searching forever to show you guys. So maybe next week, I'm going to try to take a bunch of screenshots of liquidity sweeps into fair value gaps, and then we can go over it and I can show you exactly what I am looking for when it comes to that. But that is how you're going to identify trades using fair value gaps. Again, what we want to identify is an area of interest. Where can price likely retrace to? You can use the Fibonacci retracements to find the halfway point in between that fair value gap. Use the moving averages as well to your advantage, because the more confluence you have inside of a fair value gap, the higher the probability the trade is going to be. So when price retraces into that fair value gap, if you're looking for a short, you want to be looking for bearish price action, bearish hammers, gravestone dojis, bearish engulfing, long upper wicks with heavy volume. That's what you want to look for to confirm the entry. If you're looking for a retracement for a long entry, you're looking for bullish hammers, bullish engulfing, dragonfly dojis, long lower wicks, bullish price action in that area of interest to then confirm the trade. So this is going to wrap up part 1 of this video. Next, we're going to have our special guest for part 2. But if you guys did find value, definitely make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But let's hop into part 2.
What is up, everyone? Welcome to part 2 of showing how to use fair value gaps. I know you guys learned from Brandon in the last one. Today, I'm going to go through my strategy, how I use fair value gaps, and also just honestly, fair value gaps to me is just like another tool in the toolbox. I trade primarily supply and demand. However, in current market conditions, it's been really hard to find good moves off of supply and demand, at least in my trading. So using fair value gaps has helped me make more trades in current market conditions and honestly just get better results. So I hope this video can help, and I hope this series that Brandon is doing can help you become a better trader. So let's just get into this right now. So today, actually, we're going to look at current price action. You can see it's still live. What time is it? It is 2:21 p.m. here on the East Coast. So we're still trading in session. And today we took a nice trade, actually using a fair value gap. So one thing that I've implemented in my strategy is using pre-market lows and pre-market highs, and also pre-market support and resistance levels. So to get my tool out here, let's get this drawing tool. Boom. All right, so we've seen we had a lot of resistance in the pre-market. We touched once, twice, 3 times. Up in this level is 446.6 to 446.7. So I had that marked out as a key level for this morning. Again, I use the pre-market low, so I mark that one out as well. I also come up here and mark out the pre-market high. As you can see, that's marked out. So I have current levels marked out, as well as if I go to a higher time frame, I come out here and I'll pick up supply and demand levels. I don't have any much charted on my charts right now because of the chop and the range we are in. That's why I don't have many supply or demand. However, this is why I've been using the fair value gaps, because the supply and demand hasn't been working in my strategy lately. So going into the 5-minute time frame, we have those current levels marked out, and we see a rejection off of that resistance, a nice push down. And I like to use fair value gaps as a point of, especially for new traders. A lot of traders say with my supply and demand strategy, they fail to be able to execute because they get nervous. They don't want to just buy puts on supply because it's just tough supply, right? They get a little nervous. They don't know how to enter the position. Well, I always say, well, you can wait for the rejection to happen on the supply and then find a fair value gap to find your entry. And this is the same instance, right? We see price action reverse off our resistance, come down, and then form a fair value gap to give us an entry to capitalize off of this move. So looking at the price action, let's get our little rectangles out here. Price action rejects off that supply and forms a decent fair value gap from here. Oh, sorry, not from here. Sorry. From here to here. Boom. Nice fair value gap. That being said, why is that a fair value gap? Really quick, I'm sure Brandon already touched on it, but the neighboring wick candle comes down to here. The next neighboring wick candle is right here. Therefore, it leaves an inefficiency in this candle right here. Now, the theory is once price action gets pushed back into this inefficiency in this candle, sell orders will get filled, continuing this push to the downside. And we have multiple reasonings, right? We have a reject off of resistance, a fair value gap retest. But what do you notice here as well? Another thing I put into my strategy are the 9 EMA and the 20 EMA. So price action goes and retests the 9 EMA, fails that 9 EMA, gives you a perfect entry. Let's see. Let me just get this little oval tool. Gives us a perfect entry right here to go short. And we can go short here and capitalize off this nice move down. Now, with my strategy alone, what I'll do is once I see this and honestly take my trade, my stop loss is going to be a candle close above this fair value gap. So really sets me up for good risk to reward. And a lot of people get so, especially newer traders, they get so, I would say like mad, or they get FOMO when they miss this nice candle move down and they think they missed the move, when you could just wait for a fair value gap to form and catch it, honestly, at a perfect entry. So you're not really missing out, but you're being patient and waiting for a sniper entry, as Brandon likes to say. So that is really how I use fair value gaps. I love for the EMAs to correlate with this gap, and also having another level to give me confirmation, right? I had this resistance level, gave me confirmation to go short. If I have a supply or demand level, that is ideal. So that's really how I use them. I use them to the upside and the downside. I would have to go through my recent to find a upside one. Let me see. Let's go to the 5-minute 180 day here to find an example. So here's one right here. It's kind of like, extended, but it's still the same theory. So let's go. Boom. Remove this really quick.
What time frames do you use when you're identifying these FVGs?
I only use the 5-minute time frame personally. I know you have experimented with the 2-minute time frame, the 3-minute, I believe. And I don't think that's bad. I think honestly, people ask me, can we use it on the 15-minute? Can we use it on the hourly? I mean, sure, why not? It's all dependent on how, what system you build and what works for your strategy. I feel like for me, I hated trading the 1-minute, and I didn't really like trading the 2-minute. So I feel like the 5-minute gave me the best possible entries, and also I think a little more patience for the move to actually work out and happen. So in my case scenario, I like using the 5-minute. Here we formulate this big fair value gap on this candle. We draw it out here. So why is this a fair value gap? Well, we had this impulse move to the upside. This neighboring candle wick comes up to here. This neighboring candle wick comes down to here, formulating an efficiency right in this little zone in between this candle. See where the body candle is? That's where the inefficiency is. We would have to assume that there's orders being left there and ready to get filled to the upside. This next candle comes down, pushes down, but what does it do? Also touches these EMAs, makes a nice move up. And that's exactly what I wanted to touch on, because the EMAs also gave you another sense of confirmation, a little more conviction, and then we see a nice move up. So again, this is the ideal entries I look for when I'm trading in between zones, or even if I didn't get the entry off the zone, this is what I'm looking for, and what has worked in the last 5 to 6 months, especially in these market conditions. So not only have I seen success with it, Brandon's seen a lot of success with it. I know we've been working on kind of together with this type of strategies, and as well as the Team Bull members have found a lot of success with it. I've taught it in the previous masterminds, and yeah, we found a lot of success as a group. So I think one thing in detail that this strategy does well with is that it gives you a really, really good entry. And when it does fail, your stop loss, a 5-minute candle close out of this zone is primarily going to be a small loss comparable to your winners. Like you see here, if we had a 5-minute close down here, okay, it's a decent loss, right? It's a decent loss, even if the candle closes all the way down here. But again, we entered right here, or let's say we got, okay entry. Let's say we entered right here. We still had this massive upside to capitalize on, right? So either way, we're setting ourselves up a good risk reward. And I believe that it's just one of those strategies where if you're a person that struggles to enter, you have so many ways to have conviction in this trade that you can feel a little more comfortable hopping in, if that makes sense. What do you think about that, Brandon?
I like it. And yeah, we're also going to be doing a video on your channel, so make sure you guys check that one out. I think you'll have it out by the time this video goes up, but pretty much combining fibs and the fair value gaps together. But again, it's just another area to identify where can price potentially retrace to. Like, we don't want to try to chase those huge green candles, because at that point, the risk reward is significantly skewed against us. But being able to identify where these retracement zones are, like the one that you have drawn on the screen, gives us a fantastic risk to reward, because like you said, all I had to do was break below that little red rectangle and we were stopped out of the trade. And then from there we push all the way up into, what is that, 446.6. So I personally really like it. And then if we have other confluences, you know, moving averages, VWAP, Fibonacci, previous supported resistance, etc., just makes it so much higher probability.
Yeah. One other thing I would like to say is, like you said, you put it with fibs or you put it with supply and demand, like I do. We're not getting those supply and demand tests every single day, especially with the way I trade them. I usually use the 1 hour to the 4 hour supply or demand zones. That's why you see my zones be so far out, because I'm using the most prominent in the higher time frame levels to give us the bigger moves. And you know, if you're scared to enter off of those, if you're nervous, this is a great strategy to give you some extra conviction, because I know one of the biggest problems with traders in general is they formulate this plan in the pre-market. They write it in their notebooks and they go attempt to trade it when the price action's live, and then they don't do it, right? They don't execute. They don't have the confidence to do it. And then they see the move actually work out in their favor, and then they end up sizing up, entering the position when it's wrong, and then getting absolutely screwed. And it's all because your mind is playing games with you. You don't have the right confidence. So I think this is just one strategy that can really build that confidence and build your system along with the execution. All in all, I know Brandon uses fair value gaps pretty much the same way as I do. He uses the fibs to get really good levels for the most part as well, and I use support resistance and supply and demand, really the main core of my strategy. I think the past 6-7 months have been a little hard for me with supply and demand levels, so I had to adapt my strategy a little bit and, you know, implement fair value gaps and other strategies. And this is just one where it's worked so well, and Brandon's even said the same thing. It's worked really well in his strategy. So if you're struggling, just know, like, even if you're a great trader, even if you are the best trader in the world, everyone needs to adapt to current market conditions. So doing this boot camp and going through this boot camp that Brandon's doing can help you adapt and help you, you know, build better strategies for all market conditions. And if you're watching this, you're taking that next step to success. So thank you for having me, Brandon. I really appreciate it. And yeah, thank you guys for watching. Peace out.
So personally, when it comes to back testing, what I like to use is TradingView. You can use on demand on Thinkorswim, but honestly, it's really, really slow and it's really laggy. So in my honest opinion, TradingView is probably going to be your best bet when it does come to back testing. It costs like $14.95 a month. It really isn't that much, and it's going to significantly help you in your trading. I talk about this all the time. If you simply come into the market, take one trade, don't go back, journal, review your trades, whatever it may be, you're just getting one repetition in the market. But if you come into the market, you take the trade, you go back and you're back testing, you're reviewing your trades, you're journaling through your trades, you're creating multiple repetitions, which as a result is going to help you in the future as a trader. So personally, when I am back testing, I either do it on the ES futures or the NQ futures. So what we're going to do is we're just going to pull up the ES futures, and when I am back testing, I personally do it on the 5-minute time frame. If you want to play around with different time frames, feel free. 15-minute, 30-minute, hour, whatever it may be. Just personally, I really like the 5-minute time frame. I have found that that is my sweet spot, my bread and butter when trading. That's why I like to do a lot of back testing on the 5-minute. So what I like to do is click this replay button right here and then simply close my eyes. I'm going to look over here. We're just going to scroll all the way to the left, and then we're just going to pick a random spot. I have no idea where we're about to land, and we're going to go right here. Whoops, there we go. Okay, so as we can see, this was in the middle of the session, wherever price may be at this time. Where is it at? Is it? Okay, price is all the way up here. All right, so as we can see, we had a nice little bottoming out here around 9:30. It looks like a little liquidity sweep below these lows over here. Price reclaimed it and then gave a nice push to the upside. Personally, not really seeing a setup here. So we're just going to go bar by bar, see if we can find a setup. I have no clue what's going to happen. So if I take a losing trade, I take a losing trade. If I take a winning trade, you guys are going to see exactly what I'm looking for. But we're simply just going to go forward and we are going to see if we can find any good setups. There was a nice fair value gap right here, gave a nice push to the upside. unfortunately we weren't able to get that. So let's just continue going forward and let's see if we can catch anything in this session. After 12 o'clock, we're just going to skip and go to the next day. Typically I don't trade after 11:30. I just noticed the market really doesn't offer too much opportunity after that time. So we're just going to go ahead and go to 12 o'clock, which is going to be actually right here. So we're just going to skip to the next day, not really seeing anything. As we see, I mean, the market really did not do much after that at all. All right, so the market just opened. What I'm going to do is I'm going to mark these overnight lows and overnight high just in case price wants to give a liquidity sweep up there. Not doing any analysis on the higher time frame. If you want to, you can. Like you can go to a 1 hour, a 4 hour, or a daily and start looking for those higher time frame levels. I'm personally just going to keep it simple on the 5-minute time frame. If you go to a 1 hour or an even higher time frame than the 5-minute, kind of defeats the purpose, just because you're going to see it shows you exactly where price went, right? Price went right up into this liquidity right here. So now I already know there's more than likely going to be a liquidity sweep. So if you are going to be back testing, just keep that in mind, that you are going to see what that full candlestick ends up doing. Okay, so I did end up going short and I was talking through the last recording and of course it froze right after I was on that. I promise you that this is the same exact day. If you want to go back, you can see it August 14th, 2023. I did end up talking through why I went short up at this area right here. So as you can see with the back tester, I went short 2 ES contracts. The stop was going to be above 45.03, which would have been the invalidation point. This is a liquidity sweep right above these highs right here. So as we see, price broke, reclaimed the opposite side, gave a nice little liquidity sweep. I went short 2 contracts. Stop loss would have been above here, ideally aiming for this liquidity over here, even this liquidity right here. We can see if there's some fair value gaps on the way down that we can look to potentially take profits at as well. Obviously, we're only short 2 ES contracts. Now, if we're trading options, obviously we have that that availability to trim more on the way down, but we only have 2 ES contracts. So what I'm going to do, first price target is going to be this daily 20, or not the daily, the 5-minute 21 EMA. And then ideally, we're going to be aiming for down here. So let's see what price ends up giving us. Again, we went short up there. Let's see what we can catch on the way down. Price is coming back up. We're going to stick to the stop loss. It's either going to hit the stop loss or it's going to come down and hit our first price target. So as we see, price did come down and it ended up hitting the first price target. Now, as far as the stop loss, you can see that price didn't really break above the level. All it did was come up and wick at it. So that personally wouldn't have stopped me out. If we start showing strength above the level, that is where I will get stopped out. As you can see, all it did was tag the level and then came right back down on this 5-minute time frame. Personally, would not have stopped me out. So as we see from here, price is now down to, what is that, around 8 points to the downside from the entry. So because price did hit that first price target and actually dropped a little lower, what I'm going to do is just buy one back right now. And then ideally, we're aiming for these lows down here. Still going to keep the stop above here. The trade will still end green regardless. So let's see what price ends up giving. And then from there, if it gets to around 1600, we're just going to go ahead and close out the position. But ideally, what I'm looking for is a break below these lows. Might have to take profits a little early. Let's see if it breaks below. Try to break below, reclaim the level with heavier volume, so not ideal. But again, still going to hold this, see if it can break below the lows, see what it can do, and we're going to stick to the stop loss. All right, so it's getting close to the end of the day. It would be 3:35 right now. Obviously, you know, as a day trader, I'm not going to be sitting here in this shop all day. But again, we're just back testing right now. And as we can see, price is starting to break above that break-even point. So at this point, I'm just going to go ahead and close it out. But this right here is a perfect example of a setup that I would be looking for. So let's go ahead and let's just skip to the next day and see what price can give us. And real quick, if you're looking to trade live with me and a bunch of other amazing traders, make sure you guys check out our Discord. The link is going to be down in the description. We live trade every single morning. A lot of free education is provided inside of this community. Plus, the overall community itself is amazing. So again, if you guys do want to trade live with me and a bunch of other amazing traders, make sure to check out the link to the Discord. The link will be down in the description. All right, so I accidentally skipped over 9:30, but anyways, let's just see if we can find a setup. There was a really good one right here that I ended up missing, a very nice 5-minute fair value gap, but anyways, let's see if we can find a setup. We do have a nice pivot high, pivot low here. So let's see if we take a nice fib trade. Let's see if price can come up towards that 50 or 61.8, maybe even an earlier entry after that. Let's just wait and stay patient. If price breaks below the lows, probably not going to be interested. So let's see, we're getting pretty close to that 50% retracement. Not a lot of volume. So depending on the smaller time frame, maybe validated an entry. But I'm just going to skip to the next candle. If the next candle confirms it, then I will try it. So nothing that I'm really seeing on this 5-minute candle right here. Still no entry. And then as we can see, price came up. See if it can hit that 61.8. Maybe that ends up confirming an entry. Also, it kind of looks like we're forming this little 5-minute bear flag right here. So let's see what price ends up doing. Maybe it can hit the 61.8, which would be the upper range of that bear flag. Or maybe it just breaks below and we can look for a nice little put entry. So let's just go ahead. Still waiting for a setup. Got very close to that 61.8 and heavier volume on that sell. So let's actually go ahead and let's just try one contract for the time being. And the stop loss is going to be a couple points above these highs right up here. So maybe around like 44.82. And then ideally looking for the breakdown to the downside. So let's just see what price ends up doing right there. Had a very nice drop to the downside. Had another nice drop and then a reclaim. Let's see what it does from here. Hopefully it doesn't bounce to the upside, but we're going to stick to the stop loss. Again, if we're trading SPY options, obviously I would have been trimming by now, but I only have one ES contract. So you guys have to keep that in mind, but just going to keep the stop loss still above those high points right there, unless something with the volume tells me to get out of the trade. Let's see if price can take out these lows and then I'll be willing to close out the position from there. There we go. There we go. There we go. Let's buy it back. Boom. So that's just trade number 2. Was able to catch this from 44.74.25 all the way down to 44.62. Now, again, this wasn't an ideal setup for me, but if I were to take 2 contracts, I would have trimmed one here, put my stop loss at break even, and then ideally aim for these lows down here. Let's see if it ends up doing it. Actually, it looks like we got a pretty good exit on that because price just sat there and consolidated for a majority of the rest of the day until here. So let's just go ahead until the next day and see if we can find another setup. All right, so let's make sure we actually start this at 9:30 this time. We have 9:15, 9:20, 9:25, and then we do have a nice potential liquidity sweep below, or actually it looks like it already tried to do it. So it looks like price broke below these previous lows right here. It looks like it's trying to potentially reclaim it right here. What I would like to see is a bullish hold above this level right here, this 44.47, and then ideally get long and aim for these highs up here. Again, I have no idea what's going to happen. I'm just on a 5-minute time frame. I'm not doing any higher time frame analysis. Now, if price just breaks below these lows, obviously we're looking for more downside. So let's see what ends up happening. Let's go ahead and do the next bar right there. All right, so nothing really screaming to get long. So just going to go ahead. Let's do the next candle. And of course, it just went ahead and exploded without it. So potentially no trade here. Let's see if we can get a liquidity sweep up at these highs up here. Man, that would have been a nice trade. So again, nice little liquidity sweep below these lows. Nice little reclaim. Just really didn't see anything on the 5-minute telling us to get into the trade. And of course, we wanted to push to the upside. So let's see if it does want to give us liquidity up there. Also, what we could look for potentially could be this pivot low to pivot high right here for a potential bounce. So let's see what ends up happening with this. Not really seeing anything on this 5-minute time frame that's telling me to get long. All right, so price did end up popping off that level, but personally didn't really see anything on the 5-minute that was telling me to get long. If anything, I'm more interested in a short up at this area. So let's see if price can get up there. All right, so it looks like we did get a nice little double top up here. Maybe if it comes up and it does a triple top, I'd be willing to short with a stop loss above these highs. Right now, it's just consolidating, nothing too interesting in this setup. So it looks like a potential triple top up here. What I'm gonna do is let's try one sell. Again, not a very high probability setup, but I'm just walking you guys through what I like to look for when I'm back testing. And the stop loss is just going to remain above this high. As far as a price target, I mean, I guess I would like to see a break below these 2 lows right here. So let's see if price ends up doing that. Again, I could get stopped out of this trade. I have no idea what's going to happen. All right, price is breaking down. It looks, I'm not a big fan of those wicks right there. Again, if I'm trading SPY options, I would have already trimmed at this point. So let's just see if price breaks this trend line. If it breaks the trend line, I'm willing to close the position. There we go. Let's see if they hold it below. So again, we have the option. Do we want to close the position? If we're in SPY options, obviously we are trimming and moving our stop loss. Let's just go ahead and give it one more candle. Beautiful. Just going to buy it right there. So from 44.61.75 all the way down to 44.50.25. Let's go ahead. Let's go to the next day. And it looks like price wanted to go a lot lower than that. But again, with options, it is going to be completely different. So as we see, price ended up dropping all the way down to these lows down here at 44.17 or 44.18, whatever it may be. And let's just go ahead and continue from here. Let's wait until the very next day and let's see if we can find another setup. Got to make sure to pause it at 9:30. All right, so let's see what we got going on right here. So it does look like a lot of rejection up at this 44.36. If we could get a liquidity sweep above that high right there, I'd be interested. Maybe there's a fib that we could also use from this high all the way down to that low. Let's see. Let's just go ahead and take it. Let's try pivot high, pivot low. So it looks like that's around that 61.8. Also, let's see if we go to, I don't want to do a higher time frame because it's going to show me what ends up happening, but let's just go ahead and see. We could also take this high, yesterday's high, all the way down to that low point right there. And as we can see, also that 50% retracement. So obviously we now know that that candle is down, but I wanted to look and see about that 50% retracement. So yes, we already know what's going to happen, but I would be willing to short around this high up here because it's close to that 50, or even a liquidity sweep at those high points right there. Also, we do have a nice little trend line right here. So let's just go ahead and take that right there. So let's just go ahead and see if price ends up giving us anything to work with. Looks like it might try to break down without us. Looks like that's what it's going to do. Also, it does look like there was a possible fib inside of this and price came up to reject it. But we are going to see if we can find some type of setup. As of now, it's looking pretty top heavy. It looks like they want to try to pull it to the downside. But let's see if we can find a potential setup here. Okay, so a lot of volume on this 5-minute candle at 9:55. Let's see if it can lead to something. Okay, so we do have a nice high point right here and a low point right here. It looks like we rejected off of that 50% fib right here. We have that 5-minute 21 EMA right at that 61.8 at 44.29.75. In this scenario, more than likely what I would do is do about half my position and be willing to add the other half up here with a stop loss a couple points above this area. So because we're trading futures, let's just go short one contract. Again, using a smaller time frame, we more than likely would have gotten a better entry closer to this 50%. So I'm willing to add one, maybe add another one up here. Let's see what price ends up doing. Ideally, looking for a new low of the day down here. And then that would be my trim point. But let's just go ahead and let's go to the next one. As we can see, price then got very close to that 21 EMA, dropped all the way down near that low of day at 44.20, giving, what was that about? About like 4 points, nothing crazy. Yeah, 4 points to the downside. And you can see stop loss hasn't been hit yet. Ideally looking for a new low. Again, could still get stopped out on this trade. I'm not trimming yet. But again, when you're back testing, this is what's going to help you a lot when it comes to your trading, because you could look at this and be like, oh, well, we rejected the 21 EMA here. Buyers tried to buy us up right here, came back up, pretty bearish candlestick off of that 21 EMA again, plus that 50% retracement. Okay, let's keep our stop loss above here. And there might be trapped buyers who are trying to buy down here. So if we take out these lows, I'm assuming those buyers are going to get stopped out, and a potential spot that we can aim for in this trade is actually going to be these lows over here for a potential liquidity sweep. Again, if you're trading SPY options, I don't know why this won't click, but if you're trading SPY options, you have a lot more wiggle room than just one ES contract. So let's see what price does. Boom, it made that new low right there. Obviously, I should close out the position. If you're in SPY options at this point, you want to be looking to trim your position even more. But let's see if price gets down to these lows. We'll just trail the stop loss at break even, maybe a liquidity sweep down at this 44.09, and we can look to ride it back up. So let's see what ends up happening from here. And it looks like I would have been stopped out on the position at break even. But again, like I said, what we would be doing is trimming on the way down and moving our stop loss. Obviously, the stop loss got hit at break even, but I'd still be willing to watch this down at these lows. It looks like it wanted to come snag that stop loss before making that next leg down. Yes, indeed it did. Anyways, let's continue to watch this. If it gives a nice liquidity sweep, honestly, would be willing to do 2 contracts on this ES. It's getting very, very close. Let's see if we can get it. Very close. Of course, you're not going to get it. You got so close and you didn't want to do the liquidity sweep. We might get it. All right, let's watch it right here. Price just swept below these lows. Let's see if it can reclaim it. And if it does with heavier volume or bullish candles, I'd be willing to try a long position with a stop loss right below that 44.09 area. So Let's see if it reclaims. If not, we're just going to go ahead and ignore this setup altogether. So does not look like it wants to reclaim the area, and no. Anyways, that's going to wrap up back testing. Hopefully that helped you guys out, and just some examples. They weren't anything crazy. Again, what I like to do when I'm back testing, close my eyes, choose a random date on a 5-minute time frame, and then look for potential setups. If you want to, you can use the higher time frames. You just got to realize that it's going to show you exactly what that time frame candlestick is going to do, which is why I wasn't really doing it in this example. So if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video. All right, so a common theme that I see a lot of people struggle with is they have green trades turning into red trades, green days turning into red days. So we're going to discuss that first, and then if you're someone who keeps having red day after red day, we'll then discuss that. Alrighty, so I want to break down my risk management strategy and how I go about my position sizing on a daily basis. So when it comes to trading, typically my first trade is going to be my largest position, unless it's not the highest probability setup, or maybe I only get a starter position, or whatever the case may be. But typically my first trade is going to be my largest, and I want you guys to kind of look at this like just a regular pyramid. Now, bear with me, my hand drawing is literally like a first grader, right? That might actually even be a compliment, more like a kindergartner. So this is going to be our pyramid right here, and this is going to be trade number 1. This is typically where I am going to use the most amount of size, right? Now, I want my first trade to be the highest probability setup. And like I said, if it's not super high probability, but I still see the risk reward, I might just use a lighter size. So again, first trade is going to be the largest size right here. If I take a losing trade on my first trade, I'm not going to go into the second trade with the anticipation of making back everything from trade number 1. If that happens, great. That's fantastic. But if I take a large losing trade for trade number 1, I'm not going to take another trade unless it is super high probability. Now, what I want you guys to keep in mind is if I have 2 losing trades in a row, I am done if my max stop loss is hit. Now, I could end up getting out of the trade for a small paper cut. Say I'm looking at price and I'm like, oh, this really isn't going to move in my favor, and I just get out for a small loss. Okay, if I do that 2 times in a row, then I'll still keep looking at the market. But if I have 2 trades that hit my max stop loss in a row, I just call it a day and I will come back the following day. That is something that I really want you guys to write down in your notes, because I see people that have 2, 3, 4 losing trades in a row and they will continue to trade trying to make that money back. Guys, that is how you are going to blow your account. So if your max stop loss is hit for 2 trades in a row, close the screens, call it a day, and come back tomorrow. So now when it comes to trade number 2, I'm only going to be risking some of my profits from trade number 2. That way I am guaranteed green on a day. A majority of the time, this is what I'm going to do unless I see a really high probability trade. Then okay, I might risk all of my profits from trade number 1, but still at least end the day around break even. But typically it's going to be risking some profits out of trade number 1, maybe half my profits for the day, maybe a quarter of my profits for the day. If this trade right here, the second one, ends up being a loser, then if I see a third setup, one, I'm going to be very selective, but then from there, I'm only going to be risking a little bit of profits from trade number 1 as well. That way I can still guarantee that I end green on the day. Now, if trade number 2 were a green trade, and I do see a really good setup for trade number 3, typically I don't go over 2 trades a day. And if you are looking to learn more about my overall day trading and swing trading strategy, how I find bounces, rejects, support and resistance, price targets, Fibonacci, all the indicators I use, and so much more, make sure to check out my 450-page book on Amazon titled The New Age of Technical Analysis. If you are interested in learning more about my strategy, make sure to check out my book, The New Age of Technical Analysis, on Amazon. The link will be down in the description. But there are those cases where I will see a third setup, and if I were to take a third setup, I'm only going to be risking some of my profits from trade number 2 and trade number 1. I'm not going to go in using all of my profits from the first 2 trades, and if the trade were to go against me, then end red on the day. Again, I see a lot of people doing this. They'll have 2 nice trades and then they give everything back on trade number 3. That is just greed. Those people are trying to make $100,000 in a day. If you have 2 beautiful trades previously, risk a little bit of profits. That way, if your stop loss is hit, you are still guaranteed green on the day. Now, say trade number 3 is a winner. Okay, if I were to take a 4th trade, which is pretty rare that I will take 4 trades in a day, but it happens sometimes, okay, then I'm only risking a little bit of 3, a little bit of 2, a little bit of 1. So what I want you guys to notice is as I'm taking more and more trades, my position size is going down each trade that I take. So if this was a winner, okay, trade number 2, I'm going to be risking some of my profits from trade number 1. Again, it could be half your profits, 3/4 of your profits, but either way, you are still guaranteed green on the day unless the trade is really high probability. Then okay, maybe I'll risk all my profits and risk going break even, slightly red. But if trade number 2 is a winner, okay, if I take trade number 3, I'm risking some of my profits from 1 and 2. Say that's a loser, more than likely going to call it a day there. But if it's a winner, trade number 4, okay, then I'll risk some of my profits from here. Now, if 4 is a winner, it is very rare that I'm taking 5 trades a day. And honestly, you probably shouldn't even be taking 5 trades a day because at that point, you're just over trading. In reality, there's not typically 5 high probability setups every single day. So if anything, I would say you want to stick around this range right here, 1, 2, 3 trades per day. So if you're somebody who constantly is finding yourself going from green day to red day, try this out. Let me know how it works. Now, if you're also somebody who is in green trades, and we're just going to go ahead and close this, but if you're somebody who constantly finds yourself having a green trade ending red, try this out as well. So what I see a lot of people do, and the main thing is going to be greed. Again, people are aiming for these ridiculous price targets and they want to see more out of price. The main thing that is going to help you understand if you should be getting in or out of your positions is just going to be strictly price action. Now, before you ever enter a trade, as we discussed in the, I think it was the stop loss videos, you should always understand exactly where your stop is going to be. Where is your invalidation point? You can use the option chart. That way you understand, okay, I'm willing to risk this much. As you get into trades, this was a trade that we did end up taking earlier in the Discord. We were able to catch a nice pop to the upside. We took it on SPY using SPX. But if we head on over to SPY, you need to understand, okay, where am I going to be taking profits? Because could this thing have gone all the way back up to the opening print? Of course, but we want to be taking profits on the way up as well because we don't know if price is going to reverse and start coming back down. So we want to set areas that we can lock in some profits. That way we are taking risk off the table. And if price wanted to continue to go all the way back up into these highs, awesome. That's why we trim the position and move the stop loss up. So as price starts trading up into the 440 area, which was previous support turn resistance, that is where we got our first trim. And then the second trim was as price came up and hit VWAP. If you were just trading with hope and really just hoping that price came up here, you more than likely didn't take a trim. And I know a lot of people do this on a daily basis. They don't lock in profits. They don't move their stop loss up. Again, you could have taken profits at 440. You could have taken it at the 8 EMA. You could have taken it at VWAP. There was multiple opportunities to trim in profits, especially because SPX was coming down towards that 4,400. So there was multiple opportunities to trim on the way up. And again, move your stop loss up. If price is going to continue to push, great. That's why we have our runners. But if price starts pulling back and you haven't trimmed your position yet, that is how you are going to start having those green trades turn into red trades. If this sounds like something that you struggle with, what I want you to do is start taking partial trims as price starts moving in your favor. Obviously, you want a 1-to-1 risk to reward, but you can use previous support or resistance areas, moving averages, VWAP, etc. to identify trim areas. As those trim areas are hit, make sure you're taking off some of your position. That way you're locking in profits. And if price starts pulling against your position, you're more than likely still going to end the trade green, maybe even slightly green, maybe at break even, but at least you're not walking away with a large loss. Because if you weren't taking trims on the way up, as price pulled back and hit your stop loss, you're now ending the trade red when you should have been ending the trade green. So again, lock in profits as it moves in your favor and move your stop loss up. And then finally, if you're somebody who is just constantly ending your days red, I do want to discuss a little bit about how I go about my position sizing. Now, if you guys have not seen my stop loss video, I highly suggest you guys go watch both of them because as I'm looking to enter a position, I always have the option chart up of the option that I am watching. Now, I always want to get in for as close to my invalidation point as possible. That way, the risk to reward is significantly skewed in my favor. Now, as price is trading close to where my invalidation point would be, I look at the option chart and I'm like, okay, the option was trading at this price at this time. If price were to come up to my invalidation point, I would be willing to risk X amount of dollars. From there, I can determine how big of a position am I comfortable with. If I were to look at the chart and I'm risking $40 per contract, I would size smaller than if I were to trade something with a $15 loss per contract. I see a lot of people, they always position the same exact way in a trade, but it's always going to depend what is your max risk per contract. If your max risk is $70 per contract, you're going to be using a smaller position size than if your max risk was $20 per contract. So keep that in mind the next time you go about position sizing. And also you just want to make sure that you're not over positioning yourself. Again, if you watch that stop loss video, you're going to have a very good understanding on what is your max risk per trade. If you buy, let's say, 20 contracts with a max stop loss of $20 per contract, your max risk is going to be around $400, right? If you're not comfortable with a $400 stop loss, you should not be using that position size. If you're only comfortable with losing, let's just say $200, then you should only be trading 10 contracts. If you're not comfortable with a $200 risk and you're only comfortable with 100, then you should only be trading 5 contracts. Again, it's always going to depend. How much is my loss per contract? How much am I comfortable with losing to figure out if I am correct in this trade? And then that is how you understand how many contracts you should buy. Again, no trade ever should blow your account. No trade should ever screw you. No trade should ever F you, right? You always want to take calculated risks in the market and never over position, because that is how you are going to blow your account. But that is going to wrap up risk management. Hopefully you guys did find a lot of value in this video. And again, if you are not caught up with all the current bootcamp videos, I think we're on day, what are we on? Day number 22. Definitely make sure you guys head on over to the YouTube channel and get all caught up over there. But as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. We're getting super close to 60K subscribers, so I appreciate every single one of you. And make sure to do that daily check-in, comment down below letting me know you guys are still rocking with me. Everybody have an amazing rest of your day, and I'll see you guys in the next video. Position sizing, right? I see a lot of people, they'll over position on one trade and they'll blow half of their account, or they'll over position all day and it leads to a blown account. I'm going to be showing you guys how to understand what your position size should be in every single trade. So what we can do, because ES is trading at this 61.8% retracement, we can look at this and be like, okay, well, price has made a massive move to the upside, as we can see this pivot high to pivot low right here. Or actually, no, it's this pivot high to pivot low. But price is trading right at that 61.8% retracement. So we are trading at an area of interest, right? As we can see on the 5-minute and even the 2-minute time frame, price had a pretty strong reaction to that level. Say we wanted to go short. Let me just see what SPY is trading at real quick. So I like to use both SPY and ES in conjunction to each other. So as we can see, SPY, when it came up and it rejected off of this area, it's currently trading at 443.33. So we know that SPY is trading at this area. We would more than likely, if we're looking for puts, go with the 443 puts. So what we're going to do is we're just going to type in SPY right here, get an active trader set up. If you guys haven't seen my active trader video, I highly suggest you guys go and watch that. I show you how to set up your active trader. That's just the default. But if we were looking to trade SPY, I wouldn't be trading 0DT. I'd be trading tomorrow's expiration. So if we just go ahead and we pull up the 443 puts for tomorrow's expiration, we can see that when price traded up into this high point up here at 443.62, the contracts were trading at a low. The puts were trading at a low of 1.34. So say we waited for this 5-minute candle to close, well, we can see that the options, when they close, were trading at 1.41. So because we can visually see the contracts traded at this low of 1.34, say we get an entry of 1.41. Where is our stop loss going to be? Where's our invalidation point? If ES started breaking above that 61.8, which is going to be at 4453.75. So I would say give this a couple points to the upside above this high point right here. So stop loss around, I would say 4457, give or take. So 2.5 points above this high point right here, just to give it a little room. So if we head on over to SPY, 2.5 points is going to be about 25 cents, give or take. So our stop loss on this trade is probably going to be around, I don't know, 443.85 to 443.9, give or take. So this is where our stop loss would be. This would be the max amount that I am willing to lose on this trade. So we can look at this and say, okay, if we got short at 1.41, if price were to start breaking above here, the contracts are going to break below 1.34. So we can say, okay, if we give this thing about 25, 30 more extra cents of downside, we could conclude that our stop loss is probably going to be around 1.2 to around 1.25. As you continue to trade, you'll be able to calculate this a lot quicker inside of your head. So we know that we are willing to lose around roughly $15 to $20 if our stop loss were to get hit all the way up here at this 443.9. So then from there, we can go about our position size. Let's just say that we were willing to risk the whole $20 per contract. This is where you have to ask yourself, how much are you willing to risk to figure out if you are correct in this trade? So if our max stop loss is going to be $20 per contract, we have to sit here and say, okay, Am I comfortable with losing $200? Am I comfortable with losing $400? Or are you only comfortable with losing, let's say, I don't know, $100, whatever it may be? This is going to depend on you as a trader. You need to understand, how much am I willing to risk on this trade? And if I were to lose this trade, it's not going to blow my account. I'm not going to lose half of my account, or whatever the case may be. Only you are going to know that answer. If you're not comfortable with losing the $200, then size down. If you're not comfortable with losing 100, then size down. If you're only comfortable with losing $40, then all you're going to do is take 2 contracts. Again, it just really depends on you as a trader and what your risk is going to be. Again, it's really going to depend on you as a trader and what you are comfortable with losing. You never want to get into a trade and then oversize and then the trade go against you, because what's more than likely going to happen is you're going to start making a lot of mistakes. Say in this scenario, again, you understood that $20 was your max risk, but you went in with 50 contracts, right? That's going to be $1,000 of potential risk. And as this thing goes against you, maybe the contracts only dip down to 1.3 from 1.4, and you're down $500 when you aren't even comfortable with losing $500. What are you more than likely going to do? You're going to cut the position early because you're not comfortable seeing that loss or having that loss. Even though your stop loss was never hit, you're more than likely going to freak out, cut the position, and then just see price continue in your favor. Let's go ahead and let's just take another look at another example today. Let's just pull up, I guess, Microsoft, because I know Microsoft bounced off this 61.8 earlier. So let's say we're looking at Microsoft. It had this nice pivot low, pivot high, traded right back to that 61.8. Let's pull up the 1 minute time frame. And as we see, price came down. It started to bounce right off that 61.8. So let's just go ahead and pull up the Microsoft contracts. Since Microsoft was trading at, what is that, 324, we would have been looking at the 325 calls. Now, if we break this down to a 1 minute time frame and we go ahead and what time was this? That was at 9:39. So let's go ahead and scroll over to 9:39. We can see as price started trading down towards these lows right here, the Microsoft contracts traded at a low of 3.1. So now in this scenario, we could say, okay, our invalidation point is literally if price starts breaking below this 324. So we could say our stop is going to be around 323.8, give or take. Say we waited until the end of this candle to get long. We wanted to wait for that confirmation, which you always should wait for confirmation on the candle. So you would have gotten long around 324.3. Again, that's at 9:39. Here's our 9:39 candle right here. You more than likely would have been filled around 3.25. So now we can say, okay, if price started breaking below this low right here and got down about 20 cents, our stop loss should roughly be around, I would say, 2.95 to 3, give or take. So let's just mark this area right here. So as a result, you should be comfortable with losing around $25 to $30 per contract. Now, again, how much are you willing to risk on this trade to figure out if you are correct? Because obviously you can see price significantly climbed to the upside today, but how much money are you willing to risk on this trade? If you're comfortable losing $300, then you'll go 10 contracts. If you're comfortable losing $150, then you'll go 5 contracts. If you're only willing to risk $60 on this trade, then you'll go 2 contracts. If your max stop loss is hit, again, it should not blow your account. It should not ruin your day. No trade should ever destroy you or screw you or F you, because every single trade we take is a calculated risk. When I go and I position into my trade, I know how much I am willing to risk on that trade to figure out if I am correct. If I am wrong, I accept that because I knew before I ever entered the trade, this is how much I am willing to risk on this given trade. So that's the little trick that I like to use to understand what is my position and how much am I willing to risk. Again, have the chart of the contract pulled up that you're willing to trade, and then look and see where was that contract trading as price hit your validation area. And then as we know, okay, invalidation points, where is it? And then we can make a guesstimate of where those contracts will be trading, which as a result can help us understand, okay, I should buy 10 contracts, 20 contracts, 50, 100, etc. So that is going to wrap up this video on position sizing. Again, this is a very important video, probably one of the most important of this bootcamp. If you can't control your position size, those losses, they are going to add up and eventually blow your account. So make sure you guys are positioning correctly in your trades, be comfortable with the risk. And as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video. Alrighty, so journaling. I do want to point out that there's no right way to go about your journaling. I get asked all the time, like, how do I properly journal? And again, there's no right or wrong way to go about it. So some things that I like to make note of when taking a trade, and we can just come up with some trades. Let's, I don't know, let's look at, I guess, Tesla today. I don't know what Tesla did. So let's just say with Tesla today, you ended up trying a bounce down here at 232.30. Or actually, let's head on over to the QQQ trade that I ended up taking today. So I actually ended up taking a nice QQQ bounce down here towards this 369 live inside of the Discord. Now, the whole reason why I like this level is because if we go ahead and we take this pivot low to pivot high on the Fibonacci retracements, you can see that we had this 50% retracement at 369.02. So when I go back and journal later on today and I go and review this trade, I'm going to start writing down, why did I take this trade to begin with? We had a 50% retracement, a level of interest, and then as we break it down to smaller time frames, 1 minute, 2 minute time frame, we're going to notice that price had a pretty strong reaction off of that level. So as a result, we were able to catch a nice little scalp to the upside. It wasn't anything crazy, about like $1 pop to the upside. Again, nothing too insane, but I'm going to talk about what I could have done to then increase the profits by flipping the other direction. So we'll come back to that here in a second. So the very first thing, what was the trade I took? QQQ calls. Why did I take it? Fibonacci bounce, plus we had a bullish reaction off the level. Now from there, I'm also going to discuss my trims. I will say my first trim on this trade honestly was not the best. The reason why I ended up trimming was because SPY was actually moving, but QQQ wasn't. So that was pretty much out of my control. So as we can see, SPY actually rallied pretty hard to the upside. And as we see, SPY was actually coming up towards that 61.8% retracement, which could have been a possible reject area, which is why I was willing to trim QQQ a little early on this trade, because I didn't know if QQQ was going to start pulling back because SPY was actually moving, QQQ wasn't, and SPY was coming up to a reject level. Now, also at the same time, I was aiming for that 370 area, 370 just psychological resistance. And also at that point, we did have a nice little fair value gap inside of that 370. So I thought that would be a good first trim. And then as SPY was coming up towards that high a day at this 445, again, psychological resistance plus previous high a day, double confluence at that area that it could lead to a reject. That is why I ended up trimming again. So as far as the first trim, the risk reward wasn't the best, I would say. But again, it was just that kind of scenario where QQQ really wasn't moving when SPY was, and I didn't want to get stuck bag holding. Now, how I could have increased profits was if we go back to that QQQ, and this is exactly what I'm going to do when I go back and journal today, what I could have done, and I didn't see this at the time, was as QQQ was moving up on this 5-minute time frame, again, SPY had this massive rally, came back up, hit that high a day. Well, while QQQ was moving to the upside, what do we see on the 5-minute time frame? We have volume here, not heavier than these previous 5-minute candles right here. We have lighter volume right here, and then on that third candle, we get a doji with very light volume, which actually went right into the 8 EMA, which could have led to a short position. So what I should have done, because I ended up selling the rest of my QQQ calls right above break even, what I should have done was sold those and then flipped short with a stop loss right above this 21 EMA. So again, when I go back and journal, what I'm going to do is I am going to talk about how I could have flipped short because the risk to reward to the downside, because then at that point, the risk to reward to the downside made more sense than the upside. So yes, we were able to catch a nice little scalp off the 50% retracement. But then if we look at this, we have 3 decreasing candles in a row. We have the 8 EMA, we have a fair value gap, plus price failed to close above 370. So I could have flipped short with a stop around, I'd say 370.5, 370.6, and I could have caught this entire move to the downside. Unfortunately, I did not. And that is what we discuss in our journals, how we can improve our trading going forward. So not only am I discussing the trades that I actually took, but I'm also discussing trades that I missed. And also at the same time, what I am doing is I am screenshotting all these trades that I take, losing trades, and even missed trades. Put them all into a Word document. Trust me, it is going to help you out a lot. That way in the future, you have something to come back to and reference to. And if you haven't already, make sure to check out my book, The New Age of Technical Analysis, on Amazon. My second book is going to be dropping in a week and a half. So I'm very excited for you guys to read that one. I am going to say you need book number 1 to fully understand book number 2. So make sure you guys go pick up a copy, and the pre-orders for book number 2 are going to be up this Sunday or Monday evening. Again, I'm super excited for you guys to read that second book. Yeah, make sure you guys check out book number 1. The link will be down in the description. Now, also, you want to journal through your emotions. If you're somebody who hesitates when it comes to your trading, let's just pull up I don't know. Let's go to I guess AMD. Let's see if AMD even gave a setup today. Not really any setup today, actually. I don't know. Let's just go SPX, right? So let's just say you're looking at SPX, and honestly, I don't see really any good entries on here. But if we just go to the 15-minute time frame, say you're looking at price, it's coming down to your area of interest, let's just say 4,400, and you end up hesitating to get in your position, or you start thinking that the trade's going to go against you, so as a result you don't end up taking the trade. Whatever the emotion may be, even if it's greed, doesn't matter. You want to journal about it, because trust me, that is going to help you a lot. If you find yourself second guessing every single time a trade gives you a setup, you need to go back and you need to journal, what are you thinking before entering that trade? So again, say, I don't know, just say price pulled back down to this fair value gap right here on SPX at around like 44.02. It gives a bullish reaction and you don't take the trade because you're thinking that this trade is going to go against you, and as a result you don't take the trade. That thought of you losing money is what is causing you to hesitate, and as a result you are missing out on profits in the market. There's no way to know if this is going to be a winning trade or a losing trade unless you take the trade. Now obviously we want to be using proper risk management, so if you did not see my videos on stop losses as well as position sizing, I highly suggest you guys go watch that. Those links will be down in the description. So when you're journaling, not only are you talking about the trades you took, you also want to talk about missed trades. Maybe it's not something that you saw at the time. Maybe you hesitated. Maybe you second guessed yourself. You want to talk about emotions. Did you take a dumb trade? So say you tried to bounce SPX at, or let's just say you tried to buy the breakout of SPX right here, and it went against you. There really was no confirmation to try to go long above these high points right here, because price already made a massive move from 44.40 all the way up to the breakout of 44.55. Now, could it have continued to push to the upside? Of course it could have, but that is just such a large move to the upside, to the point that the risk to reward really did not make too much sense. So if you take a dumb trade, why did you take the trade? Did you force the trade? Did you have FOMO because your original entry plan was down here and you just saw price continue to push to the upside, continue to push to the upside, and you're like, you know what? I can't take it anymore. I gotta enter the position. And as you continue to write in your journal and review your journal entries, that's also really important as well. I like to review some of my journal entries before the market even opens every single day. You're gonna start noticing recurring patterns inside of your trading. So again, if you're somebody who hesitates to start taking trades because you have that thought of losing money, you're going to start seeing that inside of your journal. So if you go back and you're like, wow, the last 4 days I missed out on a beautiful, profitable trade just because I thought that I was going to lose money, you're going to identify that that is what's wrong with your trading. And then from there, you can work on removing that thought entirely. So pretty much what journaling is going to do is it's going to help you identify your strengths, but also identify your weaknesses. And then from there, obviously you want to work more on your strengths, and you want to start working on eliminating your weakness. But yeah, again, there's no wrong or right way to journal your trades. Write down what is most important to you and make sure that you're doing it every single day. Don't just journal if you're on a losing spree or you're losing money in the market. You need to be doing it on your good days and your bad days, because when you go back and you read through your journal on your good days, you're like, wow, I did this, this, and this correctly. And then you go back on your bad days and you're like, wow, I did this, 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 and this wrong. So it's going to help you identify patterns in your trading. And trust me, if you do this every single day, it is going to significantly help you in your trading. So to sum everything up from this video, screenshot all of your trades, winning trades, losing trades, missed trades, even scenarios, so specific setups that you see in the market, why you ended up entering a trade. Was it a winning trade? Was it a losing trade? Why do you think it was a winner? Why do you think it was a loser? That was something I forgot to bring up about losing trades. When you do have losing trades, go back and really try to break down the chart and understand, why was this a losing trade? Maybe the volume wasn't in your favor when you thought that price was going to bounce, or whatever the case may be. Try to figure out why the trade was a loser, because again, that is going to help you identify scenarios in the future to help you avoid that position altogether. And remember to talk about your emotions, review your journal, and make sure you're doing it every single day. But that is going to wrap up this video on journaling. If you guys have any questions whatsoever, feel free to comment down below, let me know, and I will be answering them. But as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video. Alrighty, so like I said, we're going to be discussing emotions and psychology. And honestly, I'm just going to keep the camera larger because we're not really going over too many technicals. So when it comes to trading, every trader is going to struggle with their own emotions. Everybody's is going to be different. When it comes to trading psychology and emotions in general, you have fear, you have FOMO, you have anger, you have greed, and the list goes on and on. So what I'm going to do is go over the emotions that I face as a trader, and I want to show you guys how I was able to overcome them. Now, one thing I want you guys to keep in mind is these emotions, they never go away. But as successful traders, we know how to suppress those emotions as they arise. So something I personally struggled with in my trading was hesitation. And it's not like that hesitation went away forever. Sometimes it will still pop up. I just know how to get over it. So hesitation could happen for a number of reasons. If you're a newer trader, I do expect hesitation to be something that you do struggle with just because you don't have enough experience in the market, right? So if you just came into the market and you've been trading for about a week and you go and you try to use Fibonacci retracements, well, you don't have that experience in the market yet. So you're going to more than likely hesitate because you don't know what to look for in that trade. So experience is going to be a big thing that is going to help out with hesitation. As you experience things over and over, you're going to start knowing what to look for in a trade. And then from there, it should become automatic. Another thing that could cause hesitation is the fear of losing money or the fear of being wrong. So let's face it, as human beings, we don't want to be proven wrong. It is like the number one thing that we absolutely hate. But as traders, we have to accept the fact that we are going to be proven wrong in the market. And when we are proven wrong, that is when we have to get out of the trade immediately. If you don't accept the fact that you're wrong, that is how you are going to blow your account, because you're going to continue to stay in the trade. You're going to find every single reason to average down on the trade. And as a result, what's more than likely going to happen is you are going to blow your entire account. So accepting the fact that you are going to be proven wrong in the market is going to be key to your success. And the same thing when it comes to losing money. We're going to have losing trades, right? Your account is never going to go straight up. You're going to have your highs, you're going to have your lows, you're going to have your highs, you're going to have your lows. So it's just going to be a slow uptrend chart as long as you know what you're doing. Hopefully it's not straight down or a slow little downtrend, but over the long term, it's going to be like an uptrend on a chart. So once I was able to accept the fact that it's okay to be wrong in the market and that it's okay to lose money, because over the long term, if you do have a proven profitable strategy, you are going to make that money back and more. Which part of this bootcamp is to teach you my winning strategy. So if you guys haven't checked out any of the bootcamp videos already, make sure you guys do so. I got like 24 bootcamp videos up on my channel plus 750 free videos. So if you're not taking advantage of that, I highly suggest you do. And the final thing that helped me overcome my hesitation was just doing it, just like Nike says. But you have to force yourself to enter the trade. So let's just say, you know, you're looking at liquidity sweeps, you're looking at Fibonacci's, whatever it may be. Again, as you gain that experience, you know what to look for when it comes to liquidity sweeps, fair value gaps, Fibonacci, whatever it may be. You accept the fact that you are potentially going to lose money. You accept the fact that you are potentially going to be proven wrong. Now from there, you literally just have to force yourself to enter that trade. And as you continue to force yourself to do something over and over and over and build that repetition, it's going to help you a lot when it comes to your hesitation. So if you're experiencing fear in the market or hesitation in the market, they kind of go hand in hand. But also something that I want to point out is as traders, these emotions, they don't just randomly come out of nowhere. More than likely, you have experienced these emotions somewhere else in your life. So something that helped me a lot overcome my emotions and what I personally faced as a trader was sitting down and writing down every single scenario throughout my life that could have potentially led to fear in the market or hesitation in the market. I love using this example. Say in high school, you got called on by your teacher multiple times, and every single time you answered the question wrong, and all the kids laughed at you because maybe you said a dumb answer. I don't know, whatever the case may be, right? More than likely, the next time the teacher wants to call on you, you're going to hesitate. You're going to be scared to give the answer, whatever it may be. So there's going to be situations that happen throughout your life. If you sit down and really think about it, you're going to say, huh, well, I remember when this happened, maybe that's why I'm experiencing greed in the market or fear in the market. So trust me, that is going to help you out a lot when it comes to overcoming these emotions. And if you haven't already, make sure to check out my book, The New Age of Technical Analysis, on Amazon. My second book is going to be dropping in a week and a half. So I'm very excited for you guys to read that one. I am going to say you need book number 1 to fully understand book number 2. So make sure you guys go pick up a copy, and the pre-orders for book number 2 are going to be up this Sunday or Monday evening. Again, I'm super excited for you guys to read that second book. But yeah, make sure you guys check out book number 1. The link will be down in the description. Now we could talk about greed. I personally didn't struggle with greed, but a major reason why I see people struggle with greed is because they think that they're never good enough, right? Or the profit is never good enough. Maybe you grew up and you always got A's on your report card and your parents never thought it was good enough, or maybe you were really good at football, but your parents never thought it was good enough and always pushed you to be better and better and better. That could lead to you being greedy in the market, thinking the profit that you made is not good enough. And as a result, you just want more and more and more. What do we know about greed in the market? Greed is an account killer. If you're up 50% on your contracts and you're not taking profits because you want 100, 200, 300%, that is being greedy. So you have to accept the fact that you have to take profits when the market is telling you to take profits. When price hits your profit goal, you want to start scaling out of your contracts. Not every single trade is going to be a home run. It is those base hits over an extended period of time is how we stay successful as traders. So if you experience greed in the market, again, sit down and think about every single situation that could cause you to be greedy in the market. Maybe you were that person on the football team or the soccer team who was doing really good, but you never thought it was good enough. Maybe your parents didn't think it was good enough, or whatever the case may be. You're going to start noticing, those situations are resulting in me being greedy in the market. Or maybe you're just an angry trader. Maybe something in your past has caused a lot of anger. And when you have a losing trade, maybe you get really angry, you get back into the position, you get stopped out again, you get angry again, flip the opposite direction, and then it hits your stop loss again, and then you get even more angry, and then you full port, and then you get stopped out and blow your account, and then there, of course, you're going to be super angry. But maybe something in your past has caused anger and you started to notice that it came out in your trading. Again, sit down, write down every single situation that could cause anger, and trust me, it is going to help you out a lot. Now, there's 2 books that I highly suggest everybody gets. The first one is going to be The Mental Game of Trading, and then once you read through that book, make sure you get the book called Letting Go: The Path to Surrender. It's like a little yellow and white book. Those 2 books together are going to help significantly with your trading emotion. That's going to wrap up emotions and trading psychology. Again, everybody has their own emotions that they face in the market, and it mainly stems from something that happened earlier in your life. It's just now coming out in your trading. So again, sit down, write down every single scenario that could result in that emotion. And once you read through those 2 books, especially Letting Go, it's going to help a lot with letting go of those emotions. So hopefully that can help you out in your trading over the long run. Anyways, that's going to wrap it up. In the next video, I'm going to be discussing take profit zones. That was a very highly suggested video, so I'm very excited for you guys to watch that one. That one is going to be out on Monday. I'm going to be busy tomorrow. But as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video. Alrighty, so how to identify take profit zones. So what we're going to do, let's just pull up ES futures. Now, when it comes to take profit zones, I'm going to be honest with you guys. There is no right or wrong way to identify your take profit zone. As long as you are aiming for a minimum of a 1-to-1 risk to reward, there's so many different ways that you can identify these take profit zones. And in this video, we're going to be discussing some of those ways. So say we're looking at ES today, and it looks like ES gave a nice little liquidity sweep right here, came back down, and it tried to double bottom. So looking at ES right here, we can see that it gave a nice little liquidity sweep below the daily lows at around 44.2675, and it ended up reclaiming the level. So as price reclaimed the level, that is when you could have been looking to go long with a stop loss right below these lows. Now, this is often where I get asked, where is our take profit zones? And like I said, there's not just one way that we can identify where these take profit zones are, but right off the bat, you could say, okay, ideally, I'm looking for price to come back and test these highs. As you can see, we got a liquidity sweep right up at those previous highs right there. So this could have been an overall take profit zones, ultimately what you would like to see. But at the same time, we're also taking profits as the trade moves in our favor. That way we can catch those larger moves. Let's just say that you go long 50 contracts on SPY. I highly doubt that you're going to want to hold all 50 contracts until this high up here. As traders, we want to slowly take profits off the table. That way we are guaranteed green. And then from there, we move our stop loss up, ultimately aiming for that overall take profit zone. So now how can we identify different areas that we can look to take profits? Another way that I really like to identify take profit zones is the indicators I use intraday is I use a 21 EMA, I use an 8 EMA, and then I use VWAP. So if I just go ahead and put the exponential moving averages on, and then we put on VWAP, we could see that VWAP, this middle line right here, could have served as a take profit zone. So let me go ahead and let me fix all this up real quick. Or my bad, that wasn't even VWAP. I don't know why VWAP won't pop up on this, but we'll just actually hold on. Where is this? Let's make it. Oh, that was VWAP. Okay, perfect. Yeah, so VWAP right here, that could have been a take profit zone. So I like to use VWAP as a possible area to look to take profits off of the table. If we head on over to this and we make it the 8 EMA, and let's just keep it right there, I'll be looking also to take some profits off the table at the 8 EMA. Also the same with the 21 EMA. So as we can see on this chart right here, VWAP is this red line right here. The 21 is going to be the black right here. And then this blue line right here is going to be our 8 EMA. Now, because the 8 EMA was so close to the area, it really wouldn't have made sense to even try to take profits at that spot right there. But as price starts reclaiming this area, let's just say that we ended up getting long at 4428.5. Let's get the long position. 4428.5 would be right here. We're going to be risking about 5 points to the downside. So the 21 EMA was only 2.75 points. That wouldn't have made sense to try to take profits there. So if I were to go long on this trade, the one-to-one risk to reward would have been at VWAP. So that would ideally be my first take profit zone at VWAP if we were to get long right here. Again, you want to at least be looking for that one-to-one risk to reward. Now, if price action itself is saying get out of the trade, then obviously you want to get out of the trade. Even if it isn't a one-to-one risk to reward, say you're only about 0.5, but price action is really saying like, hey, you should probably get out of this trade because it's going to go against you, then listen to the price action, exit the position. But again, ultimately, you want to be looking for a one-to-one risk to reward. Say you were to get long actually at the bottom, then okay, this is enough of a distance that we could look to take profits at the 8 EMA, 21 EMA, and then VWAP. But depending on where you enter, it might not make sense. So in this trade, you could have had your first take profit at VWAP, and then from there, you can also look at different zones. So what else can we use? We can use Fibonacci. Let's take a pivot low to a pivot high. We can aim for the 0.5 retracement. We can aim for the 0.618 retracement as possible take profit zones as well. So let's just go ahead and delete that off the chart. Say you were aiming for the 0.618 as possible take profit zone. Well, what else do we have on here? We could also be aiming for this fair value gap right here, very small one. Or we could be aiming for this fair value gap right here. Say you're aiming for the middle of the zone right there. That could lead as a take profit zone as well. So again, we could just go ahead and replay this entire trade. Say we ended up getting long at that 4428.5, stop loss right below these lows right here. Ultimately, what would we like to see high a day, right? But we're also taking profits as the trade is moving in our favor. So first price target could have been VWAP right here, which was our one-to-one risk reward. Boom. As soon as we hit it, what can we do? Move our stop loss up to break even. That way we are not risking anything on the trade. And then from there, we could have been aiming for the 0.618% retracement. Again, taking pivot high to pivot low down there. So that could have been another take profit zone. And then you could have been also aiming for this area right here, this fair value gap. And then your ultimate price target all the way back up at the high of the day for a 4R trade to the upside. So this is what I am looking for when it's coming to take profit zones. There's no correct way to say, okay, I'm only going to be trimming if we hit this area, because there's so many different ways that traders are looking for take profit zones. And I also want to point out that I'm not only willing to trim at those areas as well, right? So say price was getting up to my one-to-one risk reward towards that VWAP, and I start noticing that price is hesitating towards that area. I'm not going to sit there and force it and be like, well, we're only 0.5 points away from hitting this VWAP. I'm not trimming until we hit it. If price is telling me to trim my position, I'm going to trim my position. You can also watch level 2, which is going to help you identify strength and weakness in underlying price. And that is going to help you a lot as well when it comes to understanding, okay, should I trim here? Should I trim here? But those are the multiple different ways that I am looking to take profit. Let's just head on over to NQ and let's just go to a random day and see if we can find a random scenario. So let's just scroll on back and let's go right here. So actually there was a very nice liquidity sweep over here. As you can see, it's marked on the chart. So looking at the overall price action, you can see that price ended up dipping below the area, got bought back up, and then same thing right here, dipped below the area and got bought back up. In the stop loss video, we talked about how I'm not selling just because the stop loss is hit. I'm watching the underlying price movement to understand, okay, is it a weak touch of where the stop loss is going to be, or would the sellers actually be strong in this scenario? So again, depending on the overall price action, you more than likely did not get stopped out of this trade. We can actually even break it down to a 1 minute time frame. Let's just go ahead and I don't have it marked, but we'll go to a 1 minute time frame. We'll find it right here. Okay. So looking at the 1 minute time frame, we can see that the 1 minute time frame, honestly, nothing about this 1 minute candle said to get out of the position. All it did was dip and then come right back up and reclaim the level. So obviously you're not going to get stopped out in that scenario. This is why we want to use mental stop losses, because again, you'll be able to identify, is it a weak touch of where your stop loss should be, or is there actually a lot of selling momentum? So if you ended up getting short on this candle or even this candle, your stop loss is going to be below these lows, depending on the price action. Again, if it starts getting down and it's looking very weak, obviously you want to exit the position. But let's just say that you ended up getting long on this candlestick right here. Where can you look to take profits, right? There was really no reason to try to get into this position and then aim for the fair value gap, because it's already been hit and it's already been respected, right? So let's just say that you waited for the 5 minute candle close in this scenario right here. And again, if you break it down to the 1 minute time frame, the 1 minute time frame would have gave you an even better entry. So if you ended up sniping that entry off the 1 minute time frame, then well, look at this. As we see, we have the 8 EMA and the 21 EMA right here. So if you entered all the way down here based off of what was happening on that 1 minute or 2 minute time frame at that liquidity sweep, well, it made a lot of sense to aim for the 8 EMA and the 21 EMA. Again, our closest indicator, that is where we could look to take profit. So if we just go ahead and let's just say, again, or actually, let's just say that we got this position down here, right? We entered as the 1 minute and 2 minute reclaim this level. Stop loss is going to be slightly below these lows. Your first take profit is going to be towards that 8 EMA, 21 EMA. As it comes up, boom, that's where you want to take your first take profit. Then from there, looking at the chart, where else could this thing go to? Well, there's really not anything blocking it until VWAP, right? So that could be a second take profit. And then ultimately, what are you aiming for? The high of the day right here. Now, I also want you guys to keep this in mind. If I did end up taking profits right here, I'm not only trimming if price were to get up towards VWAP, right? Because as we can see, this is still a very nice move to the upside as price breaks through that 8 EMA and 21 EMA. I would be looking to take profits off of this move right here. Again, locking in profits, moving my stop loss up. That way I'm comfortable with letting the trade run and potentially catching even more profit. So as the trade pops, you could have been taking off more profits depending on how many contracts you're trading on SPY. Price pulls back and then price gets up towards that VWAP, again, an area that you were looking to trim. So as price comes up to it, make sure you're locking in profits, and then boom, right at that high a day, which was your overall price target, that is where you should be looking to exit your position. Sometimes we're not going to get that overall price target. That is why it's important we are locking in profits as the trade moves in our favor. Now let's just go ahead and let's flip it the other direction. Well, if we're looking at price right here, what do we get? Liquidity sweep right above these highs. As price closed on the opposite side, you could have went short. So let's get the short position right here. Stop loss would have been right above those highs right here. What is the closest indicator? VWAP. You could have been looking for a nice scalp towards VWAP for almost a 2R trade. And then from there, what could you have been aiming for? The 8 EMA right here, which would have been a 3R trade, and then the 21 EMA right here, which could have been a 4R trade. And then maybe from there, you were aiming all the way down here, which would have been an 11R trade. As you see, you wouldn't have gotten that ultimate price target all the way down here, but you had 3 opportunities to lock in profits to the downside and moving your stop loss to at least break even in this scenario. And then as you can see, price came up, boom, hit the stop loss. Let's just go ahead and look at one more example right here. If we're looking at NQ, as we see, it got a nice low liquidity sweep below these lows right here, ended up reclaiming it. Say you ended up getting long on this candle right here, again, breaking it down to a smaller time frame. Maybe you were able to get a better entry. So let's actually just go ahead and break it down to a 2 minute time frame. And let's see if price gave a good little liquidity sweep right there. And sure enough, yes, it did. So looking at the 2-minute time frame, you could have gotten a nice sniper entry right here. You could have gotten long at the end of this candlestick right here. So let's just put on the long position right there. And again, you want to give yourself a little wiggle room to the downside. It's not like my stop loss is always going to be right at that low. I want to give it some room below there. So again, this is in hindsight. This already happened. So yeah, I can sit here and say, okay, my stop low is going to be below this low right here. But it really depends on how price is reacting at that area. Looking at the 2-minute time frame over here, you shouldn't have been stopped out of this trade. Why? Price wicked down, came right back up, right? So as we see in this trade, if we just go back to a 5-minute time frame, what should the first price target have been? That VWAP, ideally. Where did this go? Right over here. Boom. Okay. So say you were to get long in this trade right here, boom, your stop loss somewhere down below these lows. Maybe you did want to keep a really tight stop and say, okay, well, I'm going to stop out if it comes down to this spot right there. Either way, you can see, okay, what are we aiming for? Again, using that 2-minute time frame, you got a really good entry right here. So you could have been aiming for that EMA. Is that a 1R trade? Boom. Yes, it is. So that was a 1.5R trade right to the 8 EMA. What are you looking to do? Take profits. Price got very close to that 21 EMA, giving you a 2R trade. Again, if you're up 2R on your position, you better be locking in some profits. Ideally, what are you aiming for? VWAP. And then if it wants to break above VWAP and give you more to the upside, you could have been looking for even more. But as we can see, if your stop really was right below this low right here and you were keeping a hard stop, price came down, it hit it, and then the 2-minute again confirmed the trade to get back in. So you could have went long again with a stop loss right below those lows. So let's just put one right there. And again, what are you looking for? At least a 1R trade. So if you got long right here, well, was this 8 EMA a 1R trade? Absolutely not. You don't want to be looking to take profits here. But that 5-minute 21 EMA was a 1.58R trade. Boom. That's an area you can look to take profits. What about VWAP? 2.25R trade. Boom. That's another area you can take profits. You could even aim for these highs over here. This high over here, maybe that same fair value gap right here, that price rejected right there. You could be aiming for that. There's so many different ways that you can identify these take profit zones. Ultimately, you could be aiming for high day. You could be using Fibonacci retracements, whatever it may be. There's so many different ways. And again, I am willing to trim before price hits the level if price is telling me to exit. I see a lot of people, they are so focused on saying, I am only trimming if price comes up and tests this fair value gap right here. That is the only area I'm interested in trimming at. A lot of the time it comes back to ultimately bite them because price falls short of the level, even though they were up a decent amount of their trade and they never locked in profits. Again, guys, the way that we are going to be able to catch these large moves in the market is by scaling out of our positions as long as it's a 1-to-1 risk to reward at a minimum before we start trimming, scaling out of the position, moving our stop loss up, and then looking for price to continue in our favor. At the same time, we're identifying other areas that we can look for trim spots. But yeah, that is going to wrap up this video. So hopefully you guys did find a lot of value in this. Again, this was a very highly requested video. So make sure if you guys did find value in this, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day. And make sure you guys tune in tomorrow, 7 p.m. Eastern time for another bootcamp video. Everybody have an amazing rest of your day, and I'll see you guys then. So important is because multiple different time frames are going to show us different setups. So you can't just simply look at a 5-minute chart. We're going to pull up ES. So you can't simply just look at a 5-minute chart and understand the overall trend and identify high probability setups. Like sometimes, yes, you can identify, oh, there's a 5-minute bull flag, but there's more to that. You need to understand what's happening on the higher time frames. Is the 1 hour looking bullish? Is the 4 hour looking bullish? Maybe we're coming up to a daily level. That's really important. And if you're ignoring those higher time frame levels, that's where you can really mess up as a trader and slowly start burning away your account because you're so focused on only one time frame. So personally for me, when I start my analysis, I am always looking at a daily time frame. The reason this is so important is because it's showing us the overall trend in the stock. Like, yeah, SPY was in an uptrend right here, but if price is coming up to a strong reject area, maybe off a weekly time frame or maybe even off a monthly time frame or a further back daily level, we could start looking for rejects, which again is why we want to do multiple time frame analysis. If you're only looking at 5-minute candles over here, you might not know that this is a supply zone right here and that you should ideally be looking for rejects in this area. And then once price breaks the supply zone, that's where you can start looking for more upside. So I like to start on either the daily or the weekly time frame, identify any key areas. Again, we talked about Fibonacci. So you could go on the weekly time frame. You could have said, oh, well, here's our clear-cut pivot high, pivot low. Let's start looking for rejects at the 50% retracement, which you can see reject here, reject all through here, or even at the 61.8, because we took a lot of rejections at the 61.8 on SPY. The level was 429.61. I still remember it. And there was so much price action at that level. Again, using the multiple time frame analysis, we were able to identify that key area for a reject. Also, looking at the weekly time frame, it looks like ES is getting very close to weekly supply up in this area right here. So we could end up seeing a reject at around 45.65 to 46.36. That's definitely a possibility. And again, you're only going to be able to see that on the weekly time frame. You can't see that weekly supply on a daily because all you can see right here is consolidation. You're definitely not going to see it on an hourly, a 4-hour, 5-minute, 15-minute, whatever it may be. So you want to always start on the higher time frame, the weekly, the daily, to get a very good understanding of where price could currently go. Now, once you're done looking at the weekly or the daily, that's where you can break it down to a smaller time frame and start looking for other setups. So you could break it down to a 4-hour and you could say, okay, well, we have this low point right here and we have this high point right here. We could look for liquidity sweeps at these areas right here. Again, you couldn't really see those on the daily or weekly. Or you could also look at this and be like, wow, we have a lot of previous support over here turned into resistance. We could start watching this area right here for a potential reject. And as we see, if we just break it down to a smaller time frame, price really never rejected inside of that zone at all. All it did was grind through it until it finally broke above it. So again, there was no reason to enter short on SPY. Also on the 4-hour time frame, you could have said, wow, there's a little bit of supply right here. So we have a very large 4-hour zone right here. You can see price came up into that supply area, ultimately ended up rejecting it, and then price ended up coming down. And again, this is the importance of multiple time frame analysis because it's going to show us things that we're not able to see on other time frames. So once I'm done on a 4-hour chart, I'm then going to break it down to a 1-hour chart. And I'm also looking for any chart patterns, bull flags, bear flags, ascending triangles, descending triangles, falling wedges, rising wedges, head and shoulders, etc. Sometimes you're only going to be able to see those on a specific time frame. There's been many times where I'm able to see a 1-hour bull flag, but if you're on a daily time frame, you're not going to see that bull flag whatsoever. And again, that is the importance of multiple time frame analysis. So then once you're done on the 4-hour, again, break it down to a 1-hour time frame. What do we notice right here? Liquidity sweep right above these highs and price ended up flushing to the downside. But also at the same time, what do we notice on the 1-hour time frame? We have a pivot high to a pivot low that we could use on the Fibonacci retracements for a possible reject. Again, using a daily time frame, you would have never been able to see that level. Again, looking at the 1-hour time frame right here, there was a possible liquidity sweep level, and as we can see, price broke below, reclaimed it, and then gave a nice push to the upside. You would have not been able to see that liquidity zone on the daily time frame. You only would have saw it on a smaller time frame. So now that you've identified all of your key areas on the higher time frames, weekly, daily, 4-hour, 1-hour, any Fibonacci retracements, supply and demand, chart patterns, support and resistance, etc., I then break it down to smaller time frames to identify entries. So I'll watch a 5-minute time frame, a 15-minute time frame, or a 10-minute time frame, and then a 1-minute or a 2-minute time frame. What I am looking for is for price to have confluence at my area of interest. We talked about this, I believe it might have been video 2 or 3 on this channel about price action and areas of interest. It was like literally the first 6 videos had to do with levels of interest and then piecing together price action with those areas. So again, if we have a higher time frame level, say we're looking at a reject up here, because I do know SPY ended up having, let's go to SPY real quick and let's go to a 1-hour time frame so you guys can see this. If we go to the 1-hour time frame on SPY, we had this previous high point right here at this 44 or 446.35. So we know that this could potentially be an area for a reject, and I don't know why it's showing it like that on here. Let me show you guys on Thinkorswim. So now heading on over to Thinkorswim. Again, I don't know why that was being weird, but as we can see over here, this was the high I was talking about at 446.81. So maybe I just marked the area wrong. But you can see price came up to the area and had a pretty hard flush to the downside. Again, you could have used that area for a possible reject. And then using the smaller time frames, look for a valid entry at your level. Let's go on over to I don't know, let's just pull up, I guess Google, because Google is a really good example right now that ran a lot today. Unfortunately, I wasn't able to catch it, but if we just zoom out to a daily time frame on Google, and again, I talk about this a lot in my first book, the TTM squeeze in the 21 EMA. There was a very nice daily squeeze on Google. Price came down, it held it as support here. Yesterday, it held the 8 EMA as support here. Since price is respecting that 21 and 8 EMA with a squeeze, more than likely it should fire up. So using the higher time frame analysis, we have a really good understanding. Okay, price is holding these areas. We have a very nice daily squeeze. Price is respecting these levels. Let's ideally look for an upside move on this. So you break it down to a smaller time frame, and we can see price had this low. It pushed up to this high, came back, respected that 8 EMA as support 1, 2, 3, 4 times. And then from there, Google continued to push all the way to a high of around, what is that, 136.6. From there, you could have looked at other time frames, the 1 hour time frame. Where can you identify any trim points? Well, if we're looking at Google, this was the previous high over here at 134.50. So that would be an area that you would want to look to trim. And then if Google was able to break above there, I mean, on the 1 hour time frame, there wasn't any possible rejection points. And then using a daily time frame, you could start looking for any other rejection points or any other previous support turn resistance areas that you could use as a price target. And then let's just take one more look at, we'll just pull up NQ. So looking at NQ on the daily time frame, if we just zoom out to a monthly time frame, we can just clearly see that NQ is clearly in a monthly uptrend. Very nice volume on this candlestick as well. Very nice lower wick. So, I mean, what is that telling us? More than likely, we should try to see more upside. So let's see where that volume ends at the end of the month. But if we get that kind of price action with this monthly candle close with the volume, I like more upside on NQ. But this is just letting us know the overall trend, right? We can still look for rejections. We can still look for bounces. Looking at the weekly time frame, I pointed this out on my channel. As price is grinding to the upside, this weekly candle right here was the highest selling volume that we had with a bearish hammer since all the way over here, right? This was the highest weekly volume that we had right here. Nothing too special about that candle, but this was a bearish candlestick. Again, bearish price action, bearish volume, very heavy selling volume. And then from there, what happened? Price stalled out for a few weeks or a couple weeks after that, and then it pulled back down to the downside. So weekly is telling us here, hey, we should probably look for a slight little pullback on NQ. Again, we can still look for bounces and rejects intraday, but this is just letting us know, again, multiple time frames are showing us multiple different opportunities to take trades. So now looking at NQ on the daily time frame, well, as we see, price started pulling down to the downside, had a very high volume doji, which is letting us know buyers and sellers are uncertain. Not enough to tell us that, you know, price is going to try to rally to the upside from here. But this is just letting us know, okay, let's just stay patient. Let's see if price is going to break below here, because if price broke below that low, then it did have more downside into a possible retracement zone. So then from there, price pushes up, lighter volume, even lighter volume. And then this candle right here, very light volume, which is typically telling us a reversal is going to happen. And then from there, we had a pretty hard sell-off to the downside. So now if we just break it down to a 4-hour time frame on NQ, well, on the daily time frame, we weren't really able to see this fib right here, so we could have taken this pivot high to pivot low and look for any possible rejects. As you can see, price just blew through the 61.8, blew through the 70.7, so really nothing there. But on the 4-hour time frame, what do we notice? We have a possible area for a liquidity sweep, and you're only going to be able to see this on the 4-hour, 1-hour time frame. Sure, you could see it on the daily, like right there, but that's not like too obvious of a point, if you know what I mean. Like, you're able to see it better on a 4-hour or 1-hour time frame, right? So using the 4-hour or 1 hour, you can identify, okay, there's possible liquidity up here. 4-hour time frame, there was a clear cut pivot high, pivot low for a possible reject. And then possibly even going into tomorrow, if price were to reject this area right here, I have delayed data on TradingView, as you can see, but if price were to reject right here, well, looking at the 1-hour time frame, we do have this pivot low to pivot high right here, and then we could look for price to come down and possibly bounce off of these areas right here. So again, multiple different time frames show us multiple different opportunities that we can take. And then from there, we're using the smaller time frames, 5-minute, 10-minute, or 15-minute, and then a 1-minute or a 2-minute. And then as we see, for a majority of the day, price just rode the 8 EMA to the upside, came down, tested the 21 EMA, and now it's still continuing to push to the upside. Again, it could give a liquidity sweep up here. If price breaks above it, gives a bearish reaction, it starts coming back down, then that confirms your higher time frame level, and you could look for a short opportunity with a stop loss right above these highs. Again, it could have already done it. I have no idea. Again, it's very important that you are doing your analysis on multiple time frames, because if you're so focused on only one time frame, you're going to end up taking trades that aren't making sense to the higher time frame. And again, if you're so focused on only one time frame, you're ignoring everything else on those higher time frames, daily, weekly, 1 hour, 4 hour, and you could be taking a trade right at an area of resistance or right at an area of support, and as a result the trade goes against you. So do yourself a favor, do not ignore the multiple time frames. Make sure you are doing multiple time frame analysis and use the smaller time frames, again, 5-minute, 10-minute or 15-minute candle, 1 minute or 2 minute, and watch the price action very closely at your area of interest. But that is going to wrap up this video. So as always, if you guys did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day. We have, I think, 2 bootcamp videos left. So I'll see you guys in tomorrow's bootcamp video. Talk about some trades that I ended up taking, talk about my reasoning behind them, which is also going to piece together everything we discussed inside of this bootcamp. So let's first start off by looking at a swing trade that we took on BRKB that went from 1.6 all the way to 3 overnight. So how do I pull this up? There it is. So if we go on to the daily time frame, ideally looking for more out of this trade, I would like to see 100% on this. But what I was watching on this BRKB was we had a very nice daily squeeze, which again, I talk about all the time, but we had a nice daily squeeze. Price came back down yesterday and retested that 21 EMA and had a very nice bullish reaction. So we ended up purchasing the 365 calls expiring September 14th, September 15th, whatever that third Friday of September is. And again, these contracts went from 1.6 all the way to 3 in just one single day. Ideally, what I'm going to be aiming for is this previous high at 364.50, but we've already locked in a decent amount of profits and our stop loss is now at break even. So if we come up to that 364.50, that's ideally what I would like to see, but an even better price target that I'm aiming for is way up here at this 368.67. So that was the first trade that I ended up taking. The second trade was a trade on SPY today that actually did 100%. So if we zoom out to the 1 hour time frame, and let me actually pull up my pre-market watch list. If you guys don't know, I am live every single day on this YouTube channel and give you guys this watch list for completely free. I come up with it right in front of you, so you guys are seeing how am I identifying these levels, why are they important. You can ask questions, so make sure you guys are tapping in every single morning, 8 a.m. Eastern time. But as you can see right here, SPY looking for a reject at 451.5 up to 452. Why did I like that level? So if we zoom out to a 4 hour time frame, we can see that 451.50 was this previous support point right here. So previous support and resistance, as you can see, resistance here, support here, support here, support here, and then we rejected this level multiple times. That's why I liked 451.5. But then if we head up towards 452 right here, you can also see that we have other price action at this level. We got very close here, we supported here, we rejected right there, we had support here. So that is why I like this entire zone right here. And again, I have a video on how to identify support and resistance zone. So this was my main reject area. Now with SPY, as it came up towards that 451.50 originally right here and started rejecting off the level, that is when I got my first entry. But I ended up adding to my position at the end of this third 15-minute candle. Now, why did I add to my position? So on TradingView, I don't know why it's showing that has higher volume. So looking at Thinkorswim, if we go to the 15-minute time frame, you can see that this candlestick right here had very high volume. Obviously, that's going to be given the market just opened at 9:30 to 9:45. So very high volume right there. But then we had a very large bullish candle on this 15-minute time frame with lower volume right here. So that was the warning sign and price was coming up to a key area. And then as price closed on this third 15-minute candle with lighter volume, that is when I added to my position with a stop loss above 452, which was the top of my resistance zone. And again, we talk about this in the volume class. Typically, 3 decreasing volume candlesticks in a row of the same color is going to be a reversal pattern. That's typical on any time frame, the daily, weekly, 5-minute, 15-minute, whatever time frame you are using. This is a very common reversal pattern. Decreasing volume of candlesticks that are the same color. it works with red candles, and it also works with green candles. So that is why I added to the position, and I was able to catch this all the way down into 450 for a beautiful, beautiful trade. Now, the final trade that I took for the day, it was a quick little scalp. It wasn't anything crazy. But again, we talk about fair value gaps inside of this boot camp. You can see that as price flushes to the downside, it bottoms out right here. What do we get right here? A nice fair value gap. So I drew in the fair value gap. I told everybody that I was watching around this 450.2 area. Now, why did I like this area? Because it was the midpoint of the fair value gap. Again, we talk about this, measuring this low to this high right here, giving us the halfway point. We had VWAP, we had the 21 EMA, and on this 5-minute candlestick right here was a very large candle, however, very weak buying volume on it. So we ended up getting short, and I was able to catch a nice little scalp down into this 2-minute fair value gap, and then I did get stopped out of the remainder of the position. So this is where my first price target was. Ideally was aiming for low a day. So as price came down towards that fair value gap, that is when I got my first trim off. And as we started to break above that 450.35, that's when I fully exited the position. So nothing crazy on this trade, but the BRK B swing was absolutely beautiful. And then the first SPY trade was absolutely beautiful. So those are the recaps from today. But now going forward, wrapping everything together, I mean, you guys have all the information that you need to become a profitable trader. All you guys have to do is now put in the work. And again, I'm going to keep saying it. Make sure to take advantage of this bootcamp because it is going to go private very, very soon. So take advantage of it while it's still up, but also take advantage of the 750 other YouTube videos that I have on this channel. So if you take advantage of everything that is posted here on this YouTube channel, plus checking out my first book, The New Age of Technical Analysis, on Amazon, that is 450 pages, goes over a lot of information that was not taught inside of this boot camp. But then also on top of that first book, make sure you're checking out my second book that is releasing this Sunday, The New Age of Day Trading. This one is going to be an absolute banger. This one is, I think, like 330, 350 pages, something like that. But this one releases this Sunday. So if you're taking advantage of everything on the YouTube, the first book, 450 pages, the second book, around 330, 350 pages, you're going to be able to build a very solid foundation for your trading. Hopefully it helps you out a lot. So again, make sure you are marking your calendar for this Sunday. Again, The New Age of Day Trading will be releasing on Amazon. But yeah, that's going to wrap up this video. Hopefully you guys did find a lot of value throughout this boot camp. I do have one more boot camp video uploading tomorrow. And the final time I'm going to say it, make sure you guys are taking advantage of it before it goes private. Everybody have an amazing rest of your day, and I'll see you guys in tomorrow's final boot camp video.